Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of, I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone
1
else
minute to go
who comes
down.
after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
What we try to do is combine some of our insights from the fundamental business with external and data set signals. And I think that's a lot of times where the opportunity is.
10 seconds.
Live from New York. Welcome to the program. Here's the state of play for you. Positive by 0.75% on the S&P 500.
Hike 200 basis point hike, 200 basis point hike to 18% as expected. Seeing 3M earnings coming through here. Second quarter adjusted EPS continued opposite at $1.93. Second quarter net sales at $6.26 billion. 3M still sees fiscal year adjusted organic sales 0% to 2%. They also still see that fiscal year adjusted total sales minus 0.25% to 1.75%. Fiscal year adjusted EPS continued ops at $7 to $7.30, previously seeing $6.80 to $7.30. Second quarter net sales at $6.26 billion, a beat on estimates of $5.84 billion.
It seems like people are rallying around the idea that these can be insurance cuts or preventative cuts of something that is more pernicious. And yesterday's prints really seemed to highlight that that seemed to be the case. Question is just how much the Fed commits itself. And to Bill Dudley's point, what we're not seeing, because there have been a lot of downward revisions in the labor market data. And that, I think, is one thing a lot of people are pointing to.
I think this comes down to two things, Lisa. I think it's one, what is your assessment of the labor market? And two, what do you infer from that as to how much time you think you have to remain on hold at the Federal Reserve? And when we spoke to Bill Dudley yesterday, his view on one was that this labour market is more fragile than the Fed thinks, and two, they have less time than maybe they think they do. And this is what's interesting about next Friday for me. How does this market respond if we get a bad payrolls number? How does this market respond if we get unemployment going through the so-called SARM rule? Is the Federal Reserve comfortable with all of that? They might just say it's a one-off. Based on some of the commentary we've had over the last couple of days, I can imagine people piling on and saying, this is it. They've got to make a move. It's growth scare. The labour market's breaking. We're heading to recession. The SARM rule's triggered. Then you've got an even messier market. And we're this close to something like that happening.
You frame this as how will the Fed respond to this? There's also this question of how does the market respond to this? And we've kind of gotten a sneak peek at just the surface of how that response, how deep that response could potentially be. What we're looking at in markets is the hope and the prayer that the Fed cuts rates proactively. If they cut reactively, we've gotten a sneak peek of just how much we could see that sell-off. And Michael Hartnett of Bank of America saying, actually, even financials are set to lead downward if we do get a true growth scare and do see some of these revisions continuing, particularly on the negative side in the labor market.
Michael's point, he says we're one bad payrolls report away from all of that. Let's see if that payrolls report comes on Friday. The trend over the last 2 years has been a surprise to the upside. So let's see. Let's turn to foreign exchange. I want to talk about dollar yen. The range on dollar yen in yesterday's session, okay? At the low of the session, 151.94. At the high of the session, 154.32, and at the close, just short of 154. Right now, we're back to 154.30. We had saw massive swings on stocks like Nvidia, but we also saw big swings cross-asset. in currency pairs like dollar-yen in yesterday's session. I think as things stand still, we're still heading towards a fourth weekly decline on that currency pair. Haven't seen that all year. Going into quite a big week also for the Japanese next week.
Yeah, for the Bank of Japan to come out and decide whether or not they're going to hike rates. In a lot of the research notes that I've been reading over the past couple of days, the ultimate question is, how vulnerable is this market to an inactive Bank of Japan meeting? If they do not raise rates next week, how much does this yen weaken right back to where it was before this rally began? It feels technical in nature, unclear what's driving it. The Bank of Japan could quash that if they want to by simply doing nothing.
Dollar yen 154.30. Under surveillance this morning, our top stories. Let's start with this one. Vice President Kamala Harris pushing Israeli Prime Minister Benjamin Netanyahu to accept a ceasefire deal with Hamas, highlighting concerns over the civilian death toll in Gaza. Netanyahu also met with President Biden and will be visiting Donald Trump at Mar-a-Lago later on today. So picture this, you're a foreign leader and you've now got to meet with three. Got to meet with the sitting president, separately from the vice president, and also you've got to meet with the former president who might be the next president as well. What on earth does policy look like after January?
Well, this is part of the reason why Peter Scheer is very concerned about some sort of geopolitical issue springing up now, because it feels a little bit, not that there's a vacuum of leadership, but that it's unclear who has the strongest grip over policy going forward, and I'm talking about beyond January of next year. It's interesting to see how Kamala Harris was trying to create daylight between her policy and Biden's policy, coming out with some harsher words for Netanyahu. And then, of course, you have Donald Trump, who is a huge supporter of Bibi Netanyahu. And this sort of acceleration of the divergence in U.S. politics by Netanyahu is something potentially some people have speculated he could exploit.
He's in a hot war. You've got Ukraine in a hot war. And they could have a very different relationship with the United States of America come January, depending on who wins in November. That's quite a turn of events. The lack of continuity in foreign policy in America, I think, is what Peter Scheer is getting at over at Academy.
And it starts to sort of raise the question of what could happen. You start talking about Ukraine, and Volodymyr Zelensky really said, look, I know you don't want to talk about things publicly, but just let us know. If you're going to be playing with our future, I just want to know what the policies are from the prospective nominees, because a lot could change, and we want to be prepared.
That's the latest in Washington. Let's get to the latest in China. Apple losing ground. How many times have we seen reports like this? Market tracker IDC saying iPhone shipments dropped around 3% in the last quarter, pushing Apple out of the top 5 as local rivals such as Huawei have been surging ahead. Even deep discounts, and I think this is the important point here, failing to help boost sales of Apple at a time when the sales side leads are getting bulled up on this idea that when the new iPhone drops in September, you're going to get this massive upgrade cycle off the back of it.
So here's what I'm looking for. How many international companies are going to start to X out China and propose growth models that have nothing to do with that nation? Because essentially there have been a number of reports that a number of the executives who went to China from the United States, big heads of multinational companies, don't know how welcome they are. And the rhetoric is not convincing because policy has not been. With Apple, sure, you could say that the price is probably part of the issue. You could say also that, hey, the phones have been banned by a lot of governmental agencies. There's a big push into national companies which have exceeded, all of them have exceeded Apple for the first time. It just creates a very difficult environment to really have any predictability. We're talking about U.S. policy uncertainty. Sure. How about China policy uncertainty for some of these companies?
Look, that environment is always going to be cultivated by the central government, by the Chinese Communist Party, but also this turn of consumption, how consumers have gravitated towards national players. You mentioned Peter Scheer. That's also something Peter Scheer's been on top of. How welcome are they? Not just by the government, but also by the consumers on the mainland.
Which, again, goes to this point of how much are companies still expanding in China? You know, whenever we ask people about China, executives of companies, they always really hedge, almost invariably. Qualcomm CEO is a little bit different. He said, we like China. It's important for our business. But most executives say, you know, we're cognizant of some of the risks. It's an important market. We are aware. We want to make sure that we're, you know, being within everybody's guidelines. What they're doing is totally different. They're moving production to India. They're moving away. They're diversifying their supply chains. They're very aware of the potential risks.
It's not what they say. It's the physical reaction that gets me. You know, the jacket will be done up, and then they'll undo the button because it's getting a bit hot. Yeah. And then they don't know what to do with their hands anymore, so they're sort of like this, China, yeah, no. It's the physical reaction. You just saw them, they react physically to it. They know it's a topic they've been briefed on by public relations just not to touch. Don't go there. Don't go there.
Nothing good can come of it on either side of the equation.
We keep asking. Apple's positive in the pre-market. We're up by about 0.9%. It's a difficult one for them, I know. I want to turn to foreign exchange. Investors looking ahead to a double dose of central bank rate decisions in the next week. The Fed and BOJ both drop on Wednesday. The yen rally facing a moment of truth as the currency holds onto an advance of about 5% against the dollar since just before it began surging on July 11th. Jeremy Stretch of CIBC writing this: should the bank desist from tightening next week, as we assume, we would be mindful of dollar yen retracing half of the recent correction. Hence, we are mindful of a correction back towards 156.90. Jeremy joins us now for more. Jeremy, we've seen massive swings in dollar yen over the last couple of days. What do you think has been going on? Is this all just about fundamentals and looking ahead to the prospect of a rate hike next week, or is it something more than that?
Well, I think there are a couple of things definitely in play in the context of this move. Clearly, we've seen excess yen short positions. Some of those have now been partly compromised. But I think also at the same time, we've seen increasing speculation of late regarding the prospects of a BOJ hike coming at next week's meeting. So in the context of yesterday's move, when we did trade briefly below 152, we were trading in the region of 9 bips or so higher, or around that sort of threshold in terms of pricing for next week. So amplification in terms of BOJ assumptions, allied to paring back in yen short positions, have really amplified this sort of uncertainty and volatility, which of course comes as we've seen risk very much under threat in recent sessions. So I think there's certainly a couple of factors in play, but I think in terms of the BOJ, we would expect once again the bank to overpromise and underdeliver or maintain a dovish tone, and that is why we would probably prefer to anticipate that dollar yen does risk moving back higher.
Jeremy, you said there were a couple of factors at play. How much is a sort of fundamental question about the Bank of Japan, and how much is this just a couple of hedge funds that blew up?
Well, I think, as I say, we have seen significant repricing, or at least attempts to reprice the BOJ view for next week. So I think that's one of the factors. But clearly, I think there is a case to be made that when we do see episodes of market uncertainty, then it is often the case that some of those positions which are proving to be profitable are also unwound as a consequence of any uncertainties elsewhere in the market. So I think there are a combination. I wouldn't necessarily ascribe a particular sort of proportion or dynamic influence on either of those factors, but I think the combination have certainly proved to be a fairly powerful cocktail in the context of what are, of course, relatively illiquid in summer markets, and that does amplify that intraday volatility.
Jeremy, how much is this a yen story, and how much ultimately is this a dollar story? Is this a question about people getting more confident that the Fed's going to hike cut rates at least in September in the face of data that's definitely cooling?
Well, undoubtedly, in our view, we have been anticipating a September Fed rate cut for some time, and we would and had been expecting the data to validate that. And I think that generally is broadly proven to be the case. Now, obviously, that GDP print yesterday was somewhat hotter than expected, but I think the underlying trend is of a slower pace of growth, certainly in the first half of the year relative to last. And I think the inflationary dynamics, as well as the labour market, are also signalling that there is a need or a necessity for the Fed to start policy easing come the September meeting. So I think there is increasing confidence in that regard. And I think it may be the case that whilst we continue to see US economic exceptionalism relative to the rest of the world in the first half of the year, I think that exceptionalism and the argument around that will start to dissipate as we move forward. And I think that does validate the presumption that the impetus of the dollar, I think, will gradually reduce, albeit, of course, there are still cross currents, not least of which in relation to US political dynamics.
Jeremy Stretch of CIBC, looking for a swing in the other direction. Jeremy, appreciate it. Looking ahead to the BOJ and the Federal Reserve next week. I think Lisa took this conversation in the right direction. When you have a big consensus trade like this one, short Japanese yen, for this long, other things are kind of built on top of it. So when you snap back the other way with speed, and it's the speed that matters from, say, 160 down to 150, things start to crack elsewhere. Identifying where those cracks are and where they're coming from is important.
Yeah, and I don't want to spread rumors saying that someone blew up, because there's no evidence to suggest that. It's just simply, there seems like perhaps there were a few, I don't know, trades that sounded and rhymed very similar that were leveraged that got blown out at the same time. And we saw the unwind of that. And that's what a lot of people have been talking about. Very hard to attribute some sort of fundamental reason behind that.
Dollar yen has had a 157 handle this week and a 151 handle. this week as well. That's quite a range. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Mercedes is the latest automaker reporting a decline in its second quarter profit. It trimmed the upper range of its forecast. It now expects returns on sales between 10 and 11%. It previously said the high end could be 12%. Automakers are under pressure from weaker demand in China and a drop in purchases of battery-powered cars in Europe, with governments cutting back on financial incentives. Mercedes shares fell as much as 3% in the early trade before paring some of those losses, given weak earnings were somewhat expected. Shares are flat over the past year. And JP Morgan has launched a new internal AI chatbot in one of Wall Street's largest use cases for the technology. In a memo viewed by Bloomberg, JP Morgan told its employees to use its own version of ChatGPT as a writer, idea generator, and problem solver. The FT earlier reporting that the chatbot could do the work of a research analyst. Many of the big banks have been experimenting with AI over the last year, with hopes it lives up to its productivity and cost-cutting potential. Citigroup has estimated that the technology could displace more jobs in banking than any other industry. And former First Lady Melania Trump is publishing a memoir this fall. The self-titled book is described by her office as a, quote, powerful and inspiring story of a woman who has carved her own path, overcome adversity, and defined personal excellence. The book will sell for $40. A signed copy will be available for $75, and a collector's edition will go for $150. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next, big policy questions on the horizon.
The trajectory for debt and deficits is quite dire, regardless of who gets elected. I think that's something that the next administration is going to have to address.
Up next on the program, the former World Bank president, David Malpass from New York. This is Bloomberg.
Jason Kelly, and this season on Power Players, we're taking you behind the scenes to see how the business of sports has gone global.
I want sports to grow. I want sports to be bigger because we have talent.
And how mammoth value is coming from the smallest of players. 3,184 hits, 431 home runs, and of course the most famous stat that everybody knows, 2,632 consecutive games played. Unmatched career. Why are you doing this?
What we have achieved in the NWSL from an investor perspective over 2 years is the equivalent of what it took other leagues 25 to 30 years to achieve.
You've got to have a business that's sustainable. The only way it's sustainable is got to make money.
There's only one word, winning. You win on the court, you win off the court. And as you do that, you bring people along.
The top names in business are on Bloomberg.
What I can say is that we've been making significant investments across the franchise, across regulatory reporting, across data, and across resolution and recovery planning. These are areas we've been investing in because we know they're areas that, frankly, the industry likely needs to further enhance, and we certainly want to enhance them for ourselves.
Nobody covers business like Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close, weekdays at 3 p.m. only on Bloomberg Television. Context changes everything. Season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
If you are just tuning in, welcome to the program. Equity futures bouncing back. Pretty volatile session yesterday, and I have to say, pretty volatile week. Equity futures up by 0.75% on the S&P. In the bond market, yields just about unchanged. The 10-year 4.24. Under surveillance this morning, big policy questions on the horizon.
The trajectory for debt and deficits is quite dire, regardless of who gets elected. I think that's something that the next administration is going to have to address. It makes it very tricky for the Fed to be able to cut rates, in an environment where debt and deficits and long-end yields could potentially rise if the market and the bond vigilantes start to kind of push back on the narrative that's coming put forth by the administrations that come to power.
So big week ahead, and here's the latest this morning. Treasury's holding steady after recent gains as optimism grows over the Fed's first rate cut. Bond traders also looking ahead to next week's quarterly refunding announcement from the Treasury Department. Alongside us in the studio here in New York, the former World Bank president, David Malpass. David, good morning to you, sir.
Good morning, John.
I want to start with this quote, and I think this is a timely conversation for us. It comes from Hudson Bay Capital, Stephen Mirren, Nouria Rabini, two people I'm sure you know well. Here's the quote. By adjusting the maturity profile of its debt issuance, Treasury is dynamically managing financial conditions and through them the economy, essentially taking over the core functions of the Federal Reserve. And they dub this novel tool activist Treasury issuance, or ATI. Can we just reflect on all of this? What did you make of this piece? What are they telling us?
I love new acronyms, ATI. So activism, so Treasury has to decide every quarter whether to issue T-bills or bonds and which bonds to issue. And they do that in conjunction with Wall Street. And the problem, and I've written a lot about this in the Wall Street Journal, is that puts an overlap between them and the Federal Reserve. So that's a challenge right there. As you decide where the issuance is going, it affects the shape of the yield curve, and when you do that, you're affecting stock prices. So you've got this giant direction for capital based on whether Treasury is borrowing short or long. Right now, for years now, they've been borrowing too much at the short end and not enough in the 10-year kind of window, the 30-year window.
And why does that deliver meaningful consequences? Can we explore that a little bit more? If you think about the shape of the yield curve, it's the same amount of debt. It's just being issued at the front end of the yield curve and less at the long end. Why are there meaningful consequences when you increase or decrease the level of debt at the longer end of the curve?
When QE started, that was the Federal Reserve buying a lot of bonds in, say, 2010, 11, 12, 13. That flattened the yield curve. So you had the Fed buying longer maturities, basically the Fed buying duration. So when the market hears that, that's positive for equities, but it's not positive for small businesses around the country. They borrow at the short end. So basically, Treasury is the big foot coming in and borrowing right at the spot where your small businesses want to borrow for inventory, for construction loans. So if you could change the shape of the yield curve to be more upsloped or upsloped at all right now, you would liberate a lot of floating rate loans for people that really need them day by day in order to get their businesses growing.
Some people could say that this is actually just smart policy because ultimately the Treasury Department didn't want to lock in borrowing costs at 5% for the next 10 years. And they wanted to have a short-term kind of lease on rates that were at the highest levels in decades. Why don't you see it that way?
Hi, Lisa. I think that's a bet made by the Treasury. So we already saw a giant bet made by the Fed on duration, and they've lost, billions and billions. And I think it will end up being $1 trillion from that mistake when they were buying long bonds with short-term interest rates. Think Silicon Valley Bank, or think a hedge fund that made a bad bet. So as Treasury does that, they should be more neutral about the economy. Here we are coming into an election cycle, and they have they're holding down the long end of the curve, which props up the equity market. It fuels, think of where the capital is going right now. Treasury is borrowing short, so it means a lot of long-term, long-duration capital can go into equities or can go into long-term bonds. So you have this phenomenon for years now of corporations issuing bonds and buying back their stocks. You've got dividend recapitalizations going on now. This is all a phenomenon of the shape of the yield curve, which is being controlled, I think, in an anti-growth way by Treasury and the Fed.
This may sound like an esoteric conversation. It's pretty much anything but. It's talking ahead of 8:30 a.m. on Wednesday, when we're going to get the Treasury refunding agreement, where they announce what kind of maturities and the amounts that they're going to be selling of government debt. It comes at a time where Fitch said in a recent report that heavy Treasury supply is a key risk to our lower yields call across the curve. And it comes at a time when you potentially are rumored to have an ear toward another administration of Donald Trump. What would you, if you were in a situation to dictate maturities, do in order to, say, increase maturities of U.S. government debt while not sort of causing this massive sell-off at the long end that could be hugely disruptive.
Yeah, and I think you have to be neutral from Treasury and from Fed, that you're not trying to manipulate the yield curve. You know, historically, there was remember the Operation Twist, which was a big failure in a previous decade, a previous century, and so the government has tried to do this, and it ends up hurting people within the country. So all you have to do, I don't think it's that hard, is say what your goals are, that you're trying to not have the short-term funding be the most efficient. The Treasury is making a bet right now that they'll be able to refund at a lower yield later on. How do they know that? And wouldn't it be more confidence-inspiring if they allowed the market to help them do that? They're asking the world to keep giving, you know, the U.S. the Treasury borrowed in 2023 $23 trillion in its coincidence in 2023. And so that's a giant amount of debt for the market to digest. So say to the market, we are working toward a lower yield curve that's upsloped. That's going to maximize business confidence and be very positive for growth. They're not doing that. They're saying instead, we're going to keep borrowing short term because, as Lisa's pointing out, it might be cheaper if yields fall. It might cost them a lot. Right now, it hasn't been a good bet. If you look back
the core principle,
over the last
as you know,
2 years,
David, just to jump in, is meant to be regular and predictable debt issuance out of the Treasury. That's meant to be the core principle. Do you think we've moved away from that? Do you think this is a permanent fixture of policy now, this tool?
Clearly, it depends on the political cycle where you're going to borrow on the yield curve, and if you're trying to prop up markets in the short term or the long term. And that also affects, and it's very important, the actual capital flows going on in the economy. So there's been this heavy bias toward big companies and toward the government. So, you know, that same point that you're making about where the Treasury is issuing means that the government feels comfortable with this giant fiscal debt because you're not borrowing at the long end of the curve. I think we need to go to a more neutral, balanced environment with a more independent Fed that's not really facilitating this process through its own. Is it coincidence that the Fed moved to QT to phasing out QT right now in this part of the curve? They should be allowing that long bond portfolio to run off. That would be confidence inspiring for markets.
David, it's good to catch up with you, sir. I feel like we've only scratched the surface and we need to go a lot deeper on this topic. Thanks for giving us your insight. David Malpass, the former World Bank president, on a key issue. That note and that research from Nouriel and Stephen, it has had so much attention over the last week or so.
If you extrapolate it out, there's a real question, what is the consequence of higher long-term yields if you do allow them to be determined by market prices? And there was sort of this implication, maybe U.S. government officials would take the deficit more seriously if the market were determining levels. Maybe it would be more of a gut check that would actually push people to a bit more action on the policy side.
Well said.
Thanks.
Well said. Coming up next, got David sort of nodding his head as Lisa's talking as well.
Well said.
Well said. Coming up next, Victoria Fernandez of Crossmark, Sucharita Kadali of Forrester Research. We'll catch up with Giorgio Falani, the AC Milan CEO, and Sheila Kayolu of Jefferies. All of that and more in the second hour of Bloomberg Surveillance.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
A tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. The top names in business are on Bloomberg.
One of the reasons why I'm frustrated, like many Americans, about our choices for president is neither is proposing to do anything about a coming debt crisis in our country. Our debt is already as large as our economy. It's going to go nowhere but twice as big as that. We have an entitlement problem, which is these entitlement programs are going bankrupt by the end of the decade. We have to get ahead of that. Otherwise, we're going to have a debt crisis in America.
Nobody covers business like Bloomberg. Context changes everything.
The Fed doesn't want to appear panicked, particularly when the underlying breadth of data do not suggest the broader economy is falling out of bed.
We're getting a little bit too carried away with negative surprises where, in fact, we are still seeing broadly stable data.
If the labor market starts to show signs of weakness, we have to go faster.
The data right now does seem consistent with an adjustment cutting cycle. You're seeing that gradual cooling.
I think rate cuts are definitely coming. I just think that at this point, there's not a really strong case for waiting.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now, and it begins with a snapshot of your equity market. And this equity market has been all over the place over the last week. Monday was the best day of gains since June. Almost forgotten about that, haven't we? It was a nice bounce back a little bit earlier this week. And then Wednesday happened, which was like the worst day of losses so far this year. And then we added to it yesterday, even though literally 15 minutes before the close yesterday, it felt like we might finish in positive territory. Lisa, all over the place is the right way of describing this equity market.
And part of the reason why is because there just isn't necessarily a clear compass. The economic data has had ups, has had downs, hasn't necessarily been particularly consistent. And frankly, neither have corporate earnings. I mean, yesterday we were talking about Ford having its worst day going back to 2008. We're talking about American Airlines slashing their full year forecast. Today we get 3M boosting profit forecast, Colgate raising its full year organic growth models, Bristol Myers beating. It is an inconsistent and difficult picture to really wrap your head around.
People always use that word, don't they? And it frustrates us both. Idiosyncratic. Stellantis, idiosyncratic, because obviously there's this EV thing going on at the moment and they're at the wrong time, at the wrong place and all of that. Then you look at another company and you can make another excuse, Kering. Well, they've got Gucci. Gucci can't execute. And I think that's the difference for me. What is it about execution? And what is it about the US consumer right now? Where's the real struggle? Are people just not executing, or are they just struggling because the consumer's weakening?
It's a great question. And to me, the answer really lies in what does it mean to execute? Is it just simply the right types of strategies, or is it the most cost-efficient strategy? Are we talking about cost cutting? You know, Bristol Myers talked about that. McDonald's just talked about how the $5 meal is bringing more people back into the fold, and they extended that because people are much more cost conscious. When you start talking about efficiency, cost cutting. You start thinking about job cuts and other things like that. How deep does that go? And that really ultimately, I mean, people are getting sick of this, but it goes back to weakening or weak. We just aren't sure, but right now people are still coalescing around weakening, and it's healthy and planned.
Well, it's certainly weakening, without a doubt. Let's just pick out two names, two of the biggest food and beverage manufacturers on the planet, Pepsi, Nestle. Pepsi, in the US, there is clearly a consumer that is more challenged. Nestle, there is value-seeking behavior among consumers. You can't avoid this. You can't call that idiosyncratic. That's a consumer pushing back, and that's a company losing pricing power, and we've seen that repeatedly.
Take Nestle, cocoa and coffee, right? That basically cocoa beans and coffee beans, both of them have gotten more expensive. This is commodity prices increasing on their input costs, so they cannot pass it along to consumers. Cameron Dawson was talking about this yesterday, that you start to see margin compression or margin relief, as Ben Liedler would call it, at a time when inflation is coming down, that it might be good for the consumer, but it tends to be bad for corporate profit margins. Is this a company-specific problem and not necessarily an economic problem? No one's really able to get their head around that right now.
When there's enough companies having the same problem, you've got an economic issue, right? Because they're cutting costs.
And they're cutting jobs. And that is clearly what we're seeing. And the backward-looking revisions of what people are watching. How much do we not understand the real-time data, because it's going to get changed so much when we take a look at what it really was a couple months later.
You just get the feeling from a market perspective, things are so finely balanced, you're like one bad data point away from this all changing. Michael Hart of Bank of America basically said the same thing. One bad payrolls report away from changing this whole story for some of the biggest companies on the planet.
I also think a lot of people aren't really necessarily conditioned for this type of environment. We've seen huge swings, right? We saw the 2008 crash. We saw the pandemic. Everything kind of went at once. And this has been a story of many different industries that are moving at their own paces. We see services side inflation coming down. We see goods inflation coming back up, actually already having seen that trough. And all of a sudden starting to get more expensive because cocoa beans are getting more expensive, because some of these companies are saying, well, maybe we need to cater to a higher end consumer in order to be more profitable.
We can talk about the airlines later, but I was thinking about American trying to pivot, Southwest trying to pivot, at a time when maybe the high-end consumer now is starting to push back as well, based on what we've heard ex-Hermes in the luxury state of play.
Assigned seats in Southwest.
I know, it's a big change.
Have you ever actually flown Southwest?
I haven't, but I've done Ryanair.
Okay, it's basically the same thing.
At the, you know, sort of like when Ryanair peaked, late 90s, when you sort of run across, you know, early 2000s, you'd run across the tarmac to try and get a seat and elbows
Would
out.
You?
Yeah, oh yeah, then you'd have to like try and save some for the family to make sure no one else sat beside you.
Did you ever elbow someone out of the way and then have to sit next to the person
I would never get physical, Bramo.
Okay.
I would never do that.
Can you imagine?
No, that would be pretty awkward.
Really
but I'm sure that happened. You know,
all the time.
Back in the day, Ryanair was pretty brutal. I'm happy that Michael O'Leary changed things because that wasn't a nice experience. Equity futures right now on the S&P 500 look like this. We're positive by 0.7%. In the bond market, yields 4.24 on a US 10-year. The euro just about unchanged, 108.54. I want to sit in the commodity market just for a beat. 77.92, down about 0.5% in crude. And I mentioned Michael Hartnett of Bank of America a little bit earlier. Look, one person's sell-off and growth scare is another person's rotation and broadening out. And I think it's really important to sort of separate those two camps right now. And you can give each camp some fuel. And this is what Michael Hartnett's talking about. You can look at one and say, look, credit spreads are okay. They're still pretty tight. The economy's fine, and so is this market. This is just a broadening out. But when you look at commodities and look at what's happening with the yield curve, particularly the rally at the front end of the curve, you can make the argument that a growth scare is starting to emerge.
Take a look at copper prices. I mean, aside from just sort of the yield curve, the forward contracts, near term versus long term, take a look at how much copper prices have come down. Why? Is that because of some sort of normalization after an incredible boom, or are people starting to sniff out that maybe that commodity boom, that building infrastructure kind of development isn't happening as quickly as they previously thought?
We'll get some thoughts on commodities for you in just a moment. Here's the state of play for this hour. The next 55 minutes or so, we'll catch up with Victoria Fernandez of Crossmark on the great rotation, Sucharita Kodali of Forrester as the US consumer pulls back, and Sheila Kahyaoglu of Jefferies on volatility in the airline industry. We begin with our top story, the S&P 500 notching losses for the 6th time in 7 sessions as the rotation trade continues. Victoria Fernandez of Crossmark writing this: we are invested in the market market, but with a weakening labour market, higher credit card and auto delinquencies, and seasonality shifts, we could see a softer second half of the year. Victoria joins us now for more. Victoria, I want to start with the consumer. Lisa and I spent some time talking about that. There's a few companies out there saying things are weakening. Others say things are okay. What are you focused on?
Yeah, well, Jonathan, I think this is the problem that we're seeing. We don't have a consistent message coming from the earnings season telling us one way or the other so that the market can make a definitive decision on where it wants to go forward. That's what's causing some of this volatility that we're seeing in the market, especially like yesterday, up all day and then down at the end. So in our eyes, it all comes down to the labor market. You and Lisa were talking about this earlier. The labor market is key for us, and not necessarily the payrolls number. I'm looking more at the JOLTS number. I want to see those job openings. I want to see how long it's taking someone to find a job once they leave somewhere. Temporary work, we know that is a precursor to what we're going to see in the labor market as a whole. I think that U3, U6 number has kind of muddied the waters a little bit with the immigration issue. So I think focus on JOLTS, get an idea of that labor market because it flows through to everything else we're seeing. It flows through to wages. Then you have the consumer pull back, and we know the consumer is driving this economy. You get consumers pulling back, revenues pull back, margin compression, layoffs go up. It is a cycle. I talked about this with clients in Kansas City yesterday. Follow that cycle, and it tells us things are going to slow down in the second half, and we need to be ready for that.
So, Victoria, here's the question I would have for someone like you who likes financials. Why on earth would I want to own the banks going into what you've just described?
Yeah, I think we have to look at it from a technical side as well as a fundamental side. I know, Jonathan, you asked me a couple months ago, why are we sticking with financials? And look at the run-up that we have seen. It comes down to the fact that when you're going to have volatility in a market, we had the VIX up to 18, up 20% this week. You need to have companies that have strong balance sheets, good cash flows. They can handle this storm. If we're getting a re-steepening of the yield curve, which we typically get before we go into a recession or a pullback, I hate to use the word recession anymore, but as we go into a pullback, that actually will be beneficial for some of these financial companies. But we're talking the larger banks. We know Russell 2000 has done better because of some of the regional banks, but we would say stick with these larger banks with the good balance sheets. They still have people using their credit cards and paying those off. Even though delinquencies have risen, consumers are going to rely on those credit cards as well. So I think you have a couple reasons as to why in a market where a lot of elements are going down, financials still have over half of their securities in that sector over their 50-day moving average.
Victoria, you talk about diversification across sectors and across asset classes and how important that is. What does it mean to be diversified right now at a time when we've seen sort of odd correlations and a lot of the traditional sort of 60-40 aspects of portfolios haven't been reliable?
No, you're right, Lisa. And we were actually just looking at correlations in consumer discretionary this past week and how that has really fallen out of bed. You really have to be specific when you're going in and looking at names, really doing that homework, looking under the hood on the fundamentals. But for us, diversification doesn't just mean within the equity sector. You know, we've been talking about financials. We've been talking about healthcare. We've been talking about some of the staple names that have pulled back in the first part of the year as areas to go into. But we also think you need to put some money to work in that fixed income world, lock in some of those higher rates, at least for the next 18 months to 2 years, to help buffer some of the volatility in the equity market. But look, there's other elements. Generate some income in your portfolio with call options. That's one of the most liked strategies that we have at Crossmark, where we're seeing a lot of flows come in. But you can also have allocations to things like absolute return strategies. So there's a lot of elements where you can go in, build your portfolio out to really kind of buffer some of this volatility. It's not just within the equity sector.
Next week's massive. I know you know this. We've got the big tech earnings from Microsoft, Apple, Amazon, and Meta. We have, of course, the payrolls report on Friday. And then on Wednesday, the Fed meeting, as well as the Treasury financing or funding agreement, which actually could be important for duration. Absolutely. What do you think is going to be the biggest market-moving event among those?
Yeah, I think it's really hard to pick from those. But I will tell you, I'm actually going to be watching the quarterly refunding announcement. When we look earlier this year, some of the biggest spikes that we've seen in yields have come on the quarterly refunding. Obviously, the deficit is a huge issue, and people are very concerned about what's happening there. And that gives us a clue into what our interest expense is going to look like, and issuance going forward could lead to downgrades for us from some of the rating agencies. So to me, that is extremely important. We know that some of these tech names, valuations are coming down a little bit. So I don't think we'd be completely surprised if we see earnings just hit expectations, maybe not go further, and guidance come down. I think we know the Fed is using this meeting as a setup for September. So to me, actually that quarterly refunding, I think, could be key.
Victoria, do you share this view that the Treasury is deliberately manipulating the shape of the yield curve by issuing more at the front end of the curve?
Yeah, I was listening to your conversation with David Malpass, and I'm not sure if they're trying to deliberately change the shape of the yield curve, but I do think they're trying to go in and figure out a way to reduce interest expense going forward. If they can issue more T-bills in doing that, which we've seen in previous refunding announcements, then I think that benefits them. So I'm not sure if it's an intentional yield curve movement. I do think it's intentional to try to reduce interest expense, again, leading to the idea that we could get downgraded if that continues to go higher.
Victoria, appreciate your view going into next week. Victoria Fernandez across Mark. Lisa went through a range of stories to look ahead to next week, including payrolls. Payrolls, the estimate in our survey. Sneak peek for you, Lisa. 175 is the median estimate in our survey so far.
How low is the bar for the market to change its narrative, or how high? I mean, this is sort of going to be the key question. It's not just the actual number. I still think that the revisions are becoming increasingly important as they pretty consistently downgrade the view from the month before.
Household versus establishment, still playing that game. Unemployment, by the way, the estimate in our survey, we're looking for that to stay at 4.1%. Let's give an update on stories elsewhere this morning with your Bloomberg brief. We can cross over to Danny Berger. Hey, Danny.
Hey, John. The world's biggest eyewear maker, EssilorLuxottica, says Meta is planning to buy a stake. The investment would see Meta push into virtual and augmented reality for smart glasses after years of the two companies working together. Luxottica's CEO made the comments late Thursday after weeks of speculation about the U.S. tech giant's plans. He added that if Meta decides to invest, it would have to buy shares on the market, declining to elaborate on the size or timing of that stake. And a top candidate to succeed Boeing CEO Dave Calhoun at the end of the year has emerged. Stephanie Pope, who runs Boeing's commercial airline unit, made the rounds at Farnborough International Air Show as the plane maker's highest-ranking official in attendance. Pope was promoted to chief operating officer late last year, making her the heir apparent, and Calhoun has publicly endorsed her as his natural successor. Vice President Kamala Harris has officially joined TikTok. Since she began her presidential campaign 4 days ago, TikTok and other social media platforms have seen a groundswell of viral memes, images, and videos featuring the presumptive Democratic presidential nominee. More than 95% of left-leaning TikTok posts about Harris currently have a positive sentiment towards her, according to Credito IQ, a social media analytics firm. Harris has more than 1.3 million followers. Former President Donald Trump, who has been on TikTok since June, has 9.2 million followers. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Nobody's dealing with that platform anytime soon. Just on fundraising, love this story. We'll touch on it more a little bit later, but I want to give you some numbers. So there is a cryptocurrency industry event taking place in Nashville tomorrow. There will be a private fundraising effort for Donald Trump, including asking prices. Get ready for this. If you live outside of America and you're not familiar with the fundraising efforts, this will blow your mind. The asking price of $844,600 for a seat at a round table. If you want the opportunity for a photo with the presidential candidate, $60,000 per person. And Lisa, if you want for $100,000 per couple, so if you want a photo for two people, you and your other half, $100,000.
Some people would say, why would anyone do this? And then we hear about how, Elon Musk and some of his decisions to donate to Donald Trump would actually put him in a better position should Donald Trump be president, even if his policies seem like they are against his business. There is this sense that the more you have some familiarity with the potential future president, the better for you.
According to an invitation to the event, if you've got that kind of money. It's like $1 Bitcoin, apparently, in our story, $1 Bitcoin for a photo with the former president. Up next, the consumer pulling back.
There's a weakening in the U.S. consumer. Consumers are spending, right? But they're not spending as much as they used to. So I think it's a slowdown story versus a recessionary consumer spending print.
That conversation up next. Live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. The top names in global leadership are on Bloomberg.
I envisage not only some kind of a bridge towards membership or language linked to the irreversibility of Ukraine's membership in NATO, but also
the dollar yen rises as much as 0.51% to a session high of 154.735.
Right now, the sooner the war will end.
Nobody covers the top global leaders like Bloomberg Television and Radio.
Who said summers were quiet? I don't remember the last quiet summer.
We're talking about the data not being as accurate during this time of year, an election that's haywire.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Is the answer here, Jeff, that everything is just plain solid?
It's pretty solid, Tom.
At some point, we got to call it a soft landing.
Tune in to Bloomberg Surveillance, The Fed Decides, starting at 1:30 p.m. Eastern.
Counting you down to the opening bell, attempting to get you to the weekend. Equity futures look like this. About 2 hours away from that open. We're up by 0.75% on the S&P 500. In the bond market, yields just about unchanged. The 10-year not doing much. 423.67. A bit of quiet. A welcome bit of quiet, I have to say. Under surveillance this morning, the consumer pulling back.
There's a weakening in the U.S. consumer. Consumers are spending, right? But they're not spending as much as they used to. If you look at credit card spending data, for example, if it was up 7 or 8% year over year, now it's maybe 3 to 5%, depending on what kind of a consumer you look at. So I think it's a slowdown story versus a recessionary consumer spending print.
Things are cooling. They're not cool. How many different versions have we heard of that over the last couple of weeks? That was from Michael Gapin of Bank of America. Here's the latest: consumers pulling back from post-pandemic revenge spending, and it's starting to hit the top and bottom lines of companies, from food producers to airlines and luxury retailers. Sucharita Godalia Forrester writing this: many consumer-facing retailers, Nike, Target and others, aren't doing particularly well. I don't know that that is economy related, but rather execution related. Sucharita joins us now for more. Sucharita, that is a really important distinction. And we asked this at the top of the program. There's an execution issue, then there's a consumption issue. Which one is which right now for many of these companies?
Well, in the case of some companies, like Nike's a good example, where the category may be doing okay. Their competitor, for instance, at this point in time, Adidas, seems to be having more traction. That suggests that the consumer isn't necessarily pulling back from the category altogether or the subcategory in their case. And that issue is more related to perhaps their product assortment and some of their innovation levels. Now, from an overall consumption level, what we are seeing is that the numbers are softer than they were during the pandemic. But we have to also keep in mind that the pandemic, the economy experienced some of the highest levels of spending that we had ever seen. And that was even inflation adjusted. And then we had inflation coming on the heels of the pandemic, which ate into the real spending, but the consumer was still spending more. And now, finally, I think what we are seeing is a leveling and the consumer spending not more than the inflation level. And that's where we're seeing perhaps some softness in some of these discretionary categories, as well as some essentials too, like grocery.
Essentially, you're just saying don't confuse the process of normalization with something bad, something sinister. Is that a fair assessment?
I think that that is a fair assessment. And the truth is that it's not like we have seen spending fall off a cliff. And that's important. We had record levels of consumption fueled by, of course, stimulus payments, as well as the market doing very well. So the consumer was in a really, really good place over the last few years. And it would have to be something pretty catastrophic for spending to fall off a cliff at this point.
Sucharita, can you give us a sense of history and where this it might be that we're looking at? You pointed to Walmart, Costco, and Amazon doing well at a time where consumers are increasingly cost conscious. Yes, they are executing well. Yes, they've got economies of scale that allow them to execute well. But how much does this indicate a shift in consumer spending that gives a hint of what's to come? Maybe not falling off a cliff, but maybe a sense of where we are in the deterioration of the consumer appetite.
Well, the thing that is difficult when you look at a Walmart spend or even Costco spend is that those are businesses that do well regardless of the economy. They do particularly well when the economy is doing poorly, but they do well even when the economy is doing well because the consumer is spending more and they're going to be beneficiaries of just mass merchandise spend. So it's difficult to say right now, looking at those companies, whether that is because the consumer is feeling more nervous and cautious. Certainly, all of the consumer confidence figures are a little wacky. And this is where we have the Vibecession thesis that the consumer's feeling worse than the macroeconomic indicators are suggesting. We have to also remember that wages are still relatively high. Unemployment is low. GDP growth, we just had the GDP numbers for so far yesterday, and those were really higher than what the expectations were. So the economy overall is doing well. These inflation numbers seem to be weighing down on consumer confidence, and that's why you see some of the softening that we're seeing.
Just quickly, do we still see just as wide of a divergence from upper income families and their spending versus lower income families?
That's definitely one of the theses out there. Some of the softening is that it's happening at the lower end for sure. The lower end consumer is the one that not only is going to be more likely to have to resume loan payments, and they're the ones that are going to have the higher interest rates from credit card debt that they're going to have to cope with. But and certainly the upper income consumer is the consumer that is more likely to be a beneficiary of some of the stronger stock market performance of the last year. But at the same time, that upper income consumer isn't seemingly purchasing those luxury goods. Every luxury brand, which is a public company, has reported softening in sales, although arguably that could be because of the China consumer, less so because of the U.S. consumer.
Interesting. Sucharita, thank you. Sucharita Kodali there of Forrester. That's the important one, the important development for me. It's how much of the spending that's helped prop up this economy is starting to break down as well.
Yeah, that's the reason why maybe we're seeing airlines in particular not being able to win out with just some of the top-tier seats.
Coming up on the programme, a somewhat self-indulgent conversation with the AC Milan CEO.
Somewhat.
It's market focused, Bramwell.
It is. I've got lots of questions.
About the Russell and small caps and all of that good stuff.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
What we try to do is combine some of our insights from the fundamental business with external and data set signals. And I think that's a lot of times where the opportunity is.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure. Don't miss Bloomberg's interview with the
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. The top names in business are on Bloomberg.
What I can say is that we've been making significant investments across the franchise, across regulatory reporting, across data, and across resolution and recovery planning. These are areas we've been investing in because we know they're areas that, frankly, the industry likely needs to further enhance, and we certainly want to enhance them for ourselves.
Nobody covers business like Bloomberg. Context changes everything.
Let's start with the price action. 2 hours away from that opening bell. Equity futures pulling back by 0.75%, or rather pushing higher by 0.75%. On the NASDAQ 100 up by 1 full percentage point. And once again, the outperformance on the small caps, the Russell 2000 up by 1.5%. I mentioned this stat earlier this morning, and if you missed it, it's worth repeating again. It comes from Jim Reed at Deutsche Bank. The Mag 7 down nearly 13% since a record high on July 10th. Since then, the small cap Russell 2000 has outperformed by a remarkable 24 percentage points over the period. And the outperformance, Lisa, continues this morning.
So that's the reason why, and I think you framed this perfectly earlier this morning when you said, ultimately, is this the beginning of a true correction, or is this a wonderful rotation that people have been looking for on the heels of economic strength? It's hard to really understand which. You can make a strong argument for either one.
Most people on Wall Street at the moment, I think, sort of like taking a tally of people on this program, they're saying rotation and broadening out, aren't they? I'm getting many people saying growth scare, with the exception of the economists who run this program saying they need to cut interest rates at the Federal Reserve, and they need to do so fast.
Former New York Fed President Bill Dudley among them, coming out and saying from the data that he has seen, they're at an increasing risk of being too late. This is really the key question. How do stocks respond to downside surprises? It seems like we have been in Goldilocks for long enough that if the Fed is prompted to cut because of weakening data, that'll be a problem for risk assets.
Let's turn to the bond market. In Treasuries at the moment, just about unchanged on a 2-year, 10-year and 30-year yield. The 2-year at about 442.86, the 10-year at 423. If you switch at the board, turn the page and get to the foreign exchange market, looking ahead to next week, not just a Federal Reserve decision, but also the BOJ with dollar yen at 154.65. I mentioned the range on dollar yen. Through the week, we've had a 157 handle. That, I believe, was on Monday, Lisa, and we've had a 151 handle, which was the low of yesterday's session. That, for a currency pair like dollar yen, is a pretty wide range.
This used to be a haven bid. This used to be sort of the safe kind of place to go. And suddenly, again, it's trading as though we're an emerging markets currency. A lot of people wondering how much is technical unwinding of popular trades that we've seen in a number of different asset classes, and how much is hinged on this belief the Bank of Japan will raise rates next week. How much could it get reversed if the Bank of Japan does not make a move in next week's meeting?
Jeremy Stretch making that point, saying that this one could whip back in the other direction pretty viciously. That's foreign exchange for you. Under surveillance this morning, some top stories. A new Times Siena poll finding Donald Trump leading Kamala Harris 48% to 47% among likely voters. That's a marked improvement for Democrats when compared to the post-debate poll in early July that showed President Biden behind by 6 percentage points. So there has certainly been a bump in the last few days.
Yeah, although Libby Cantrell says we should just get a cocktail, go to the beach, come back in September, and then we could take a look at the polls. This aspect of it, that nearly 90% of voters said that they approved of Mr. Biden's decision to exit the race, was shocking to me. When have you been able to get Americans to agree, 90% of them, on absolutely anything? To me, this sort of highlights how, in some ways, the bump is coming from relief, just that there is a different race than that everybody thought that there would be earlier.
I heard someone describe this situation, you know, when a CEO leaves a company and the stock rallies and you always feel bad for the CEO. It has nothing to do with the new CEO. It's just like the old CEO's left and there's a relief rally. That's kind of the polls for the Democrats right now.
Yeah, people looked at the age. It was under 70, and they were very excited.
Yes, by apparently something like that. Let's get to the data. PCE and personal income and spending data due out in less than an hour. The last key data points going into the Federal Reserve decision next Wednesday. Economists surveyed by Bloomberg expecting both spending and income to grow at a solid clip, even as core PCE inflation slows to near the Fed's 2% target. That drops at about 8:30 Eastern time. And the Olympics kicking off today in Paris. Train services in France facing disruptions by what authorities have called a coordinated sabotage effort. Just hours before the inauguration ceremony, the head of the National Rail Company, SNCF, saying many trains have to be cancelled and about 800,000 passengers will be affected. This sounds like a nightmare in Paris today.
On so many levels, officials are saying this is less an attack on the Olympic ceremonies and more on just the French people who are all trying to go away from Paris to go on vacation. That there is sort of this feeling that this is a time when people tend to go away. Either way, it sort of raises the specter of how do they maintain security and order at a time where this is supposed to be the first actually regular Olympics. I mean, think about these athletes that previously were in Tokyo during the pandemic, swabbing and being isolated in little rooms. And yeah, a very difficult experience. This was supposed to be sort of the comeback games.
I don't know about you, but I've got absolutely no interest in going to Paris while this is on.
I would like to see, you know, judo and table tennis.
Yeah, okay. We can go to that. We'll get some tickets. We'll drop in and drop out. Let's stick with sports. AC Milan meeting English Premier League club Manchester City in a pre-season friendly at Yankee Stadium tomorrow afternoon. It's the latest push into the United States by the Italian football giants, a market they've seen significant growth in since being bought by New York private equity firm Redbird Capital back in 2022. I'm pleased to say that joining us now to discuss is the AC Milan CEO, Giorgio Ferlani. Giorgio, let's talk about this move. We've seen these friendlies before, AC Milan on tour, playing other teams from the Premier League and elsewhere. It feels like we're getting closer to playing a regular season game in the United States of America. Giorgio, is that true? How close are we to an event like that taking place?
Good morning. Thanks for having me. You're right. We do these tours in the summer regularly to play friendlies against other top teams. Look, there's regulatory challenges in moving abroad and into a different market, domestic league games. But we certainly think if you really want to develop a fan base and you really want to expand your business in the U.S., this would be a critical part. So we will be working with Serie A, our league, and the other regulatory bodies to allow us to.
You've mentioned the bodies you need to work with. Can you just build on that, the obstacles for something like that to take place? Have you had a meeting with Serie A, the regulatory bodies, about this already? Have you taken steps to kind of push this forward? How close are we to something like this?
We certainly have discussed it with Serie A. It then needs to be discussed also with UEFA and with FIFA. And the authorities here in the U.S. There have been attempts in the not-so-distant past to play games. La Liga tried to, but it didn't work out. So we'll keep on pushing. It is absolutely important, just in the same way that American leagues have expanded globally by playing regular season games, not just friendlies outside of America. We need to do the same the other way around.
Giorgio, I've got to say, we just saw basically a mini World Cup. We saw the Euros. We saw also Copa America taking place at the same time. Pretty much everyone who I knew on the weekends was watching some of the games as they really got into it. The enthusiasm, though, in the United States for games that were held here was surprisingly not very strong. We didn't hear that much about games that were happening nearby. Have you been disappointed by how some of these games have rolled out at a time when there certainly is more interest, but maybe not in the way that there is in many of the other markets around the world?
Look, I think the ultimate test will be the World Cup in 2026, which will be and you know, that is really the top content together with top games of European continental leagues. And
Giorgio, I think that we're having some trouble with the sound. Let's just try to reestablish that, then we'll get you back real quick so that we can make sure that we understand everything. But this has actually been part of the issue, John, that people have been talking about, which is essentially we've had these games in the U.S. and we're preparing for the World Cup at a time where Copa America wasn't very well kind of advertised in a sort of significant way. And it raises this question, how the U.S. hosts the most important games for the majority of the world in a country that emphasizes other sports.
These clubs have been trying to pivot to the United States for a long, long time. It's amazing to me that the world's #1 sport is football. But if you look at the most valuable franchises on the planet in sport, a lot of them in the top 10 are American sporting franchises, American football, baseball, etc. There's a lot of money here, which is why they want to be here. If you look at the sort of evolution of what Milan have been doing, they're also investing in US talent. So they have the premier soccer star, which is Pulisic, on the roster now. Not a single AC Milan player was in that Italian national team at the Euros this summer. They've invested far more on the US side of things than maybe they have in Italian youth, and we can get Giorgio's opinion on that if we can re-establish the connection, because I'm sure he's got strong thoughts about it. But that might be a criticism of some of the moves that they have made over the last few years.
One of their top players is a United States player, which creates this issue. How do you maintain the kind of enthusiasm that some people, even if they're growing up in England but have relatives that are in Italy, can still have if you don't have sort of a homegrown base?
Giorgio, let's come back to you. I'm happy to say that if you are just joining, we are still with the AC Milan CEO, Giorgio Frulani. Giorgio, I know there was a little bit of a technical connection, but I want to come back to some of the comments we were having around the table. It feels like AC Milan has become more American in the last year or so, and maybe less Italian. The very fact that there wasn't a single AC Milan player on the Italian roster at the Euros this summer, is that a financial decision or a sporting decision?
Very good question. We've definitely become more American. We're owned by an American firm, which is Redbird Capital Partner, which is a leading investor in sports media and entertainment, and we work very closely with them. We've also become more American on the field. So we have, I think you were saying, 2 American players. Our decisions on who to field are entirely sporting. So there isn't a decision on the base of, what passport a player has, but it's about how good the player is. Obviously, some players, just by nature of being American, in our case, we have 2 players, including Christian Pulisic, have a certain commercial appeal in the U.S., which is certainly helpful. But we don't drive sporting decisions by passport list.
We were talking, Giorgio, about how the United States is a really expensive market, that there's a lot of money here. And so that's one reason why a lot of people want to come here, is because there are dollars and a lot of eyeballs to come. There are also a lot of dollars coming from the Middle East, and you're going to be facing off with Man City. Giorgio, how open are you to tapping the seemingly endless appetite in the Middle East to own clubs in Europe?
So we tap in the Middle East in a different way, which is on the commercial side. So we've opened an office in Dubai. We're the first European football club to open an office in Dubai. We've had a long-standing 15-plus-year relationship with Emirates, the airline. We have other commercial partners in the region, including the Kerzner Group. And so the way we've gone about it is not sort of via, let's say, equity injections, but rather via commercial partnerships.
Giorgio, I just want to squeeze in one final question, and I'll ask this as an AC Milan fan, a lifelong fan like yourself. We both remember the AC Milan of Capello and Sacchi, of Baresi and Maldini. We've both been disappointed with the performance of the team over the last 20 years and the trajectory that we've been on. I remember when the club became a selling club, and I identified that summer when we sold Ibra and we sold Thiago Silva to Paris Saint-Germain. It felt like that was a moment where AC Milan became a club that needed to sell players and couldn't buy that talent anymore. This summer, we've got 2 big players, the left-back Theo Hernandez, and we've got the goalkeeper, Mike Maignan. I want to understand whether that's 2 talents that you need to monetize to fund the rest of the project, or whether AC Milan is back in a position where it can keep world-class talent. Just what is the state of play?
Yeah, so look, on the sporting side, our ambition is to fight for the title in Italy every year and to be competitive in the Champions League. Now, we we do this while on the, let's say, other side, running a business that is sustainable. So to give you some facts, 2 years ago was the first year in which AC Milan was profitable, first year in 17 years. And last year was the second year. And I don't think it's ever happened to AC Milan to be profitable in 2 consecutive years. What that translates into is we're not forced to sell players because of capital shortage or cash flow issues. So, picking one word, you say we don't need to sell anyone. So as a fan, I'm telling you, you shouldn't be worried about that.
Well, as a fan, it's good to hear. Giorgio, good luck tomorrow, and hopefully we can catch up soon. Giorgio Fulani there, the AC Milan CEO. Let's turn to some stories elsewhere for you this morning with your Bloomberg Brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. Starting with some earnings, Bristol-Myers Squibb jumping in the pre-market trade by nearly 5%. It raised its 2024 profit forecast thanks to demand for its new medicines. Now, there had been questions about future growth of Bristol. Its key drugs face stiff competition and new pricing pressures, but all of its biggest medicines beat sales expectations, while the company said its cost-cutting initiative is starting to pay off. Just over 100 days to go until the election, and a September 10th debate is still on the schedule, but Trump isn't committing just yet. Trump's campaign says it would be inappropriate to commit to the debate until Democrats formally nominate a new candidate. Trump also said he wanted an organization other than ABC News to moderate it. Democrats are poised to virtually nominate Harris and her yet-to-be-named running mate by August 7th. The vice president said yesterday she was ready to debate Donald Trump and accused him of backpedaling from an agreement. SpaceX's Falcon 9 is cleared for takeoff. The uncrewed rocket won approval from U.S. air safety regulators to return to space. On July 11th, a mid-flight failure had grounded the world's most frequently launched rocket. The company, led by Elon Musk, aims to launch as many as 148 flights this year within its Falcon rocket family. SpaceX says it is ready to return to flight as soon as tomorrow. That's your brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes. Up next on the program, a turbulent summer travel season.
We've seen this theme of transportation stocks missing, whether it's airlines, American Airlines. To us, that flies in the face of this recent rotation into small caps and risk-taking.
That conversation up next, live from New York. You're watching Bloomberg Surveillance.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
DOJ or other authorities.
Could face bigger challenges.
Britain's next.
It was going to keep rain World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Equities look like this on the S&P 500, firmer by 0.8%. We're picking up here. Elsewhere, the outperformance on the small caps once again this morning going into the opening bell. In the bond market, yields just about unchanged. The 10-year 423.48. Under surveillance this morning, a turbulent summer travel season.
We've seen this theme of transportation stocks missing, whether it's airlines, American Airlines, Ford today, Tesla recently, and even UPS. So companies with heavy cyclical exposure to the economy have been disappointing. And to us, that flies in the face of this recent rotation into small caps and risk taking.
So here's the latest. It's been super difficult for the airlines. American Airlines reporting disappointing earnings, slashing its profit outlook after overestimating demand for domestic travel. This as Delta returns to normal operations following last Friday's global tech outage that led to thousands of cancelled flights. Joining us to discuss this industry, Sheila Kahulu of Jefferies. Sheila, it's good to see you.
Thank you for having me.
Where do you want to start? Delta come out and say things aren't great. And then United come out and say the same things. And I'm thinking, well, we're going into American now. Surely we've lowered the bar enough and the market's looking for this. And then American come out and say things are pretty bad and the stock craters. Have we not lowered the bar enough for these airlines still?
It keeps getting worse. Air France pre-announced negatively yesterday on the Paris Olympics impact. Air Canada, Lufthansa cut EBIT by 50%. So it keeps getting worse, especially in the Atlantic yields. There's more competition, and that's what's been holding up on the international side. But American and Southwest really have both had strategic missteps. American realigned its corporate strategy, and it decided to go direct, and it really missed out on revenue points. So they're going back into that, adding sales force, which they've cut over the last 2 years. Southwest is Southwest, so they've had some strategic issues. And what they're doing, yesterday they said they're going to add premium seats. So instead of an aircraft with 175 seats, they're going to go to 160, which is like the Delta and United average, add extra rows of legroom, and change their onboarding strategy a bit.
It's Southwest welcome to the 2020s, like 4 years late.
Yeah.
What do you make of the timing of these executions from both American and Southwest?
I think they're realizing they're losing out on market share, and their yields are worse than everybody else, so something's got to give. It's just a matter of how quickly can they do it. I think American can do it faster. You know, as a corporate booker, I don't know how quickly, I don't know where Jefferies is booking, you know, my American Airlines flight to Heathrow at this week. So I think it's easier to regain that. Southwest is really shifting its strategy with assigned seats. And don't forget, they make about $1 billion of revenue out of their $24 billion of revenue from early board booking. So they could lose that revenue. So it's unclear how quickly Southwest could actually take share back.
So this is totally off script, but you mentioned Air France, and you talked about how the bookings have actually gone down because of the Olympics. I don't get this. They're not the first to say this. We've talked to others who also say that actually travel is going down because of the Olympics. Isn't it supposed to be the opposite? Isn't
That's what I thought too.
Of cities becoming the host cities for Olympics, being that it increases traffic?
Yeah, and Ed Bastian at Delta told us otherwise. Delta has a Paris hub, so that's why it's more impacted than everybody else. But apparently no one's going to Paris this summer, and even if they are, they're not doing multi-leg flights. So they called out about $100 million in impact. Air France called out a bigger impact. I think it's a one-time thing we could look through, but yeah, I would assume the opposite as well.
There's a question right now, not just about execution and profitability of some of these airlines, but also how do they maintain morale at a time when there are some snafus? We're talking about Delta and the issue around CrowdStrike and the fact that some of the employees didn't really feel like they knew who to call. Now, United Air is requiring a doctor's note to call out sick for pilots, and that's now being reviewed by federal officials. I'm just wondering, is that a problem at a time where execution kind of depends on these people?
No, just listen to an airline earnings call. They sound great. You know, peak revenue, all-time high revenues. You wouldn't know anything is wrong with an airline by listening to an airline earnings call. Things sound absolutely lovely. You know, revenues are at all-time highs. It's just
Where's the disconnect here?
I think that's, you know, you have to look at profitability and what profitability looks like, what cash levels look like. American and Southwest are draining their cash balances. American won't be able to delever. Southwest keeps buying more planes. But I think, you know, in any industry, airlines, pilots are you know, have a great morale, so the flight attendants, and they also have contracts that they just put into place. So most of the airlines have their contracts in place. American has another cost headwind coming up. It's going to look to ratify its flight attendant contract, so that's going to be a headwind for the second half of this year and into 25.
You really don't sound impressed with the way that Southwest is run. Is that fair to say?
I think running an airline is an extremely hard job because you book and ship right away. Prices swing 10%, and your 1 point of price is 10% of EBITDA. So you could really mess up an airline very, very quickly. So I don't envy those who have to run an airline.
You have sympathy with them, but is there something about they're running their business versus, say, Delta is, that means they're performing this poorly?
I think if you focus on premium, it's a more steady base, and you have that pricing cushion. So, any mistake in the domestic markets, if you put too much capacity, you're making up for it in your international side where you have 20% operating margins. So I think that's where they have a little bit of cushion with Delta and United. And they're just bigger. They have brand loyalty. They have the credit card. They have their Delta Tech Ops, so that's their maintenance business, that if they spun that off, that would probably be worth $10 to $15 billion. So they have a lot of, that just tells you what Delta is worth. If you strip away Sky Miles, you put it at a Visa multiple, and you looked at their Delta Tech Ops business, it would mean Delta Airlines as an airline is not worth anything.
Lisa's asked this question a million times. They sound like credit card companies now. Why don't they just say that they are credit companies?
They try.
Wouldn't they be better off?
I think they're really pitching that, and you saw that with United. It took out the leverage that was associated with its credit card business to essentially unencumber the asset. Granted, it was an 11%, note, so it was saving them a lot of interest to put away that debt, retire that debt, but still.
From a broader perspective, just sort of zooming out, we were speaking with Sutrita earlier of Forrester Research, and she was saying that on the margins, you are seeing some pushback by even the higher-end consumers. Maybe this has to do with China, LVMH. We saw Gucci, really underperforming. Are we seeing the same kind of spending patterns at the highest end of the cabin, which really had been sort of the mainstay for profitability for a lot of these companies?
I think that's what everybody's worried about with airlines, right? They're not giving them the credit for the premium offering, and we cover the biz jet manufacturers, Textron and Gulfstream. They both reported book-to-bills of 1.0, but you didn't see an acceleration in orders for the biz jets. So is that hitting the high end? You're seeing flight utilization for business jets up versus 2019 levels, 20%, but year over year they were down 1%. So is this kind of a leveling out of even the high end, which the consumer brands would tell you it is?
Sheila, you've been busy, that's for sure, over the last week. Sheila Kohli there of Jefferies. Think about the changes we've seen in the last week. American, another disappointment. Southwest, a change in policy. Delta, struggling to recover from the issues that we were talking about on this show a week ago.
You asked the right question about Southwest. What took them so long? I mean, at a certain point, I understand it's the culture, and I'm sure that they're getting a lot of backlash from people saying, come on, now you're going to join everybody trying to bifurcate people according to how much they're willing to spend. And Southwest would say, yeah, because we need to make money. And guess what? That's how people do it.
Still the most confusing one for me out of all the airlines in the States. You know which one I'm going to name? JetBlue. I don't understand JetBlue. They have got a serious branding problem. If you go on a JetBlue flight, the customer service is absolutely phenomenal. You and I both shared a flight, transatlantic to London, fantastic flight, flew business with work, thank you, with work, and it was fantastic. It was brilliant. It was up there with the likes of Delta, with the likes of American, and I just don't feel like that they market that well enough in any way, shape, or form.
Because they want to cater to families. Look at their routes, going down to Florida, going down to the islands. That's sort of, you go and people put on hats and they're with their families. They're excited. It sounds really nice.
But they sound budget when they're not. Do you know what I mean? They're sort of like,
It's like big box stores trying to look cheap.
Yeah, I don't. Anyway, coming up, less on JetBlue. Less on AC Milan even. Up next on the programme, Sam Stilwell of CFRA.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, They make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
A tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
The more that you learn about this case, the more it reads like a Hollywood script. The nature of the killings, the execution, the just brutality of it.
It wasn't in the psyche of people that they could be looted because they are considered so sacred.
And we did it the way you do every single investigation. How do you eat an elephant? One bite at a time.
It jumped off the page at me that you could see that there was a Ponzi scheme taking place.
I started hearing mafia, mafia, mafia.
Il sistema è perfetto. Sono gli uomini che spesso non lo sono.
These are the holders of truth and justice. They cannot be possibly be doing this. But then they are. They are. And the evidence is there. It's overwhelming.
The top names in business are on Bloomberg.
One of the reasons why I'm frustrated, like many Americans, about our choices for president is neither is proposing to do anything about a coming debt crisis in our country. Our debt is already as large as our economy. It's going to go nowhere but twice as big as that. We have an entitlement problem, which is these entitlement programs are going bankrupt by the end of the decade. We have to get ahead of that. Otherwise, we're going to have a debt crisis in America.
Nobody covers business like Bloomberg. Context changes everything.
Throughout this earnings season, there is absolutely zero tolerance for anything that even smells of weakness.
Those mega cap techs have unbelievable return on equity. But nonetheless, trees don't grow to the sky. These things can revert really quickly.
You have lofty expectations, you have lofty valuations, investors will continue this unwind trade.
The concerns are valid. I do think there's frothiness in parts of the ecosystem.
The earnings season so far has still been really, really solid, and that speaks for other sectors really to participate as well.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
90 minutes away from the opening bell and about 30 minutes away from some economic data in America. Let's turn to the price action. Equity futures on the S&P 500 firmer by 0.9%. The NASDAQ bouncing back by a little more than 1 full percentage point. And the Russell of small caps flying once again, outperforming. We're higher by 1.7%. The only question that matters around this table at the moment, what is the state of the US consumer? Andrew Honhorst of Citi saying this: continued solid consumption will depend on the labour market. And we're all looking ahead to that payrolls report next Friday. This is what him and the team are looking for. 150K on payrolls, but they're looking for the unemployment rate, Lisa, to climb back up to 4.2%.
Potentially triggering the SOM rule, which we heard from Bill Dudley is one of the key reasons why he feels like there is renewed urgency for the Federal Reserve to cut rates, even though Claudia Sahm herself has said it's just, one benchmark. You shouldn't really take it as necessarily gospel. I will say, even heading before the jobs report, we get personal income and spending in about a half hour. And really, I feel like we got to bring back toxic brew, because it feels like with thin liquidity and this idea of, uncertainty around the trajectory of the economy, one bad print one way or another could really cause a pretty disproportionate response.
It's been a while since we talked about toxic brew.
I think it's time to start, reflecting on it.
Let's talk about what's in the brew. What's in the brew right now?
We've got a situation with earnings that are inconsistent across the board, some winning, some losing. Maybe it's execution, maybe it's consumers pushing back a little bit more. You have unemployment rate that's creeping higher, albeit at a normalizing pace. We have claims that are inconsistent, but still just nudging up. And then you have this situation where if you look at financial conditions, they are tightening. They're at some of the tightest paces just based on the recent sell-off so far this year, but still companies are able to borrow. Capital markets are open and credit spreads are tight. This is a potentially confusing brew that could easily turn into a toxic brew with potentially certain negative prints.
It makes it really difficult to answer the question that we asked 3 times to 3 different guests yesterday. Is it a rotation, a broadening out, or a growth scare? And when you point to credit spreads and say they're tight, that says things are okay. That supports the idea this is just a rally that's broadening out away from big tech. When you see what's developing in rates markets at the front end of the curve, that rally off the back of the prospect of maybe getting some bad data at some point in our future, didn't get it yesterday, maybe on Friday, you start to wonder if it's a growth scare. And that's going to be the debate we have right the way through the summer into Jackson Hole, regardless of what the Fed says next week.
And here's the rub. We don't really have the answer. I mean, even Michael Hartnett, who has had a bearish tilt for quite a while, has basically said we're one bad data print away from big tech, leading the whole index lower. When people talk about short term, a lot of people say that there could potentially be momentum in some of the sell-off, albeit it won't necessarily be a lasting sort of situation. Key thing is people don't have visibility. So how do you have conviction? How do you have anything other than tactical at a time where there's very little visibility?
We haven't talked about toxic brew for a long, long time. Throwback.
I know. I think it's not quite toxic, but I think that it's definitely a brew. It's not,
all of that.
Yeah, I think it's
toxic brew, tank chasers. As for the tank chasers, by the way, TK joining us on the Fed show next Wednesday afternoon. So look out for that. Sort of reunited for one special edition of the Federal Reserve decision and then back again together for the Jackson Hole meeting at the end of August. Let's get to this. Let's get to the price action. In the equity market right now on the S&P 500, firmer by 0.8 to 0.9, call it 0.85 on the S&P. In the bond market, the 10-year 423.87. In foreign exchange, the euro just a little bit stronger, 108.62. Coming up this hour, we'll catch up with Sam Stovall of CFRA as the equity bull market hits a bit of a wall. Republican Senator Bill Hagerty as D.C. tries to predict a Trump 2.0 cabinet. And Mark Zandi of Moody's Analytics on why too high for too long is starting to crack the U.S. economy. We begin with the big issue, the tech-led rout pausing as investors await PCE data out in just under 30 minutes' time. Last week's rotation continuing as investors confront disappointing earnings. Sam Stovall of CFRA has this to say. The lofty initial expectations for second quarter earnings growth have caused some mega cap high flyers to fail to clear this elevated bar, causing investors to wonder if other mega cap disappointments should be anticipated. Sam joins us now for more. So Sam, let's get to the calendar. Let's go through next week. Microsoft, Amazon, Meta, Apple. Do you think we're set up for some disappointment here?
Hey, Jonathan. Well, certainly next week, 40% of the cap weighting of the S&P 500 tech sector will be reporting earnings. Even though expectations are that we've seen a better movement in earnings for the technology sector now at about 17%, up from 16% and change, I think, yeah, investors will definitely be paying a lot of attention to what is said and implied with these upcoming earnings. The chip companies typically do have some challenges when it comes to third quarter areas, and our feeling is that, while there could be some stumbling, we are maintaining our overweight recommendation on tech, mainly because companies will soon be looking at 2026 estimates and pretty much ignoring what they are hearing right now in 2024.
Sam, let's take the earnings so far this week. Let's pick out one name. Let's talk about the likes of Alphabet, and we can think about how the way the market responded to what Alphabet had to say. Based on that, what are investors in the mood to reward, and what are investors in the mood to punish? And I think that's something really interesting that we've got to try and answer in anticipation of the earnings next week, because it felt like investors were in the mood to punish excess investment out of Alphabet, whatever you would call excess. I want to understand how that might set us up for next week, Sam. How do you think about that?
Well, I think what that implies is that investors are really only looking short term, because the investment that Alphabet was making is obviously for 2025, 2026, which is the cause for our optimism longer term. But in the near term, investors are basically saying that recently we had tech selling at a 78% premium to its average 20-year PE ratio, the market itself at a 38% premium, and the relative strength between the cap-weighted tech and equal-weighted tech sectors were back to where we were during the dot-com bubble. So I think that investors are saying if there's any hint of disappointment, I'd rather sell first and ask questions later.
Sam, I guess another way of putting this together is how low is the bar right now heading into next week for some of these earnings? After the sell-off we've seen, a true correction down about 13% since the July 10th record highs that we saw in the Magnificent Seven stocks. How much do you anticipate that any additional disappointment or even just not superlative type of results will provoke some pretty significant selling in addition to what we've already seen?
Well, I'm looking at history. I would tend to say that we are due for a double-digit decline in the order of 10 to 13%, primarily because of the advance that we experienced in the first quarter, as well as for the first half, and as I had mentioned in terms of the valuations. However, I do think it'll be contained to a correction, not the beginning of a new bear market, and would probably end up representing a good buying opportunity as we approach the fourth quarter of this election year. Let me also mention that when it comes to elections, there's the possibility of a red wave. And whenever we have had waves in the past, we've had 3 Republican waves since World War II, 7 Democratic waves since World War II, that has added a percentage and a half to the average return in the first year of a new administration.
So let me get this right, Sam. A lot of people are saying that a red wave, or a blue wave, but in this case, a red wave, would actually cause inflation to go up and could become a problem for the bond market. You see it as the opposite, that actually any kind of dominance in Congress would actually lead to greater returns in equity markets. Is that correct?
That's what has historically happened, but obviously it's going to depend on what the new administration puts forth. If we do see, in a sense, very high walls in terms of tariffs and whatnot across the globe, then yes, that will end up being very restrictive, would be a hurt to our exports, would certainly smell of, or have the sniff test of the Smoot-Hawley tariff back in the early 1930s, which restricted global trade. So I don't think that would be a very good thing, and I believe that those who end up being in power would be very much aware of that.
Sam, just taking a step back, it seems like you're still pretty constructive on the overall backdrop for the U.S. economy. It doesn't seem like you're sort of expecting a major fall off the cliff type of moment. What would you have to see to change that view for some of the growth worries to become a true growth scare for you?
Well, as I had mentioned, the valuations were stretched, in my opinion, 78% premium for tech. Now it's down to about 64%. So some more slight downward rotation for tech, I think, would be encouraging. I think if we get a softer than expected PCE reading this morning, that could also help talk the market off the ledge. And because we've been seeing an improvement in the rotation beneath the surface, our Lowry technical analysis arm has been showing an encouraging amount of supply-demand indicators that they monitor to say that while a short-term pullback could certainly be in order, that they are looking at that as a good buying opportunity.
Let's see what we get in 20 minutes. Hey, Sam, thank you, sir. Sam Stovall there of CFRA. This from Ian Lincoln of BMO. He says, happy anniversary. I opened up the email thinking, what on earth is he talking about? And then he said it was exactly 1 year ago, July 26, 2023, that the FOMC brought Fed funds to this cycle's terminal rate of 5.25 to 5.50. Also the anniversary of the Draghi whatever it takes bumblebee speech.
Yeah.
Back in 2012. We're going back a long time, aren't we? 12 years.
So at this point, I'm wondering how long beyond this are we going to see a difference in the Fed funds rate? And I guess a lot of people are expecting it is not going to be next week, but can you imagine if it were a full 1 year kind of pathway?
And they'd cut rates?
Really, yeah. And then it would be this sort of very...
Just perfect.
Yeah, it would have this sort of,
I don't think that's how other
narrative
people
arc.
think about this. I was just reflecting on the Draghi speech, the bumblebee speech back in 2012. I know people who were in the room, and the people in the room at the time didn't feel like it was a big deal. That's what was amazing about that speech. People at the time didn't feel like it was a big deal. And then it was like the days afterwards that we started to put together, hang on a minute, is he going to come together with some big plan here that's going to turn around the whole story? Lifetime ago. Can't believe that time has gone by as quickly as it has. 12 years. Let's give you an update on news elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Shares of 3M up some 6.6% in the pre-market trade this morning. It reported second quarter net sales that beat estimates. It also raised its full-year profit forecast. It's the first earnings report since Bill Brown took over as CEO. Brown saying accelerating sales growth is a priority and that he wants to get there by increasing the pace of new product development. Now, as the Olympics are set to kick off in Paris later today, French authorities are contending with what they're calling malicious acts targeting the nation's high-speed rail systems. Fires were set at several infrastructure hubs along the rail system. Officials say people were seen fleeing the sites in vans. Eurostar says its services to London and Brussels have been impacted, with several trains delayed or canceled. The National Rail Company says it will have to repair its network cable by cable. Vice President Kamala Harris has picked up another key Democratic endorsement, Barack and Michelle Obama. Harris earlier this week secured enough pledged delegates to clinch the nomination. It caps a whirlwind week that saw Democrats coalesce around her as President Biden decided to end his candidacy. Biden quickly endorsed Harris, but Barack Obama held back. A person familiar with his thinking telling Bloomberg that he first wanted to give the party time to unite behind a candidate. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, the morning calls. Plus, we'll catch up with the Republican Senator Bill Hagerty on possible Trump 2.0 policy initiatives. That conversation up next. This is Bloomberg.
In global leadership are on Bloomberg.
I envisage not only some kind of a bridge towards membership or language linked to the irreversibility of Ukraine's membership in NATO, but also some kind of a broader package of military material, of financial aid. The more we support Ukraine right now, the sooner the war will end.
Nobody covers the top global leaders like Bloomberg Television and Radio.
Jumpstart your trading day with 2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
Bloomberg Open Interest, weekdays at 9 a.m. Eastern, only on Bloomberg Television.
Live from New York, counting it down to the opening bell with equity futures positive here by 0.8%. Yields unchanged on a 10-year, 424.26. The opening bell about 1 hour and 14 minutes away. Let's get you some morning calls. First up, Evercore upgrading CBRE to outperform with a 123 price target. The analyst noting the real estate services firm appears to be turning a corner thanks to upbeat second quarter earnings. The second call from Phillips Securities downgrading Tesla to sell and lowering its price target to 135. The analyst seeing further margin headwinds due to soft pricing and EU tariffs on China exports. And your third and final call from Guggenheim, lowering its price target on Chipotle to $54, maintaining a neutral rating. The firm lowering its 24 and 25 EPS estimates for the fast casual chain, seeing softer margins offsetting modestly higher same-store sales. That stock just about positive by 0.7%. Let's turn to the election. Sunday marking 100 days until voters head to the polls. If re-elected, former President Donald Trump is widely expected to appoint a so-called Capitol Hill cabinet, which could be full of congressmen. That includes Republican Senator Bill Hagerty, who is being floated as a potential pick for Treasury Secretary. The senator joins us now for more. Senator, it's wonderful to catch up with you, sir. I understand you are attending the cryptocurrency industry conference in Nashville, and we'll touch on that in just a moment. I just want to gauge where you sit on certain issues in foreign exchange, Senator, given our conversation with the former president of Bloomberg Business Week in the last week. The former president, Donald Trump, said this about the currency. He says the United States has a currency problem. I understand we have a technical issue with the senator. Can the senator hear me still, even if we can't see him and the shot is frozen? Can you confirm that? We can't hear him either. Okay, so we've got a bit of a technical issue. We'll try and confirm a re-established connection in just a moment. The conversation I wanted to have was around foreign exchange, Lisa, and the first question would have been, and I'll share that with you right now, ultimately, if we've got a currency problem, what can they do about it in Treasury?
Yeah, especially at a time when ultimately this is about the Bank of Japan holding rates incredibly low and the U.S. having a strong economy. Potentially, how do you further the idea of a weaker dollar if you do pursue some of the policies that Donald Trump has talked about, including higher tariffs, including reducing certain immigration?
Deutsche Bank have this to say: tariffs and their associated stronger implications for the dollar are significantly more likely to be the dominant market outcome than policies to pursue a weaker dollar. And this is the issue at play here, almost a contradiction. You identify a problem, you think it's the currency, ultimately it's too strong, but you also propose some policies that could strengthen it in the minds of a lot of people that come on this program.
Part of the problem to really understand where the former president is sort of thinking is if you do have two contradictory policies, which is more important? Is the idea of a weaker dollar and potentially more exports more important, or is the idea of putting up some gates for products coming in here from, say, China and potentially reducing immigration?
I'm happy to say we've re-established that connection with the senator, and hopefully we can get across to him now. Senator Hagerty, do you hear me okay? No. He does not hear me okay. I think we're going to let this one go, because I don't think we can establish this connection at all. Senator Hagerty there on the latest from the cryptocurrency conference in Nashville. We went through some of the prices to attend some of this fundraiser. I shared them with you a little bit earlier. I think it's worth going over again. Donald Trump's going to be there, and he's inviting supporters in a private fundraising event to Nashville on July 27th. And it includes this: asking $844,600 for a seat at a round table. Donors can also get a photo, a snap with the presidential candidate for $60,000 per person and $100,000 per couple.
It's been 10 minutes time now at the bottom of the hour. Do you see the release of the headline event for the day and the week of the US PCE price index data for the month of June? Year over year, the forecast is 2.4% on the prior 2.6%, with a range of 2.5% to 2.3% expected. PCE price index month over month forecast 0.1% on the prior 0%. The range is 0.1 to minus 0.1%. Core PCE year over year forecast 2.5% on the prior 2.6%, range of 2.6 to 2.4%. And the core PCE month over month forecast 0.16% on the prior 0.1%.
There is a kind interpretation and a less kind interpretation.
Over the range of 0.1% to 0% expected. Let's get the US consumer spending month over month for June. Forecast 0.3% on the prior 0.2%, with a range of 0.7 to 0.1% expected. Personal income month over month forecast 0.4% on the prior 0.5%, and real personal consumption month over month forecast 0.3% on the prior 0.3%.
To do with politics. Pick your poison. Is it the kind interpretation of what's happening here, or the less kind interpretation?
And I will let everybody make their decision. When you zoom out, there is this real question, and I think that we've seen this again and again, where there isn't a clear candidate right now for president that is clearly business friendly. It is unclear who the business-friendly administration actually is. I think that we have to keep asking that, and I think that actually, I hope that we can at some point talk to Senator Bill Hagerty. Maybe not today, but at some point get him back on, because he has been of the business world, and I have this real fundamental question of, especially at a time of protectionism on both sides of the aisle, especially at a time when you have a real fraught national security moment, how do you become the party for business What does that mean? Sometimes it can just be consistencies of policies. Does it mean the idea of putting up gates or not? We talked to Stellantis yesterday saying that actually tariffs hurt their business, even if they reduce competition in the short run from China. So a lot of real questions around some of the traditional associations in the political parties and how they're really changing.
When we say the party of business, my response would be, what business? If we're talking about big tech, not the party of big tech. If we're talking about small business, David Malpass, former World Bank president, in the running potentially for a role in the next administration under Donald Trump, around this table talking up what? Small business. They want to help small business. It's not about being pro big tech. So the party of business, but certainly not big business anymore. And I think that's the populist bent in this party that's pushed them in that direction.
Yeah, it's a good point. And I wonder how much it's small business versus large, or whether it's specific industries that have certain projects that are positive or negative for certain bases. Either way, I think that when you talk to a lot of politicians, they're saying, pick one. Pick a policy and stick with it, because if you want to make plans, you have to be able to count on a landscape that is not shifting at every administration and every couple of years. I do wonder how much, though, that really has changed the tenor of some of the conversations of bank CEOs, of industrial CEOs who go to the White House, who speak with the former President Trump about what policies they'd like to see.
Let's make some plans on this program. In about 7 minutes' time, we get some economic data. Let's go through it. Personal income, we'll get PCE, then a little bit later at 10 a.m. Eastern Time, we get University of Michigan sentiment numbers as well. That sets us up for the last big slate of data before we go into next week when we get a Federal Reserve decision. And 2 days after that Fed meeting, a payrolls report in the United States of America. The estimate on our side of things for payrolls in our survey, 175,000 is the median estimate in our survey. The previous number is about 206. Into the numbers we get in about 6 minutes' time. Let's turn to the price action and start with equity futures. On the S&P 500, we look like this. We're positive by 0.8%. On the NASDAQ 100, up by 1.1%. On the Russell, the small caps, monster outperformance. Once again this morning, higher by 1.4%. If you look at the price action and the outperformance we've seen over the last few weeks, and I've gone over this stat a million times, I think it's worth going over again from Jim Reed at Deutsche Bank. 24 percentage points of outperformance on the Russell 2000 versus the Mag 7 since the record high back on July 10th. Lisa, that's mega outperformance.
Yeah, and it comes after a mega underperformance earlier this year. This is the reason why the main question for so many people has been, is what we're seeing right now in markets really good and actually shows that a healing economy is going to let some of the other companies other than big tech really benefit? Or does this begin a sort of downward spiral that at least can cause a deeper correction? The answer has been unclear.
Mike McKee dropping by the studio ahead of this break in economic data. Mike, we've had some data already this week. GDP was better, jobless claims a little bit lower. What are you looking for from the numbers later this morning?
Better. It's a good way to put it. We're expecting a slight decline from the PCE inflation.
In 5 minutes' time now, at the bottom of the hour, we see the release of the US PCE price index data for the month of June. Year over year, forecast 2.4%, prior 2.6%, range of 2.5 to 2.3% expected. Core PCE month over month, forecast. US PCE price index month over month, forecast 0.1% on the prior 0%, with a range of 0.1 to minus 0.1% expected. Core PCE price index year over year, forecast 2.5% on the prior 2.6%, with a range of 2.6 to 2.4% expected. Core PCE price index month over month, forecast 0.16% on the prior 0.1%, with a range of 0.2 to 0% expected. Also get the US consumer spending month over month for June. Forecast 0.3%, prior 0.2%, range is 0.7 to 0.1%.
Unless you're hanging out for you, Mitch.
Well,
are you hanging out for you, Mitch?
Yeah, I am hanging out.
Okay, good for you.
But after that, we'll go. And then we can go home and,
Some of us are not hanging out for you, Mitch. All right, breaking economic data up next. We'll catch up with Mark Sandy at Moody's. Mike McKee will break this down. That's all coming up next on the show.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
What we try to do is combine some of our insights from the fundamental business with external and data set signals. And I think that's a lot of times where the opportunity is.
The countdown is on. Everything you need to get the edge at the end of the
1 minute
market
remaining.
day.
I'll lead with the
Get
US
ahead of
PCE
tomorrow's
price
trading
index
with
year over
The
year.
Close, weekdays at 3 p.m. only on Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. The top names in business are on Bloomberg.
What I can say is that we've been making significant investments across the franchise, across regulatory reporting, across data, and across resolution and recovery planning. These are areas we've been investing in because we know they're areas that, frankly, the industry likely needs to further enhance, and we certainly want to enhance them for ourselves.
Nobody covers business like Bloomberg. Context changes everything.
10 seconds.
Economic data seconds away, with equity futures on the S&P positive by 0.8% and the NASDAQ up by a little more than 1 full percentage point. On the Russell, positive by 1.4. That's where your outperformance is.
Still waiting.
It's where it is this morning. In the bond market, a 2-year, 10-year,
2 spot 5%, 2 spot 5%. That is higher than forecast. 2 spot 4%. PCE price index month over month 0 spot 1%, 0 spot 1% as expected. Core PCE price index year over year 2 spot 6%, 2 spot 6%. Higher than forecast. 2 spot 5%. Core PCE month over month 0 spot 2%, 0 spot 2%. Higher than forecast. 0 spot 16%. Consumer spending 0 spot 3% as expected. Looking to the markets here, seeing some weakness in the dollar and strength in the S&P 500, but weakness in these bond yields as well. Personal income 0 spot 2%, 0 spot 2%, lower than forecast 0 spot 4%. Real personal consumption month over month at 0 spot 2%, 0 spot 2%, which is lower than forecast 0 spot 3%.
That is as forecasted down 1/10 from last month, and then the core comes in 0.2 as forecast, and
short-term interest rate futures edging up after the inflation data. Traders see a July Fed hold and a September start to rate cuts.
So that's probably where that rounding error comes in a little bit. But income spending were also revised a little bit lower. Well, income was revised lower for the month of May, and spending revised higher for the month of May. So at this point, you've got a reasonable incomes, good spending numbers, and prices continuing to inch down. They're not going really fast, and that's the thing that a lot of people are hoping for, but maybe this is enough to get the Fed going.
If we just take a step back and think about what the last 24 hours look like,
income outlet is on the feed for anyone interested.
And a decent jobless claims relative to expectations. There were these massive calls to get a move on at the Federal Reserve, and we can go through these calls piece by piece. Mohamed El-Erian came on this program a month or so ago and said, I think they need to move in July. There's a risk here that the labour market weakens and weakens quickly, and they need to get ahead of all of that. Jana Hatzius of Goldman Sachs asked the question as well, why wait? Bill Dudley, the former New York Fed president, wrote an opinion column on Bloomberg Opinion saying, I've changed my view based on the labour market. They need to get a move on. I remember you saying yesterday when the jobless claims numbers dropped, it's almost like for the Federal Reserve, what do you want us to do? The numbers look okay. Where does that argument
Looking across the markets, let's see whipsaws across the assets ending little changed now that we're consolidating.
The spending numbers aren't strong enough to say that we're not going to get rid of inflation because the economy is overheating. The income numbers show a little bit of a decline, and we'll have
There's
to
some
look
weakness
at
coming through in the S&P 500 now.
Overall composition of that is. I've just got the numbers here. Wages and salaries up 0.3. That's down from a 0.6 gain in the month of May. So a little bit better there in terms of what you're looking for in inflation.
StatScan flash estimate shows that Canadian wholesale fell 0.6% month over month for June.
Not a collapsing economy that you need to immediately rescue. It is one that is slowing down.
And we can see not much of a reaction in markets, just a little bit on the margins. Yield just a touch lower, but coming back. And John will go through all of that. But I'm looking right now at this data, and it points to this idea, slowing, not slow, right? But the stickiness in core PCE, does that make anyone take pause? I mean, there's this question of, can we really write off the idea of a resurgence in inflation if you do have certain goods inflation aspects coming up just as services inflation goes down?
Well, services inflation is still hanging in there is the problem, and goods inflation has fallen quite a bit, but everything is moving down slowly. And we're got to be at a point sometime soon, given that Jay Powell and others at the Fed have said we're going to have to start lowering rates before we get to the 2% target. I mean, we're in range now. He has said 2.5.
You've made the point also, Mike, that you think to some extent this market's already doing the work for them, that all they need to do next week is just sort of validate what the market's priced for. Is that fair?
I think that's the case. If they suggest strongly in the statement or Jay Powell's news conference that we're going to see a September rate cut, then their market's going to price that in, and they're going to get the effect of a rate cut in July.
Going into the next week, we have a lot coming up. We've got, of course, the FOMC meeting. We also have the Treasury refunding announcement, and we've got some of the tech earnings capped off with the jobs report on Friday. From the Fed's perspective, how much are they watching some of those pivotal earnings, given that the signals from corporate executives have been some of the most forward-looking indicators that a lot of economists have hooked into?
Well, they'll pay a lot of attention to it, and they're always talking to the CEOs in their districts all the time, and the Board of Governors is out talking to people. So they have a pretty good idea of what these executives are thinking. And obviously, with the Fed, it's going to be the same as it is with investors. You're going to be looking at what the forward-looking forecast is for earnings at these companies. And then if anybody says anything about layoffs or anything like that, right now, earnings seem to be coming in okay, given the situation. And the forecasts for 2025 are pretty good. So the Fed is not overly worried about recession at this point. But I will say one thing, and that is I don't want to dismiss the idea of this slowing economy too much, because we don't get the jobs report until next Friday. And if that shows 4.2%, then you trigger the Somm rule, and it scares investors, and it scares the horses, and then it maybe scares the Fed. So we have to wait and see how that turns out.
Citi thinks we hit 4.2 next week. I'm far more interested in how the market responds to this than the Federal Reserve, because the Federal Reserve knows we're close to it and they don't seem too worried about it. Bill Dudley, the former New York Fed president, suggests that they should be. I just wonder if the market sees that, given how well-known that rule has become, particularly over the last few years, Lisa, that people begin to price in what they believe will be, with certainty in their minds, a recession.
What I find interesting is that for most of this year, the volatility was in the bond market. We saw pretty massive fluctuations. Over the past couple of weeks, yes, we've seen some real moves in the bond market, but the volatility has been in the stock market. How much will the stock market, will risk assets actually respond to a downside surprise or in that jobs report or a 4.2% unemployment report, much more than even the bond market, which is already pricing in a good deal of rate cutting?
Next to no news yesterday on NVIDIA. The range down by 6.9% at the lows, the highs positive 2%. That's a massive range on one of the biggest companies on the planet. Talk about volatility.
And we've seen it index-wide, and that, I think, is sort of different. We've seen it in specific stocks, but not index-wide in the same kind of way as we have over the past couple of weeks.
Let's get to the price action, and then we'll build on this conversation on the economic side of things. Equity futures going into the opening bell in about an hour from now, positive by 0.8, on the NASDAQ up by 1%, on a Russell up by 1.4. In the bond market, we look a little something like this. Yields lower by 2 basis points on a 2-year, 440, down about 2 as well on a 10-year at 421.72. Nothing too scary in this economic data this morning. To discuss, I'm pleased to say, a good friend of this programme over the years, Mark Zandi of Moody's Analytics, joins us now for more. Mark, you think maybe we've been too high for too long at this Federal Reserve. How would you like to see this conversation change next Wednesday?
Well, I mean, at this point, Jonathan, I think September is when the Fed wants to cut and when they will cut. So I just think they're going to reaffirm that with this meeting and press conference and everything else that goes around it. So I think it's all about just confirming current market expectations. And you know, investors, you probably know better than I, but I think there's a close to 100% probability to expect a September rate cut. Today's data is consistent with that, and I think that's the language we're going to hear next week from the Fed, that they're just going to, cement that expectation.
Mark, the Fed believes they've got time, and we had this exchange with Bill Dudley. I'm sure you read his piece on Bloomberg Opinion earlier this week. The former New York Fed president suggesting that maybe they're miscalculating how much time they have, taking too much comfort away from what's developing in the labour market. As you look across the labour market, I just want to understand what's on your dashboard right now, Mark. What is concerning you? What stands out? What's sort of flashing brightly for you?
Well, I agree with Bill. I think the Fed should, I think the Fed should have been cutting earlier this year. Reason being that they've achieved their objectives. The objective is full employment, check, 4.1% unemployment rate, and low and stable inflation. And I say check. I mean, the PCE inflation's 2.5% within spitting distance of their target, and everything is headed in the right direction. And, we've been reduced to going to the second and third significant digit here. But if you do that with today's numbers, you're right on target. And the other thing I'd say is, if you exclude the cost of the implicit cost of home ownership, which I think you should do, there's growing evidence that is not really helpful in setting monetary policy. The PCE deflator is at 2% or below, and has, on a year-over-year basis, has been there for more than a year. So you got to ask yourself the question, well, why a 5.5% funds rate target when you've achieved your objectives? And I'd say, if you're saying the counter is, well, nothing's going wrong. Well, really, you're going to wait till something goes wrong before you start cutting rates? Isn't that too late? It's in the job market, what's going on in the financial system. It just strongly argues to me that the Fed should be cutting rates. But having said all of that, it looks like September. I'll take it.
Mark, one thing that we were talking to with Bill Dudley was, why now? What triggered this shift in view that it is time to cut rates in possibly even next week, given that the economy is still hanging in there? And you're saying, well, why wait? Because you see enough signs of weakening. You point to something else, and that's the downward revisions in the labor market for prior months, that concerns you. Why is that important?
Well, Lisa, it's the plethora of labor market data suggests that it's downshifting in a pretty meaningful way. The downward revisions to previous payroll employment reports is consistent with that, but there's a lot of other evidence. I mean, hours worked are down, hiring rates are down, quit rates are down, temp jobs are down. The only thing that's kind of hanging in there really well is layoffs. They feel like they're ticking up a little bit, but they're low, and that's great. But, we don't have a really good theory as to why businesses are so reluctant to lay off. We've got theories, labor hoarding kind of theories, but they feel rather tenuous to me. And as we saw in the tech sector a little over a year ago, high-flying companies that are hiring boats loaded of people can turn around pretty quickly and start laying off workers pretty quickly. So, I think things can change very fast. Once they change, it's too late. It's too late. The other thing, Lisa, I'd say is it's not only about the labor market, it's about the financial system. The financial system is under a lot of pressure. The yield curve, the difference between short and long rates is still inverted, and that's a very uncomfortable place for banks and other non-bank financial institutions. You throw in weakening credit quality, slower loan growth because of the tightening and underwriting in the wake of last year's banking crisis, higher regulatory costs. The operating environment is pretty tough, and so something could break in the financial system. And as we saw from the crisis a little over a year ago, that can happen also very quickly. So why take that chance?
You're talking about things changing very fast and the potential financial pressures. We're seeing a lot of volatility in certain stocks. Some people would say it's technical. We're also seeing it in certain currency pairs. And there's been a lot of speculation about what kind of technical backdrop there is for this. Do you think that is cause to really build on your worry about a financial system that's stretched, that's seeing sort of outsized moves in response to not that significant catalyst, simply because there aren't sort of the buffers that there have been in the past?
Yeah, it's a good point. I mean, my focus is more on the bond market, and you can kind of feel it there. The liquidity in the market just doesn't feel good. I mean, I've been watching the bond market for decades. You go back not too long ago, if you saw the 10-year Treasury yield move a couple, 3 basis points, you go, that's a big move. Now it's moving 10, 20 basis points in a day, in an hour. So I do think liquidity is an issue, and there's some structural problems there, right? I mean, the big broker dealers that make those markets haven't been able to or willing to expand their balance sheets to remain consistent with the growth in the amount of debt outstanding. We've got all this Treasury debt coming into the market because of the large budget deficits, But because of capital rules and liquidity rules, banks have not expanded those balance sheets, and therefore the market just feels really fragile to me in terms of liquidity. And yeah, we could get a liquidity event, and it's happened in the past, and certainly is a risk going forward.
Mark, just before you go, I've seen a lot of growth scares in financial markets over the years. I'm sure you have too. I can't think of a time when I've heard so much about the SARM rule as I have this time around. It's like everyone's talking about it in financial markets. Now, I know in your world, in the world of economics, we've been talking about this for a while, but financial market participant, investor after investor, all talking about the same thing. Mark, if we trigger that next Friday, do you think market participants, based on conversations you've been having, will begin to behave like it's here, the recession's arrived?
No, I don't think investors are slave to any one indicator, and every indicator's got its issues. I mean, the SARM's rules, you know, it's something certainly to watch, but, you know, obviously unemployment is ticking higher because of labor supply, right? We've got a lot of foreign immigrants coming into the country, starting to work, and that's causing the unemployment to rise. So it depends why the unemployment rate is rising. Is it labor supply, as it is today, or is it labor demand? And I think it's more supply than demand. So you have to take all these things into consideration. And I think investors are pretty smart. They do that as well. But, you know, it's just one other indicator, along with all the other indicators I just articulated, to suggest, look, you know, the labor market's feeling a little squishy here. And again, why take a chance? Mission accomplished. You've achieved your goals. Let's get going.
Mark Zandi. Mark, appreciate it. Let's catch up soon. Mark Zandi there of Moody's Analytics on the Federal Reserve. Next week's an interesting one. We often sit here and we say it's the most important jobs report since the last one until the next one. I do think this jobs report next Friday takes on some additional importance, don't you?
It is definitely the most important report since the last one until the next one, 100%. And I will tell you it does, because we don't have a clear sense of exactly where we are on the trajectory.
It's not like that July 4th payrolls report when everyone went to the beach and Mike McKee was stuck here breaking it down. This one feels more important.
We had fun without you.
I'm sure you did. How important do you think this is next Friday?
I think Lisa summed it up well. Most important since the last one, because we're going to have another one before the September meeting.
True.
So it will continue to. Although, because we're so close to the SARM rule, as you pointed out,
yeah,
it will garner interest. Unemployment has to be the first number I mention on a week from today.
I agree. I think for a lot of people, that's like the indicator next Friday. Mike, appreciate it. Thanks for today and this week. Appreciate it. Thank you. Let's get you up to speed on some stories elsewhere with your Bloomberg Brief. Let's get over to Danny Berger. Hey, Danny.
Hey, John. The SEC is suing short seller Andrew Left in his Citron capital, accusing him of committing fraud through stock trades, social media posts, and research reports. The SEC is alleging that Left and Citron generated about $20 million in illegal profits. The regulator claims that Left would make a recommendation alongside a price target and then capitalize on the resulting movements, but on prices far different than what he recommended. Left had no immediate comment. Canada has beaten New Zealand 2-1 in the Olympics women's soccer tournament, moving a step closer to a second straight gold medal. But the match has been overshadowed by an ongoing spying scandal. The Canadian Olympic Committee announced it sent the coach home after the team used drones to make unauthorized recordings of New Zealand's practices in the lead up to the match. The Canadian staff member flying the drone was arrested and given an 8-month suspended prison sentence by French authorities. And Vice President Kamala Harris is picking up another key Democratic endorsement, Barack and Michelle Obama.
Kamala.
Hello. Hi.
Hey there.
Oh, hi, you're both together. Oh, it's good to hear you both.
I can't have this phone call without saying to my girl Kamala, I am proud of you. This is going to be historic.
We called to say Michelle and I couldn't be prouder to endorse you and to do everything we can to get you through this election and into the Oval Office.
Oh my goodness. Michelle, Barack, this means so much to me. I am looking forward to doing this with the two of you, Doug and I both, and getting out there, being on the road. But most of all, I just want to tell you the words you have spoken and the friendship that you have given over all these years mean more than I can express. So thank you both. It means so much. And we're going to have some fun with this too, aren't we?
Harris earlier this week secured enough pledged delegates to clinch the nomination. It caps a whirlwind week that saw Democrats coalesce around her as President Biden decided to end his candidacy. Biden quickly endorsed Harris, but Barack Obama had been holding back. A person familiar with his thinking telling Bloomberg he first wanted to give the party time to unite behind a candidate. And that's your brief, John.
Danny, thank you. Thanks for today, and have a good weekend. If it was me, and obviously I'm not the vice president, but if the president called the former president, I'm sort of pausing and stopping. I'll sort of keep walking, you know, sort of super chill.
Well, it was fantastic B-roll.
Perfectly staged.
Yeah, it was good. It was good. It worked.
Perfectly staged. Let's put it that way. Up next on the program, setting you up for a big week ahead with a lot of tech earnings on deck, a Federal Reserve decision, and a payrolls report a week away. From New York, you're watching Bloomberg Surveillance.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of, I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Go on.
No, I'm good.
All right.
We're done.
Okay, we're done. 40 minutes away from the opening bell. Equities right now firmer by 0.7% on the S&P. Yields are lower by 2 basis points, 422.31. It's like collectively, take a deep breath. What a week, honestly, in this equity market.
I mean, to me, the weird part about this is we were talking growth scare 2 days ago. Definitely growth scare. I mean, that was basically entirely everything, and you just are seeing the confirmation everywhere. And then it was, this is a fantastic rotation. Check out those small caps. Check out high yield spreads. I mean, pick your narrative. It's like changing every day.
I think you had 4 different market regimes in the last 60 minutes of trading in yesterday's session. As we count you down to the opening bell, here's the trading diary for the week ahead. Let's get to it. Tuesday, jolts and consumer confidence data. Wednesday, we get the ADP report and a BOJ rate decision together with a Federal Reserve decision as well, followed by a Chairman Powell news conference at 2:30 Eastern Time. On Thursday, another round of jobless claims. And on Friday, the July payrolls report. And if you look at that calendar, just for the week ahead, for the data and the central bank decisions, given what we know now, if I could have the outcome to any of that, I'd take the payrolls report over the Fed. Given that it doesn't sound like the Fed's going to do anything on Wednesday, based on their communication, maybe they throw in a surprise, I don't know, but based on what we know now, I'd take Friday payrolls.
I think a lot of people would agree with you. It was interesting that Victoria Fernandez of Crossmark came on here and said, actually, she has a good sense of all of it. She wants to see the Treasury refunding announcement to see exactly what maturities of Treasuries the U.S. government's going to sell. So a lot going on.
A lot of people in Camp Bramo, aren't they? Treasury refunding next week?
Do you know how many people have messaged me to be like, stay on the auctions. The auctions are important. Don't let John bully you about auctions.
John Bully, let me tell you how commercial breaks go. But
not
that way around. Not that way around.
Big boy.
AMH and Bramo teaming up.
Oh, yeah.
Giving me grief.
So terrible.
Let's get to the week ahead. It looks like this. The Mag 7 results coming in thick and fast. We hear from the likes of Microsoft, Meta, Apple, and Amazon. You've got to wait until the end of August for NVIDIA, and we've said it already this week that they need to change that. Mandeep Singh of Bloomberg Intelligence. Mandeep, do you agree? We need to bring that in. Why do we need to wait until the end of August for NVIDIA?
Save the best for the last. So, that's been the theme for the last few quarters. But clearly, I think Microsoft is very important in terms of keeping this AI trade going, because everyone realizes Microsoft is at the forefront of both ramping up the CapEx side as well as the cloud deployment. I mean, look, this is a company that has actually got a live product, Copilot, that is generating revenue. And look, you want to see that AI lift in the numbers when they report next week. So I think that's the one to watch.
You framed it perfectly earlier this week, and we extended that conversation through this morning with a couple of guests as well. If you look at the reaction to earnings so far, you can start to gauge what investors are rewarding companies for and what they're punishing companies for. And the example you used was Alphabet. Can we start there? What did investors punish Alphabet for? And how do you see that setting us up for next week when we hear from the likes of Meta and the other big players?
Yeah, I mean, in the case of Alphabet, they didn't have a timeline for when these CapEx increases would go away. I mean, they are clearly spending 60 to 70% above their historical CapEx, and typically this reverts to the mean. They're not saying that because they think it's a long runway. I think Meta is going to do the same. And look, as an investor, you don't mind, companies spending, especially the companies that generate $100 billion in free cash flow like Alphabet does. So it's a good way to spend on new technology, but you do want to see the monetization. And in the case of Alphabet, the search revenue did accelerate sequentially, but it was 1 percentage point of acceleration. So clearly they're not losing any share. They have kind of reclaimed their mojo in terms of, being ahead on the search side. But you do want to see a more meaningful lift, which is what everyone is hoping Microsoft can show in the results.
So we get Microsoft, we get Meta, we get Apple, we get Amazon all next week. Of those, which do you think is going to be potentially either the biggest surprise or that you are most curious about?
I mean, Amazon, look, in the case of Amazon, especially the AWS side, everyone thinks they are behind the curve when it comes to generative AI, because remember, Amazon is the largest cloud player. AWS generates $100 billion in revenue run rate. Azure is 76, and Google Cloud is 40 billion. But their growth rate seems to be decelerating. So this quarter, it's high teens. Everyone else is growing around 30%, Azure, Google Cloud. So you want to see them actually surprise to the upside, just to assure investors that they're not lagging behind on the cloud side. And I think that's still uncertain.
I'm super interested in Apple. What does Apple look like in China? We've had that guide again to suggest that the iPhone's struggling a little bit in the mainland, and then Apple came out last time around and said, nothing to see here. There isn't a big problem. I just wonder if we hear the same commentary next week.
Yeah, and whether they talk about production and how much they're diversifying that, and whether they talk about the Treasury refunding announcement.
Of course they will. Yeah, that will come up too. Luca Maestri, by the way, is an amazing timer of the bond market, isn't he?
By the way, I just want to point out something. All of these big tech companies have benefited so much from rates where they are because they've got so much cash, they're keeping them in T-bills.
I've seen.
And they've been absolutely cashing in. So it raises this question of what is interest rate sensitivity for some of these
How did we get back to the deficit, Treasury issuance and that with tech firms?
You're
but
welcome.
We did. Okay, anytime. Mandeep, thank you. Appreciate it. Mandeep Singh there of Bloomberg Intelligence. Lisa, thank you. Appreciate it.
For what?
Anne-Marie, thank you. It's off next week, by the way. Anytime. Anytime. We'll see you next week on Monday. Terry Haynes of Pangea Policy, Lindsay Piegza of Stifel, Amanda Lynham of BlackRock, Kevin Gordon of Charles Schwab. From the team here at Bloomberg Surveillance, thank you very much for choosing Bloomberg TV. And if you can, please have a wonderful weekend. This was Bloomberg Surveillance.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
A tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
You look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, to dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Jason Kelly, and this season on Power Players, we're taking you behind the scenes to see how the business of sports has gone global.
I want sports to grow. I want sports to be bigger because we have talent.
And how mammoth value is coming from the smallest of players. 3,184 hits, 431 home runs, and of course the most famous stat that everybody knows, 2,632 consecutive games played. Unmatched career. Why are you doing this?
What we have achieved in the NWSL from an investor perspective over 2 years is the equivalent of what it took other leagues 25 to 30 years to achieve.
You've got to have a business that's sustainable. The only way it's sustainable.
Effective Fed funds rate 5.33% for July the 25th, unchanged from July the 24th.
You win off the court, and as you do that, you bring people along.
Futures are higher after a brutal week of trading. 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Sonali Basak. And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, mild PCE data. The latest inflation reading did little to alter bets that the Fed will be able to cut rates in September.
And that eco data caps a turbulent week for markets, full of underwhelming earnings. Apple gets set to headline another crucial week ahead for big tech.
And the SEC targets Andrew Left. U.S. authorities accusing the short seller of committing fraud through stock trades, social media posts, and research reports. We're going to get to all of that and more, but let's take a look at where markets are trading. Because we're higher after that PCE report, you can see the S&P 500, at least in futures, up 0.7%. You also have big tech rebounding right now. The NASDAQ 100 up by about 1%, actually. The bond market pretty quiet in the wake of that economic data. You can see 10-year yields currently lower by 2 to 3 basis points, Matt.
All right, two companies out with results this morning. 3M rising after raising its full-year profit forecast, and Bristol Myers also getting a boost after increased demand for its new medicines. I have the rotation chart here, though.
Yeah, take a look at it.
Is that something that you were going to say?
Yeah, you stole my thunder. We'll take a look at those stocks as well. But this is exactly what they're doing pre-market. Both rising about 6%, Matt. And of course, yes, giving fuel to that rotation. These indeed are not technology companies. But to end this week, a brutal week with brutal earnings. Certainly some green on the screen is welcome, Matt.
All right, I was going to say that
Ron Burgundy.
If you put it in the prompter, I will read it. I was going to say that the last 3 weeks we've seen the biggest outperformance for the Russell 2000 over the S&P in history. So that rotation that you've been on about since the beginning of this show is actually happening.
Yeah, 2.5 weeks I've been right here. And it's interesting because it feels like we have the economic data to back it up in terms of the environment. But when it comes to the earnings piece, Sonali, remains to be seen. Of course, we're hearing from big tech now, and then we're going to get into some of those smaller companies.
You know, it's interesting. Since the start of the month, it's been been a tough tape for the S&P 500 even, but if you think about it, the last 2 weeks have been pretty brutal. Even with the gain you're seeing today, it doesn't recover us from what this week felt like.
All right, let's talk about the economic data. PCE data coming out. Inflation actually a little bit hotter than the market was expecting. Let's get over to Michael McKee, Bloomberg's chief economics and policy correspondent, for the details. Mike?
But overall, the news is pretty good, and it should keep markets on path to a September rate cut by the Fed, probably not next week, but personal income rises 0.2. That's less than anticipated, but it's good news overall, and I will explain why in just a second. Personal spending comes in 0.3. The May number revised up to 0.4, and what happened was that May and April were revised higher, so the June figure comes in a little stronger. We saw strength in consumer spending, and it was mostly in those 2 months. Now, as Matt said, the PCE headline number comes in as expected, up just 0.1. It's the core that came up a little bit higher, but it is not really an issue because at 2.6%, that's the same as last month, and it's telling us that we are seeing inflation continue to slow. Now, the important thing about the wage...
You said the same as last month and continue to slow. It sounds like stagnation to me, right?
It sounds like stagnation, but within the numbers, things are turning out a little bit better. And you look at the personal income numbers, and what we saw there is the wage and salary component halved to 0.3 from 0.6. So at this point, wages are still, though, running ahead of inflation. And that's good news for workers and good news for people, some people campaigning for president, I guess. The other good news within this number is housing is finally doing what the Fed wanted it to do. 0.3 gain rounded up for the housing component of this, which reflects much the same as the CPI. Housing is finally going down, not going down in price, but inflation getting to a reasonable number. And where does it leave us with the Fed? Basically where we were. A little bit stronger in terms of the pricing for 3 rate cuts this year, but we're still looking at a September start, and then we go from there.
Well, today is a momentous day. Just quickly here, Mike, it's the 1-year anniversary of the Fed reaching their terminal rate in their hiking cycle. And like you said, I mean, this seems like another see you in September sort of print.
It is, but last September we weren't talking about cutting rates. We were talking about higher for longer. So it's taken a year. The Fed has left rates higher for longer, but we're finally getting to the point now where the economy has slowed enough and inflation has slowed enough that they feel they can normalize. And that's the important thing. We're not cutting because we think the economy is going into recession. The Fed wants to normalize rates, get rates to where they should be. And thank you for inviting me to the Fed anniversary party this afternoon.
Absolutely. Mike McKee, great to see you. Have a great weekend. That, of course, is Mike McKee. And let's keep this conversation going now with Caterina Simonetti. She is Senior VP and Portfolio Manager at Morgan Stanley Private Wealth Management. So there's a few different cross currents this week. Of course, if you take a look at the stock indexes, it's been super volatile. We have underwhelming earnings, like Matt said, but on the economic side, we've gotten pretty good data that, like Mike McKee was just saying, sort of gives the Fed the luxury of normalizing here. There's not the urgency to cut rates. What's the more important factor for you at this moment? Is it earnings or is it the economics?
Well, thank you for having me on the show. And it's definitely both. You know, as we look at the CPI data coming in somewhat lower than expected, you know, in just general, you know, direction of the economy, it seems more and more likely that Fed is going to start the rate cuts in September, you know, as expected. You know, the other part of it is, of course, the economy and the fact that the earnings have been mixed and below the expected rates in the areas outside of Max 7. And we see the pickup there, which is something that is really important for the overall growth and expansion of the economy. But the factor that weighs on the market more than anything is us going into the election season, and the presidential elections, as we know historically, come with a lot of uncertainty and a lot of volatility. So we are optimistic about the fact that we are going to see the rate cuts and that the economy is starting to recover in the areas, you know, outside of Max 7 where we have not seen returns at a very high levels, the sectors like healthcare, industrials, materials, financials, but we tell investors to brace themselves for higher volatility.
You know, it's interesting, Katerina, if you look month to date, you have the Russell 2000 up more than 8%, while you're seeing declines finally hit the S&P 500 and even more so on that NASDAQ 100, as you've been talking about. And the sectors that have been winning this month are very, very interest rate sensitive: real estate, financials. How much more room do those sectors in particular have to run? And when people think about this rotation, should they be thinking about it by sector or by size of firm? You know, there's a lot of divergence here on whether those small and mid caps could be safe if we saw more economic softening.
Well, absolutely, and we have to look at it from, two different angles. One is the valuations in small caps definitely seem attractive, but the question is, what is actually going to make these companies successful and profitable going forward? And this will be the cheap capital and access to labor that, these companies will be able to afford. And we're not quite there yet. So when we talk about positioning of small caps and mid caps within investment portfolios, investors have to be ready to expand the time frame for them to achieve, the desired rate of return. At the same time, as we look at the sectors that really have not performed at the same levels as, some of the large tech names, the healthcare, financials, defense, industrials, materials. This is the areas where the active stock picking makes more sense than ever. And we can identify and choose companies that have pricing power, competitive advantage, that have not performed quite as well, but are positioned for growth and are positioned defensively to perform better than, some of the names that were in the leadership. But the question is, are they going to be able to sustain the level of earnings and the level of growth that we have been seeing over the last couple of years?
Right, and if we're not, that's why you want to be positioned defensively, Katerina. I look at your notes and my eyes are immediately drawn to the fact that you prefer consumer staples over discretionary. Is that a worry about the U.S. consumer? Is that a worry about the U.S. economy?
Absolutely, Matt. U.S. consumer has been hit, with high inflation, high interest rate, market uncertainty. They're sitting on the sidelines and not sure, exactly what to do. And what we tell our clients is that, defensive positioning, diversified portfolio, actually taking a close look at the asset allocation, because a lot of people are over concentrated in specific names and specific sectors without even realizing this, which subjects them to higher level of risk. And there's always, investment grade corporate bonds as safe haven. So there are places where portfolios can be positioned, in light of the higher volatility, in light of the potential market, fluctuations that are wider than normal, is something that we're expecting going into the election season.
And Katerina, I want to talk about defensiveness in the context of an overall portfolio, because I'm taking a look at the correlation between SPY and the AG, and it's actually been positively correlated since about 2023 or so. So looking at that chart, it seems to suggest that bonds aren't providing that portfolio buffer, that they're not acting as a haven asset. And with that in mind, that bonds aren't necessarily fulfilling that duty, what is the haven in a portfolio right now?
It's an absolutely fair statement, especially considering that historically, if we look at last couple of years, we came out of the environment where interest rates were going up and bonds on the portfolio level significantly underperformed. But going forward, it's going to be a very different scenario. Investors now have an opportunity to lock in the rates, lock in the quality for the first time in many years. And going forward, as the rates on the bond side of the portfolio will remain at the high levels, we have to be conscious of the fact that money markets the rates that are variable are going to start declining the moment Fed is going to start cutting rates. So really the defensive nature of the portfolio combines the yield and the income aspect. When we look at the yield from dividend-paying stocks, from defensive areas like REITs, and also of course, the bond side of the portfolio, focus should be on quality, diversification, and locking in the higher yields for longer time frames. So the bonds can have that defensive play in the portfolios.
Katerina Simonetti of Morgan Stanley Private Wealth Management, we thank you very much for joining us. And of course, happy Friday, happy weekend to you. Another piece of M&A news to round out the week. Of course, it's been a strong week for deal making. Apollo buying IGT's gaming business and Every Holdings in an all-cash transaction. And those stocks are just soaring pre-market ahead of that news. You have International Game Technologies up more than 15%. Every Holdings up almost 42%. Apollo up almost 7%. This is not their first deal this week. Private equity back in action. Let's get a look at some of the other stocks moving ahead of the opening bell. Here's Abigail Doolittle. Abby.
In particular, Shonali, we have lots of earnings movers to take a look at. Let's start out with the shares of 3M, the multinational conglomerate, absolutely soaring, up about 7%. They put up a big beat and boost. They beat the top line estimate by 7%, bottom line by 5%. The new CEO, Bill Brown, really doing a good job with the takeover and focusing on growth going forward. Let's take a look at the shares of Bristol Myers Squibb because they are also higher. Another big beat and boost. This stock also up about 7%. Their outlook was taken up for the adjusted profit view for the year to 90 cents from 60 cents. That's really a pretty big guide to the upside for a drug maker, and it has to do with some of the company's newer drugs. And then finally, rounding it out, Deckers. Well, these shares are up more than 13%. I was expecting there to be a big short interest here for a squeeze, but that's not the case. Investors liking the massive beat, the big outlook raise. Some analysts saying that the 10% growth that the company is modeling for in the top line, that may actually prove to be conservative, Matt, because of the strength of both Hoka and Uggs.
All right, interesting stuff. And on the sneakers front as well, Abigail Doolittle, thanks very much for that. Coming up, Ford trying to recover after its worst day in over 15 years. The stock had its worst performance since the great financial crisis. We'll discuss the problems ahead for the automaker next. This is Bloomberg.
The more that you learn about this case, the more it reads like a Hollywood script. The nature of the killings, the execution, the just brutality of it.
It wasn't in the psyche of people that they could be looted because they are considered so sacred.
And we did it the way you do every single investigation. How do you eat an elephant? One bite at a time.
It jumped off the page at me that you could see that there was a Ponzi scheme taking place.
I started hearing mafia, mafia, mafia.
Il sistema è perfetto. Sono gli uomini che spesso non lo sono.
These are the holders of truth and justice. They cannot be possibly be doing this. But then they are. They are. And the evidence is there. It's overwhelming.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Let's get now to high interest, a look at what's making headlines around the world. The Obamas have finally officially endorsed Kamala Harris for president. The video that you see here was posted by Harris on social media. In this video, you can hear Barack and Michelle Obama express their pride and pledge willingness to help the presumptive Democratic candidate to win the presidency. Investors have fallen all over each other in recent weeks to buy the yen, but that could change next week. The bet is that interest rates are finally about to tip in Japan's favor. The market faces, though, a moment of truth as soon as Wednesday, when the Bank of Japan makes a decision on its key rate. And trains to and from Paris were hit by what authorities call a massive attack aimed at paralyzing the network of France's super-fast trains. The physical attacks, including fires set at 3 critical rail line nodes, came just hours ahead of the opening ceremony of the Paris 2024 Olympic Games. About 800,000 passengers will be affected. Shares of Ford are rebounding slightly this morning after suffering their biggest drop since 2008. Investors were caught off guard by an $800 million spike in second quarter warranty costs. Joining us now is James Piccirillo, senior auto analyst at BNP Paribas Exane. James has a neutral rating on Ford with a price target of $12, and you can see they trade still for $11.23. But James, I guess the earnings and especially the warranty costs don't really give you a lot of confidence in Ford's ability to execute.
No, not at all. You know, the expectation heading into that second quarter print was for Ford to follow GM's suit, which is beat and raise numbers on the back of strong pricing, strong mix. And Ford, the problem there this year has a substantial amount of launches, model refresh launches, and that's something that Ford has struggled with over the last 5+ years. And we saw that yet again this quarter with that $800 million in warranty costs, which tied to model year 16 and model year 21 vehicles. So their problems of the past continue to pop up and disappoint, clearly disappoint.
How do they move on from that? You saw management really trying to guide into the future and get investors to look past the quarter, but to the point that you're making here, it's a history here of execution. So what do they have to show to prove that they could turn things around?
Yeah, you know, they have a substantial amount of launches, as I mentioned. Cleanly executing on those launches this year for the second half certainly will help move the tide for them, right? They are, you know, they're a true show me story right now after a second quarter disappointment, and it comes down to these clean launches. Now the problem there for these guys is clean launches thus far have also led to lower volumes, and so you can see volume downside to improve the quality of the launches, and that's also a pillar to our cautiousness on the stock from here. But there is an avenue, and it comes down to execution and showing the commercial-facing business, the Ford Pro business, which this year is going to drive $9.5 billion out of the $11 billion of adjusted EBIT Ford is going to report. That's the business that needs to really be the focus.
Let's talk about how long that might take, because we heard from CEO Jim Farley saying that Ford's now testing vehicles to failure. They're running them at extremely high mileage to find those quality problems. He said, though, it will take as long as 18 months to see the benefit of that. 18 months, does that sound like a realistic timeline to you?
Yeah, it does. That seems like a fair timeline, for sure.
Ford Pro, I noticed that the margins were down slightly, but it's the unit, as you say, that everybody's put so much hope in and Jim Farley has focused on so much. What do they need to do, and why is that business more important than, say, Blue, which sells the consumer-facing F-150?
Yeah, that's exactly right. You've got the Ford Blue segment, the Model E segment, and then Ford Pro. Ford Pro is the crown jewel for Ford. And just in the next 2 years, you're going to see software and services account for 20% of Ford Pro's EBIT. Software and services, that reduces cyclicality, should further improve the margins for that segment. And so there is a lot of positive momentum for Ford Pro. For the other two segments, we covered Ford Blue and the retail, the warranty issues. That business is a show-me story for the second half. And then we can't forget about Model E. This is the EV business. It's going to lose $5 to $5.5 billion in earnings this year. Major struggles. And the question then becomes, We have emissions compliance that needs to be hit by each automaker, and Model E is the force for Ford to be compliant. Otherwise, they have to tap into emissions credits.
Yeah, but very expensive, right? I mean, they're going to lose $5.5 billion on their electric vehicle unit this year. Bloomberg Intelligence put out a figure: 25% of auto loans are underwater. And I imagine that's almost all due to EV sales, right? There's a guy on Adam Carolla's podcast, Matt the Moderator, who bought a Ford Lightning for like $100 grand, and he can resell it now for like 60. That's the story across EVs. When is that going to turn around?
Yeah, I would like to say, for when we think about the health of the auto industry from the lens of auto loans, subprime mix as a percentage of the industry's total auto loan book has never been lower, meaning, you know, the credit quality of auto loans is still very high. The clickbait articles out there would say, you know, will sometimes say default rates within subprime are at all-time highs and have reached peaks that are north of the global financial crisis, which is true, but subprime as a percentage of the total auto loan book has never been lower. And so I'm not, that's not a caution of mine. If we look at 90 days delinquency, that's also at a very normalized level. It's certainly off the very favorable lows that we saw just 2 years ago when we had auto loan grace periods from the industry during the COVID period, but we're still at a very normal rate on delinquencies.
James, we thank you so much for joining us today. Of course, it was a big story with Ford dropping as much as it did. That is James Piccirillo of BNP Paribas Exane. Now, coming up, we're going to take a look at the companies making the most buzz on social media today. That is Social Climbers up next. This is Bloomberg.
Season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. The top names in global leadership are on Bloomberg.
I envisage not only some kind of a bridge towards membership or language linked to the irreversibility of Ukraine's membership in NATO, but also some kind of a broader package of military material, of financial aid. The more we support Ukraine right now, the sooner the war will end.
Nobody covers the top global leaders like Bloomberg.
Biden says the PCE today shows real progress made on fighting inflation.
All right, time now for Social Climbers. The company's making waves this morning. And first up, Dexcom shares plunging after the medical device manufacturer cut its full-year revenue guidance. The stock downgraded to neutral at JP Morgan, with the analysts citing severe and sudden near-term challenges. Now, next up, as we go swiftly along, Coursera shares soaring on a sales beat. The online educational company also surpassed more than 2 million enrollments in its generative AI catalog of courses. Of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Now, coming up, we'll be speaking to Larry Adam. He is Chief Investment Officer over at Raymond James. Why he sees any pullback as a buying opportunity. That's next. This is Bloomberg.
decided to acquire Indeed 12 years ago when I was 36. I couldn't speak English, but I decided to move to the US with my family. Okay, let's study English. Let's, manage this big American company. But I could do it. Ages are just numbers. If you stay being very curious to run new things, you can keep doing that. So what we're trying to adjust is our company should be the praise to maximize people's ability, people's talent, and people's passion, right? Our employees' passion. So we believe that if we can have the work or the vision, people can be passionate, and which is aligned with all what employees.
So 1 minute now until the market on open imbalance.
That's the best way to maximize the people's ability.
Follow your passion.
That's right.
So whether you're 14 or 40 years old.
I think so. Because, what's the difference? I don't know. We might be totally wrong. That's how we have been running this company for 60 years.
Moments away from the start of trading after a brutal week for stocks. So much volatility.
So looking now to the market on open imbalance. The S&P 500 is 320 million to the buy side. The NASDAQ 100 flat at 0 million. The Dow 30 at 50 million to the buy side. All the Mag 7 stocks are flat as well.
You have members of the executive group of Betway, which is now, I guess, leading betting for Manchester City and other soccer games. On the NASDAQ stock exchange, you have NIP Group there ringing the bell. Let's get over to Katie Greifeld right now to see what's going on with the indexes just a few seconds into live cash trading. Katie?
Just a few seconds in, and it's an interesting picture. You can see green on this screen behind me. It feels like a little bit since we've seen that. The S&P 500 currently up about 0.6%. Big tech back in charge, at least for the moment, up about 0.7%. But it's the small caps, once again, 1.5% higher on the Russell 2000. This would be a third straight week of gains for this index, which is almost exactly the amount of time we've been doing this show. So there you have it. But let's take a look at one specific stock, and that is Bristol-Myers Squibb, raising its 2024 profit forecast, increased demand for its new medicines, really giving investors hope that the company has gotten past a dip in performance. You can see that in the shares right now, currently higher by about 6%, Shonali.
Also higher, 3M. You're looking at about a 10-11% rise in the stock as the market opens. 3M raising its full-year profit forecast. It's a sign of progress that the company's new CEO can reinvigorate the manufacturer after a lengthy period of turmoil, Matt.
And NVIDIA back up this morning after the Mag 7 having been lagging the last couple of days. It's been, as I said, a brutal week for stocks. Anytime the Mag 7 are down or NVIDIA is down, that usually means that the indexes fall as well. But we've seen a little bit of a turnaround in terms of the breadth. Let's go over to Abigail Doolittle right now and get a check-in on what's going on. Abby?
I would tend to agree with you, Matt. It is all about NVIDIA this week. The Mag 7, but driven by NVIDIA, because surprisingly on the day when Tesla and Alphabet were down, it was NVIDIA that was the worst drag on the markets. And here you can see it. There was a 7% decline. Yesterday, massive volatility. When markets were at the lows, NVIDIA down about 7%. It then turned higher, ended up closing down about 1.7%. Right now, up about 3% on the day. So a little bit of a rebound today. Let's see if it holds. Lots for this stock and these investors to contend with, though, given the fact that at one point the stock up peaked peak or trough to peak from the 2022 lows about 1,200%. Too far, too fast, especially as growth slows. Let's put this together with the chart, because this past year, the growth on the top line was 126%. The bottom line, 365%. This is expected to slow into the January year end dramatically to 127%. That might be one reason that we are looking at a bit of a breakdown that is somewhat obvious to anybody when you see it drawn with this trend line. The RSI, a momentum indicator, it is heading lower. So long as NVIDIA, Katie, stays below 118, it confirms a pattern that would fill a gap here. You have all these technical measures coming together, suggesting it's very, very likely that NVIDIA will fall sub 100. Stay tuned.
All right, Abigail Doolittle, we'll keep our eyes on those lines. Thank you for that. And let's put it all together with Larry Adam. He is Chief Investment Officer over at Raymond James. I'm going to go straight to this line in your note that we continue to look at these pullbacks as a buying opportunity. Amid all the volatility that we've seen over the past couple weeks or so, what gives you the confidence that you're potentially buying the dip here and not just trying to catch the knife?
Well, I do think we've been looking for a pullback because of some seasonality patterns. There was some over-optimism really baked into investors' sentiment. But I do think when you look longer term, I think earnings are going to be fine. I think we're going to see a broadening of participation, which means that we still like tech, but I do think that earnings are going to
US stocks extend gains, the Dow Jones up 1%.
Towards the end of this year. So that'll help drive the broader market higher. And then don't forget, we have a Fed that's going to start an easing cycle, and that'll hopefully avert a recession here. And as long as there's no recession, I think earnings can continue to move higher and support this market.
Are you not worried about a recession? I noticed today it's a small thing in the numbers, and it's only 1 month, but personal income was only half of what the street was expecting.
Also noting Eurozone government bond yields reversing earlier rises, so Germany's 10-year yield is now down 0.5 basis points at around 2.41%.
And you also saw the savings rate, right? The savings rate was the lowest that it's been since 2022. So clearly the consumer is starting to get crimped. We think that that's why the Fed has to go. They probably should go next week, but they don't like to surprise the market, so they'll probably wait till September. There is a risk associated with that. But I do think one of the offsets is the fact that you are still seeing pretty strong corporate spending, particularly when it comes to AI. And then government spending remains pretty healthy with all of the stimulus that's been put out there. So I think those two indicators, when you look at the numbers, are going to continue to offset any softness that we do see coming from the consumer.
You know, it's interesting. You think back to the Bill Dudley commentary a little earlier in the week saying that the Fed should cut next week because of worries about a recession. And you also are saying that perhaps they can cut next week, but we'll wait. What happens between now and September? As rates stay higher, if they stay higher, then how much more does the consumer get crimped? What are those ripple effects?
Yeah, well, clearly, as I mentioned, the consumer is starting to get crimped. You're starting to see delinquencies moving higher. But I think behind the scenes, you're seeing longer-term interest rates, which have a bigger impact on the economy, are actually starting to move lower, right? The 10-year Treasury yields approaching 4.2%. Hopefully, that'll start to stimulate a little bit more of the housing market. You know, auto sales have been struggling here of late. Maybe that'll start to help those as well. So behind the scenes, we're hoping that you start to see the consumer at least being able to borrow so that they can continue to spend, so that the Fed has time then to eventually cut rates.
And let's fold this all into the rotation trade that we've been seeing in the markets. The Russell 2000 year small caps have been the leader here, actually on track for a third straight week of gains, which is pretty amazing to think about. You think about what's going on in the economy right now. You think about what's going on with earnings. And I've heard a lot of people pin their hopes on this rotation trade to the idea that we're going to see that broadening out in earnings as well. Is that your base case? How are you feeling about it?
That is our base case. In fact, we think that by the end of this year, by the fourth quarter of this year, small cap earnings will be matching what you're seeing from the Mag 7 or the Mag 6 is what we call it, right? I think that that's important. Historically, once the Fed starts to cut interest rates, that's when you see small caps start to outperform. And when I look at valuations are pretty attractive in the small cap space. So from that vantage point, I think that's why you're going to see some of the broadening. And then when you look at the sectors that we continue to think will benefit, meaning healthcare, industrials, technology, you get a little bit of exposure there in those small caps, which should help drive that index as well.
What do you think about energy and real estate, Larry? I mean, if we're all going to be taking part in this AI revolution, they're going to need to have data centers, which take up a lot of space and need a lot of power.
Well, when it comes to energy is another one of our areas that we do like. That's based on the fact that we think energy prices, if you look per barrel, we think it'll go up to about $85 per barrel, which will help that sector. If you look at the corporations in the energy space, what are they doing? They're doing a lot of shareholder-friendly activities. They have buybacks. They're increasing their dividends. So that's one area that I think is still pretty attractive. You mentioned data centers. That's an area that we think will continue to do well. But again, when it comes to real estate, you got to be really selective, right? You know, broadly speaking, if the economy is slowing, real estate will struggle overall. But I do think specific areas like data centers will continue to do well.
Larry, what else do you avoid in this market? I can appreciate buying into pullbacks, but beyond real estate, where else do you stay away?
So we continue to favor the spending by corporations over the consumer, right? As we've been talking about, the consumer is struggling, whether it's because of delinquencies, whether it's the fact that they're probably not going to be able to spend as freely. They're starting to balk at price increases. So that's probably going to crimp the margins of the more consumer-related sectors, both staples and consumer discretionary. So those are the areas that I would probably avoid. Again, I want to be in the areas where businesses are spending. So that's why I still like tech. We like industrials. We do like healthcare. Those are the areas I prefer.
Larry, we thank you so much for joining us. Happy Friday to you. That is Larry Adams of Raymond James. Now coming up, a closer look at the lawsuit the SEC filed against Andrew Left at Citron Capital. That's up next. This is Bloomberg.
Jason Kelly, and this season on Power Players, we're taking you behind the scenes to see how the business of sports has gone global.
I want sports to grow. I want sports to be bigger because we have talent.
And how mammoth value is coming from the smallest of players. 3,184 hits, 431 home runs, and of course the most famous stat that everybody knows, 2,632 consecutive games played. Unmatched career. Why are you doing this?
What we have achieved in the NWSL from an investor perspective over 2 years is the equivalent of what it took other leagues 25 to 30 years to achieve.
You've got to have a business that's sustainable. The only way it's sustainable is got to make money.
There's only one word, winning. You win on the court, you win off the court. And as you do that, you bring people along.
The top names in business are on Bloomberg.
Middle market line draws are basically still about 5 percentage points below where it was pre-pandemic, which means as cost of borrowing went up, people aren't being quite as aggressive. And that's why the economy is slowing down. They're not hiring quite as many people. They're not buying that piece of equipment. They're not doing it because they're a little worried about final demand, and therefore they're being careful, which is unpleasant for your bank, but is okay because the companies don't make them profitable and the credit quality is good.
Nobody covers business like Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on in stocks. We're seeing a gain on the S&P 500 just about 12 minutes into the trade of 0.7%. NASDAQ rising about 0.6%. So not the big pop on NASDAQ that you would have expected from the big jump in futures earlier this morning. Nonetheless, a little bit of a reprieve from the losses we've seen this week. So far this week, the S&P 500 is down more than 1%, and that would be the second more than 1% weekly drop in a row. Katie?
Third week of gains for the Russell 2000, though, so something to keep an eye on there. But let's get to our top calls. Some of the analyst action in focus this morning. And first up, Phillips Securities cutting Tesla to sell. The broker notes that the automaker's near-term margins are expected to be pressured lower by volume, pricing, and EU tariffs. Next up, we have Morgan Stanley downgrading Weight Watchers to equal weight. The analyst cites lackluster trends for its core behavioral dieting app business and its clinical segment. And finally, we have Deutsche Bank upgrading Lockheed Martin to a buy. The analyst says that the company's strong second quarter results point to an attractive beat/raise opportunity in the second half of 2024, Shonali.
And Katie, we're looking at another story here. The SEC announced that they are suing Andrew Left and Citron Capital. The regulator is alleging that Left and Citron committed fraud and made illegal profits to the tune of about $20 million. For more, we're going to check in with Bloomberg's Bailey Lipschultz and talk us through exactly here what the SEC is alleging that Andrew Left and Citron did.
So the SEC and the Justice Department also, they're both alleging that Andrew Left a number of things, but most notably, he came out with calls both to the long and short side, initiated price targets, and loaded up on positions before unveiling that research. The stock would move, and then he'd quickly close the positions to profit very rapidly. So he'd make bets not only on the underlying stock, but also use options, basically saying, at least when you look through the Justice Department press release, saying that he wanted to make fast, easy money using those mechanisms.
Yeah, it's pretty amazing. He sometimes suggested that stock prices would fall by 50% or more, but then actually closed his positions after share prices had only moved a couple of percents. That's according to the indictment. Tell us a little bit more about Andrew Left, though. I mean, what do we know about him, and what's he known for?
He's known for being kind of bombastic. He did actually announced back in 2021 he was on the kind of receiving end of the wrath of the GameStop movement. So he said he was no longer going to make public short calls because he had built out such a vast following with the likes of betting against Valiant, among a broader range of investments that he kind of ended up being right on. But when you look at kind of what he's done and when he kind of started backpedaling 3 years ago, that also was when the SEC and Justice Department started investigating short sellers, some of their relationships to hedge funds. So he's been under the microscope from a regulatory standpoint for quite some time, along with a number of other players in the space.
But some of these allegations have to do with his longs as well, right? It's not all about him being a short seller. And when it comes down to it in the indictment, they're not suing him for shorting stocks. It's really about the way that he publicized his calls and then acted in his own trades.
Exactly. Reading from the SEC press release, they list an example that he said he would stay long a stock until the price hit $65, when in fact, according to the release, they immediately began selling the stock at $28. So coming out with these calls, loading up on positions, basically using his stature on social media, whether that's X or also going on TV and talking about positions, and then quickly profiting from them. According to some of the documents from the Justice Department and the SEC, he basically would put limit orders out. So he would close out those positions even if it kept going or kind of potentially
in the parlance of our times, that would be called a pump and dump scheme.
Yes. Well, even more than that, he was setting up apparently fake websites, wasn't he? To what extent did this go to? And is this a one-off? Yes, perhaps they found this because of that short selling investigation, but it doesn't seem like every short seller is out doing this.
No, well, there's a lot of skepticism around short sellers, and that's kind of to Matt's point. Is it misaligned kind of allegations where you come out with kind of this call that a company should drop 60% and you're going to hold on to that short bet? Or do you close out your position when it drops 10%? So when you look at some of the findings, again, the SEC document saying they found these alleged bait and switch tactics that netted Left in his firm $20 million. So not only did he have those, according to the filings, those accounts to help promote some of his calls, there's also potentially taking backdoor payments from hedge funds that's being alleged in some of these lawsuits, that there was partnerships with something around balance sheet.
Is there anything that we can extrapolate out from what we're seeing in this very specific case, these allegations, to the broader short selling industry? Because you know pretty well that it seems like it's been a dying breed. We've seen less short sellers. A lot of them have gone underground. What's next?
No, I think that we're going to be closely watching to see if other prominent names that were part of these investigations are going to be facing similar lawsuits. Because as you mentioned, it has been a dying breed. You saw Jim Chanos pulling out from short selling and closing that fund. You've seen a number of short sellers who are pretty prominent, either making less calls or just kind of going after smaller companies, whether that's Chinese firms and tiny operating firms that operate offshore, as opposed to some of these bigger names when you're targeting the likes of an Adani Corp, which is what we saw with Nate Anderson and Hindenburg.
All right, Bailey, thanks so much for joining us. Great coverage on this story. We should remind our viewers that these are just allegations by the SEC. In this country, you're innocent until proven guilty. We have contacted Andrew Left, and he didn't have any immediate comment on this story, but if he does, when he does, we'll bring you his response. Coming up, Evercore's deals full fuel record revenue. We're going to take stock of boutique banks and how they're doing in our Wall Street beat. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF.
So in 10 minutes time now, at the top of the hour, we see the release of the University of Michigan July final data. The sentiment final, the forecast is 66.4 on the prior 66, with a range of 68 to 65. University of Michigan 1-year inflation final, forecast 2.9% on the prior 2.9%. 5-year inflation final, also forecast at 2.9% on the prior 2.9%. The expectations final, forecast at 67.5 on the prior 67.2, and the conditions final, forecast at 64.4 on the prior 64.1.
About the things that are outside your control. How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
This is Bloomberg Open Interest. Let's take a look at where markets are trading. And you can see green on the screen, a little bit of a bounce, a rebound here to end the week. The S&P 500 up by about 0.8%. Big tech is your relative underperformer today. The NASDAQ 100 up about 0.6%. Small caps once again leading the way here. The Russell 2000 up 1.7%. I'll say it again. This would be a third straight week of wins, Shanali.
And it's time now for the Wall Street Beat, because there is a class of banker on Wall Street that is certainly winning. We are looking today at the boutique banks, with Evercore posting record revenue this week as a deal-making rebound fueled a surge in advisory fees. Joining us now is Bloomberg editor Matt Monks. And if you think about it, after a slump that we've seen, Matt, in deals recently, the comeback that we've seen seeping through this year, the fact that Evercore stock is hitting a record, Lazard had its best day since Peter Orszag took over as CEO. Are deals really coming back at that speed?
Not yet. We're coming off a very low, right? But if you look at the read-through, is very positive for these three firms that reported this week, right? Advisory fees up, way up, in some instances, 50% for Evercore and Moelis. Lazard, not so great, right? Compensation ratios holding steady, down a little bit. Their business model looks good, hiring talent. They're not going out too far afield from that. And then also the commentary that we heard from them, private equity, looking pretty good. Restructuring, coming back. Got some nice stuff in the equities pipeline. I think that things look optimistic, but you have to keep it in mind this is off a very low.
And I was reading in the Bloomberg Intelligence notes on Moelis, they say sizable additions of senior talent are coming at a cost. So even though there's this, I guess resurgence maybe is too strong of a word, but come back in terms of deals, they're having to pay for talent, and that's going to eat into profits.
So there are, what, a half dozen boutique investment banks, maybe 12, depending on how you look at it. Their business model is very simple. Hire the best people that you can get, go out and win the mandates. They don't have the diversified balance sheet to win that other kind of business. So it really is, it's a talent war, and you have to pay up to win it. They're on a very fine line, though, right? If that activity doesn't pick up to match the revenue that pay for these people, they're in a bad spot. But right now, things look pretty good as far as it goes.
You know, it's fascinating, too, to the point you're making here. You know, a banker at Goldman will say, for example, Evercore is outbidding everyone. That's right. What is the payout to that? Evercore now is actually beating Bank of America, Katie, in terms of the deal volumes that you're seeing this year.
Yeah, absolutely. But to Matt's point, paying up to do that, we heard from Evercore's senior chairman, Roger Altman, really crediting that revenue game to the consistent expansion of senior managing directors. Have to imagine that's a pretty fine line to walk there. But let's look ahead to what's next, because we think about next week, we do have some interesting private equity results coming up.
So listen, when it comes to private equity, I'm looking at it from the private equity front, from the deal-making front, right? I mean, private equity deal-making is the engine of all Wall Street. When private equity shows up, you see deals show up, you see it spike, it reads through to activism, equity offerings, everything. So that's what I'm looking for, the commentary coming out of them. And these guys have had a hard time not only putting money to work, but finding exits. So let's see what the commentary is on that front.
Also, fun fact, guys, KKR was on their IPO this week of OneStream, as well as a debt underwriting. But, you know, beyond private equity, big deals, antitrust, how much worry is there still? Peter Orszag was kind of just shunning it off, but Lina Khan does not look like she's backing off.
It's a huge overhang, right? We don't know what's going to happen if a new Trump administration gets in there. And even if a Trump administration gets in there, it's not clear that the pendulum is going to swing that far in the other direction. J.D. Vance, not a big friend of Wall Street, doesn't love big tech, right? So there will be a little bit of pendulum swing, and no matter who wins, you will see an overturn at some people at the DOJ and the FTC.
It's in 5 minutes time now at the top of the hour. We see the release of the University of Michigan July final survey results. The sentiment forecast 66 spot 4 on the prior 66, with a range of 68 to 65 expected. 1-year inflation final forecast 2.9% on the prior 2.9%. 5-year inflation forecast 2.9% on the prior 2.9% as well. Expectations forecast 67.5 on the prior 67.2, and conditions forecast 64.4 on the prior 64.1.
Earnings from the Federal Reserve, BOJ, and BOE. Sorry, earnings, did I say? Hearings is probably what I meant.
Meetings, whatever.
Earnings. We get big tech earnings.
So according to sources, seeing Lukoil ramping up oil exports via seaports by 680,000 tons in July amid the Druzhba supply suspension, according to sources.
Bloomberg terminal. Monday morning, kick it off with McDonald's. You get JetBlue, KKR.
Also in Russian oil news here, Rosneft and Gazprom Neft add additional 300,000 tons of Urals oil to Russian Baltic loading plan for July, and Russia's oil loadings from its western ports in July revised up by 0.23 million barrels per day now to 1.79 million barrels per day, according to calculations.
This is Bloomberg.
Also noting US crude futures falling as well.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring
Brent
in
crude futures as well, falling more than $1 a barrel on sagging demand.
I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of...
1 minute remaining for US data now. I'll be leading with the sentiment final.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that shortly.
Don't miss Bloomberg's interview with the...
Ten seconds. $66.4, 66 spot 4, lower than forecast 66 spot 5. 1 year inflation at 2.9%, 2.9% as expected. 5 year at 3%, which is higher than forecast 2.9%. The expectations final is 68.8, 68.8, higher than forecast 67.5. We're also seeing the conditions final at 62.7, 62.7, which is lower than forecast 64.4.
Spectators from over the world gather for the Olympic Games. So let's get to these markets about 30 minutes into the Friday trading session. You can see a big rally on our hands. The S&P 500 rebounding from some of the volatility that we've seen this week, up about 0.9%. The NASDAQ 100 up pretty mightily too, up about 0.8%. Meanwhile, you take a look at the bond market right now, a rally building. You can see 10-year Treasury yields below 4.20, now down about 5 basis points or so, I would call it.
All right, I'm looking at University of Michigan consumer sentiment figures coming in pretty much in line with estimates. The headline figure is 66.4 in terms of consumer sentiment right now. 66.5 was what we were looking for, so a little bit weaker. In terms of current conditions, that is significantly weaker. 62.7 is the level.
We have posted out the University of Michigan Sentiment Survey July final report on the feed for anyone interested.
The inflation expectations, which I think a lot of people are watching very closely right now, are bang in line. So going out 1 year, consumers expect inflation at 2.9%, and that was what we had penciled in there as well. Going out 5 to 10 years, consumers are looking for 3% flat, and we were looking for 2.9%. So pretty much in line. Joining us to talk more about this is Ellen Hazen, F.L. Putnam, Chief Market Strategist and Portfolio Manager. And Ellen, we've had inflation numbers that don't look so bad for the Fed. We had the core PCE at the top of the hour, or at 8:30 rather, coming in at 2.6%, which is just a little ahead of expectations, but probably enough for the Fed to cut in September. Do you agree?
Absolutely. Right now, the market's pricing in almost 100% chance of a cut in September, and we agree with that. And as we look farther out, we think there could be one more cut either in November or December, based on the fact that inflation continues to moderate and the labor market looks pretty healthy. So we do think that a cut or two is in the offing over the next several months.
We got to talk about small caps.
US stocks extend gains with the S&P and the NASDAQ up by 1% now.
Third straight week. We certainly haven't seen that for a while. This trade has just not worked until really the month of July. So it seems like you're taking the other side of a lot of the bulls that we've been speaking to, and their argument is that they have the Fed on their side. Really, those rate cuts going to help the smaller companies, and they're really expecting earnings to carry through as well. It seems like that's not necessarily what you're expecting, though.
As I look at the small cap universe, I think there are some positives and some negatives. But on balance, I think the rally has largely run and is unlikely to continue going forward for too much longer. And there's a few reasons why. Number one, if you look at earnings revisions, over the last 3 months, the S&P 600 small cap index revisions have been negative 3-5%. Whereas the S&P earnings revisions have been positive. If you look over the last 6 months, it's an even bigger difference. And so even though the multiple differential is fairly high at 5+ points, depending on how you want to measure it, the fact is that S&P small cap earnings keep getting revised downward. And it's really difficult for stocks to continue to outperform no matter how cheap they start off if earnings keep getting revised downward. You add on top of that the rate cuts are going to be relatively modest. As we were talking about, 1 cut, maybe 2 this year. Not sure if the long end is going to go down very much. And so small caps, as we know, are very differentially exposed to rates. They have more debt, they have more variable rate debt, and that hurts their earnings. And a couple rate cuts is not going to make that much difference for them.
You know, I want to talk a little more about the consumer here because you have that read from the Michigan data, the University of Michigan Sentiment Index. And on one hand, you do have some promising signs on inflation, as Matt was talking about. On the other hand, sentiment overall is at an 8-month low. People keep saying, investors and corporations, that it's really the low to middle income consumer that is feeling the brunt of this pain. But you're even seeing some of those pains move to the luxury sector. You're even seeing those pains being kind of distributed in a mixed way across corporate America. Ellen, what do you think about how this plays out?
The consumer has gone through a roller coaster over the last several years. Everything shut down during COVID. And then when people were stuck at home, they ordered a lot of goods. And then there was the revenge of services once the vaccines came out and people exited lockdown. And so you had services going through the roof. And goods took a bit of a breather. And now you're seeing both of those begin to retrench, right? Look at the airlines. You're seeing disappointing numbers there. If you look at the cruise lines, you're seeing disappointing numbers there. At the same time, as you point out, both the low end and the luxury are seeing disappointing earnings and trends. And so I think that the consumer is a bit exhausted. But at the end of the day, the strength of the labor market is going to override consumer sentiment because as long as people have a job, as long as their wages are growing, they're going to continue to spend, even if both the services and the goods exuberance has led to a bit of a hangover right now.
And let's talk a little bit more about the consumer. We were just speaking with Larry Adam over at Raymond James, actually, and he made a really interesting point that he's looking at the companies where businesses are spending money, those industries. He's staying away from some of those more consumer-sensitive stocks that rely on consumer spending. Is that a useful lens to approach this market through right now?
In general, we look for companies and areas of the market where earnings are growing. And it is true that on the consumer side, you're beginning to see weakness in various areas, which is leading to lower earnings estimates in those areas. And on the business-to-business side, much of which is captured in the industrial sector, although not all, you're not seeing that weakness. And so I do think it's a useful lens to look through because of the fact that it is showing up in the earnings. And that means that you can find areas of the market that are going to be a little bit less exposed to a softening consumer.
I know you, I know you like the semis after the pullback. You think it's okay to wade back into Lam Research, Taiwan Semi, NVIDIA, and Broadcom. What about Emerson? That's one of your picks as well. It's basically a testing company. It's an industrial that you like. Is there any kind of AI play into Emerson?
Primarily, Emerson is a play on reshoring of manufacturing and automation. They've done a lot of portfolio pruning and reorganization over the last several years, so their gross margins are growing by 100, 200, 300 basis points over the past several years and prospectively as well. So to the extent that AI enters factory automation, then yes, Emerson will be a big beneficiary, but I wouldn't put it in the same category as NVIDIA and some of the other companies who are more directly tied to it, I do think it will benefit, but longer term.
Ellen, great to get your take and some of your picks. Thanks so much for joining us. Ellen Hazen there from FL Putnam. Let's get a look at some of the stocks moving at this hour, 37 minutes into the trade. For that, we go to Abigail Doolittle. Abby?
We've got some absolutely huge, massive movers, Matt. Take a look at the shares of Charter right now. Parabolic uptrend on the day, up 17.3%, the best day since 2009. They beat. Their free cash flow is strong, and very importantly, so the subscriber loss was lower. Take a look at this next board. This is really pretty stunning. Each of these stocks beat and boosted in their quarter. Right now, 3M is looking at its best day ever, going all the way back to 1980. They also beat and boosted, but there's a lot of confidence in the new CEO, Mike Brown, and that his turnaround that he's implementing is working, and that growth is ahead. Mohawk Industries up 16%, the best day since 2020, similar beat and boost. And then Deckers up 8.8% off the highs, but nonetheless a strong quarter driven by both UGGs and Hoka. Finally, it's not all to the upside. Let's take a look at a massive decliner. That, of course, is Dexcom, down 40%, the worst day, not surprisingly, ever since 2005 when the company was public. The medtech company cut the outlook after a disappointing second quarter. Investors clearly bailing, Matt.
Yeah, a 10% outlook cut gets you like a $16 billion market cap erasure. It's pretty shocking to watch what's going on at Dexcom. Abigail Doolittle, thanks very much for that. Coming up, we're going to be hearing from the CEO of Airbnb, Brian Chesky. He's in Paris ahead of the Olympic Games, and he's going to talk to us about what to expect from his business as we see a return to gigantic global events like that. This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. Wednesday, the Fed decides.
Who said summers were quiet? I don't remember the last quiet summer.
We're talking about the data not being as accurate during this time of year, an election that's haywire.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Is the answer here, Jeff, that everything is just plain solid?
It's pretty solid, Tom.
At some point, we got to call it a soft landing.
Tune in to Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
Let's get now to high interest, a look at what's making headlines around the world. Apple has lost ground in China's smartphone market, falling out of the top 5 most popular models. Local companies like Huawei surged ahead in the quarter up to June. It's the first time in 4 years that the iPhone has dropped out of the important country's top 5 handset list, with smartphone shipments sliding 3.1% in the quarter to June. Mercedes trimmed its forecast for returns on the back of a subdued outlook and strong competition again in China. The German auto giant chimed in with warnings from other car makers, and after profits during the second quarter declined sharply as the whole industry struggles with a slump in EV demand. And JP Morgan has rolled out an in-house chatbot as an AI-based research analyst its employees can use in their general work. Executives at the bank telling employees the GPT-like chatbot can help with writing, idea generation, and summarizing documents. 15% of the staff currently have access to that. Katie?
All right, the 2024 Summer Olympics in Paris kicks off today with the opening ceremonies happening in about 3 hours' time. Now, the city has seen a surge in short-term rental listings since last summer, thanks, of course, in part to the games. Let's take a look at lodging demand now with Airbnb CEO Brian Chesky, who is there on the ground in Paris alongside Caroline Kono from Bloomberg as well. And Brian, let's kick off here with the fact that you have 15 million visitors expected to be in Paris during the games. Obviously, Airbnb has a big presence there as well. What approximately would you expect the impact on your third quarter revenues to be from this event?
Well, I mean, the first thing I'll just say is this is the biggest single hosting event in the history of Airbnb. We have the number of people staying in an Airbnb here in Paris to fill the Olympic Stadium 5 times over. And they're spending over $1 billion when they're here in Paris. So we're seeing really good demand this summer. I think Q3 is going to be quite strong. And I think this event, the Olympics, is just the ultimate demonstration of the power of Airbnb. Because these hundreds of thousands of people, many of them wouldn't have been able to come here, and certainly wouldn't
Russell
have been able to afford to
2000
stay
hitting
here
more than a 1-week
had it not
high,
been
last
for
up
the
1.7%.
150,000 homes we have here in Paris. And I should just remind everyone, Airbnb started for events, because in large events, there's only so many hotels. And so either you add excess capacity or people don't come.
150,000 rooms on the market. That's about double, at least, that's what we have usually in Paris for Airbnb. Do you think hosts are actually gaining from this? Because a year ago, I remember all my friends saying, I'm going to put my flat on Airbnb during the Olympics and make huge money. But it seems like the rates are not that high, not as high as expected.
Well, the average host here in Paris is making about $2,200 on Airbnb during the Olympics. So that is obviously very, very meaningful income for them. Many of them are first-time hosts, so 40% more listings we have today than the beginning of the year. So this is very, I think, meaningful income for people. But I'm also proud that the rates are somewhat moderated. You know, we really wanted to make sure, we worked with the IOC, and one of the big concerns they had was that the Olympic Games would become unaffordable. So I think the flip side of that is I think the games are much more affordable for people than they would have been otherwise.
Because especially for the luxury side of things, for example, for luxury hotels, it seems like rates are down about 40% from their peak about 11 months before the games. Is that also what you've been seeing with Airbnb, perhaps lowering their rates as we approach the Olympics in order to fill the rooms and to increase the occupancy rate?
I mean, we had a lot of bookings like many, many months ago. And so we've continued to see bookings. I mean, the thing that's really interesting, we have a really long lead time bookings, but we're still getting like thousands of people booking every single day last minute, even during the games for the coming days. So I think the demand has been very, very solid on Airbnb.
Right here, we are in the cloakroom of this iconic Musée d'Orsay, which used to be a train station.
Yes.
It actually was inaugurated in 1900 for one of the last Olympics in Paris and also for the international exhibition. You're offering to fans to stay here tonight.
Yes.
For free.
For free.
That's part of Airbnb Icons.
Yes.
Can you tell us what it is, how you selected those 2 people who are staying here tonight?
Yeah, so icons are the most extraordinary experiences in the world from the world's biggest icons, both people and iconic places. And one of the most iconic places in the world, certainly here in Paris, is this museum. As you said, it was a clock tower that became a museum. The ultimate in, I think, like creativity. To get to this room, I had to walk through a room of Van Goghs and Renoirs and Monets. And behind me is this clock tower, and millions of people or thousands of people take photos of this clock tower, and we thought, what if you could stay here? And so we got the designer of the Olympic torch, which is right next to me, and he designed this room and every single object in this room. And we picked a couple. It was a totally free stay, so you can imagine when something like this is free, it's a truly once-in-a-lifetime experience. Thousands of people apply. We looked through all the applications. We picked 2 lucky winners, a couple from California, and they're going to stay here tonight. And by the way, I just one other thing else to say is, when behind me is this clock tower. If you look down, that's the Seine where the opening games are. If you go into the terrace, you will have quite literally probably the best seat in the house for the opening games just in a few hours.
The opening ceremony, which is actually taking place in 3 hours.
3 hours, yes.
We're going to be here from the Musée d'Orsay. As part of these Airbnb Icons, obviously, this is only a couple staying here, but this is a whole thing you launched in May. You got the Barbie Dream House, you got the Prince Mansion. What's the strategy here in terms of gaining some new sign-ups for Airbnb at a time perhaps when your growth is a little slowing down?
Well, I think that the growth, first of all, is very, very strong, and I expect a huge amount of growth in the coming years to come. But let me just start with Icons. We think Icons initially is a great way to keep Airbnb top of mind, reach new audiences, and also
So we're looking now to the Fear and Greed Index, 45 out of 100, which indicates neutral, while the Crypto Fear and Greed Index is 68 out of 100, indicating greed.
Just about accommodations. I think the ultimate Airbnb.
We're keeping an eye on the VIX as well.
And we're going much deeper into experiences. So right now,
the VIX currently down around 6.4% at around 13.5
how can we
points.
take the magic of Icons and bring it to millions of people? And I hope this magic that you feel in this room is something that people will be able to experience around the world.
Obviously, there's been some resistance in some other places about Airbnb. For example, Barcelona in Europe recently, where we saw some protests. There's also discussions about perhaps banning Airbnb altogether from 2029 for at least some of those apartments in Barcelona. What's your reaction to this?
My reaction is that we ultimately want to make cities stronger. You know, I think we provide economic impact. The vast majority of hosts on Airbnb are regular people making supplemental income. The city becomes more accessible people. We try to make sure people are distributed throughout different neighborhoods. But ultimately, we want to be wanted in a city. We're in 100,000 cities and towns all over the world. And so cities have a right to choose how they want Airbnb to exist in their market. I think throughout these 100,000 communities, you see that the cities that embrace Airbnb, I think, thrive the most. And the cities that don't embrace Airbnb, like New York, which Airbnb is no longer in for a short-term basis, housing prices are not down, but hotel prices are up. So I think we've run this experiment. And I think the cities like Paris that embrace Airbnb are the ones that thrive the most.
Airbnb has taken a diplomatic approach to regulation, New York City being an exception, as you just mentioned. And you recently invested more resources into access to or British access to home ownership. Is that some kind of a mission that Airbnb is pricing out some people out of certain neighborhoods?
I think it's so complicated. It really, I hate to make a generalization. I started Airbnb with my co-founder because one weekend we couldn't afford to pay rent. Millions of hosts, we have 5 million hosts on Airbnb. So many of them tell us that they use the money on Airbnb to be able to pay their rent, to be able to pay their mortgage. That being said, I don't want to be one of those tech founders that just defends the business and says everything we do is good all the time. If you build a platform and hundreds of millions of people use your platform, it's going to be used for unintended consequences. For most of our platforms, most of us believe the vast majority of things happening is good. But if we believe everything is good, then we're being naive. But at the same point, it's important that people understand the majority of people are regular people renting their home they live in or their second home, and they're hosting guests from around the world, many of which would have never been able to travel and stay in that city. Ultimately, I think that's a very important thing for the world.
And Brian, before we let you go, we have to ask about U.S. politics because, of course, we're 3.5 months away from the November election. We've seen a lot of tech founders, in particular, come out in support of the Republican Party. And I'm wondering, from where you stand, have you thrown your support behind either candidate at this point?
No, I've not, and I'm certainly not going to wade into that this time. You know, I think it's really important for me to focus the narrative and our attention of Airbnb on what we can do for hundreds of thousands of people in Paris, and that's what I'm focused on.
All right, Brian, really appreciate the time there. That is Airbnb CEO Brian Chesky, and of course, Bloomberg's Caroline Kono in Paris. This is Bloomberg.
So Japan strengthening as much as spot 5% to 153.15 to the dollar. So again, just some weakness in the dollar yen coming through here.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
What we try to do is combine some of our insights from the fundamental business with external and data set signals. And I think that's a lot of times where the opportunity is.
Let's get a check here on these markets now because, of course, we are seeing a bit of a rebound. The S&P 500 up 1%. The NASDAQ 100 seeing not as much of a lift, but a lift nonetheless, 0.8% higher. Yields across the curve getting a bid, really. The 10-year yield below that 420 mark at 419, 4 basis points lower. We are still down on the week for the S&P 500. I must say, we are up on the month for the Russell.
Yeah, it's interesting, again, trying to weave together the economic data with the earnings, and we have a great earnings example today. You take a look at 3M, for example, jumping by the most in 36 years after they raised their profit forecast. On the other side, Dexcom just having a biblically bad day.
It's amazing. Yeah. So I think the Dexcom thing, the 3M story is amazing, right? The biggest jump in shares in history. But Dexcom is a company that's gotten punished extraordinarily for what looks like a small reduction in its full-year sales forecast. They had said previously they would earn as much as $4.2 billion or as little as $4.2 billion in sales. Now they're saying that could actually just be 4 even. So a $200 million cut, and the market is erasing $17 billion of market cap from that company. It's just unbelievable.
Well, I feel like it really speaks to the environment that we're in, really investor psychology right now, where if you miss on earnings and God forbid you lower your guidance, you're going to get punished. We saw that with Nike a couple weeks ago as well, just really dramatic moves for those who don't meet the bar.
It's all in pair trades, and next week is super interesting when you think about McDonald's, Starbucks, more on that consumer. We don't know how the consumer is exactly exactly doing right now. They say they're optimistic about the future, sort of, but sentiment is at an 8-month low. Let's see if they're buying burgers.
Yeah, or lobster rolls.
Or lobster rolls.
Coming up, seafood prices are on the decline. We'll speak to the founders of Cousins Maine Lobster next. We'll ask them about inflation. We'll ask them about starting a successful restaurant chain, and we'll ask them about hiring. This is Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
This morning's PCE data coming in line with expectations, but inflation is sinking in the seafood industry. Since the start of last year, fresh fish and seafood prices have continued to come down as many feel restaurant pricing is climbing. Joining us now to talk about this is Sabin Lomack and Jim Salikas. They are the founders of Cousins Maine Lobster, a leader in the fast casual seafood industry with over 60 food trucks across the U.S., and they are cousins. Guys, thanks so much for joining us. Sabin, let me start with you. Tell us about the business. I think it's a little over a decade old. How did you start it, and how's it growing?
Yeah, we started 12 years ago. My cousin Jimmy and I were reminiscing over some drinks in Los Angeles. We hadn't seen each other in years, and we grew up together in Maine. And we really just wanted to recreate our childhood. We realized that lobster was special to us, special to our family. So we said, what's the easiest, quickest, cheapest way we can do it? A year later, we opened a food truck. And for the last 12 years, we've been running uphill. And now we're going to be approaching about 100 units by the end of the year. So it's been crazy. It's been fun. And really, we accomplished our mission.
Jim, tell me about, I mean, it's an incredible success story, and as a lobster fan, I follow it along, and I'm always Googling, you know, on your website my zip code to see if any trucks are in my area. But what have been the struggles? What are the most difficult things of building a business like this over 10 years?
Yeah, I mean, listen, number one is our product is wild caught. You know, it's not like we're building trinkets and we can produce more. This is coming off the ocean floor. And so we're always working on projections to make sure we have enough supply secured and procured for years to come to make sure that we can take care of our growing system. You know, the other piece of this is we started with one food truck, two cousins. You know, we had a couple, 4 corporate trucks. But when we started franchising the business in 2014, you know, it took the business to new heights, but we were learning an entire new business within the business. Being a franchisor is really hard and complicated. And you've got to make sure at the end of the day that when we open in new markets with new franchisees, that the integrity of the business and the brand that we built is going to be the same for customers, for franchisees, that food quality and overall experience.
What is the biggest difference for you guys between last year and this year? We were sitting in an era where inflation was roaring. People were really struggling, both from the consumer side and businesses looking to get access to any materials. How do you feel today?
Yeah, you know, in terms of, for us, ever since COVID, I mean, COVID was in the days of inflation, the prices soared. You were wondering about the scarcity of product. How would that work? And for us, our business actually kind of took off even more because by the nature of we're outside, people can, you know, be 6 feet away from each other, and it was kind of grab and go. Today, we're really thankful, as we have been for the 12 years of the resource of the Maine lobster industry, the product itself, the species, where we feel strong about the supply that's happening here in Maine. You know, the landings are a little bit slower out the gate this year. But that always comes on. It can come earlier, it can come later. So we actually had a little bump in price, but we really expect that as more landings come in here in the next month or two, that may subside a little bit.
You know, it's interesting. They always say never do business with family. You guys were able to, over successful business, really stand out on Shark Tank early on. Sabin, what does the fight look like in the Cousins family?
Dow Jones hitting a 1-week high, lost up 1.5%.
And strong than Jim, so it's really not that difficult for him. You know, all things aside, we do hear that don't work with family. And it's hard to work with people or family. It's a marriage. Jim and I did a personality assessment test early on because we wanted to find out where we would bump heads. Most certainly because we didn't want to disrupt our family life. And I think that's a really good job of maintaining the fun and the kindness and all the things that are important. But, you know, I'm saying marriage, Jim. So, you know, I put up with this stuff.
Isn't that lovely?
It's very hard, we'll say.
Sabin's personality test.
You know, you guys sound a lot like my cousins. That is Sabin Lomack and Jim Wiskis, founders of Cousins Maine Lobster. Thank you both very much for your time. Now I want to bring you some news crossing the terminal where Apollo and banks are discussing restructuring for Brightspeed debt. We're going to be up to speed on this. Remember, the private market is coming back. There are some deals out there in the market that could cause some banks to take a loss on the debt. That is including Bank of America and Barclays that are banks here alongside of Apollo holding those restructuring talks.
All right. Meanwhile, General Motors unveiled the newest version of its C8 Corvette in Miami yesterday. I spoke with President of General Motors, Mark Royce, on the latest issue of my podcast, Hot Pursuit with Hannah Elliott.
You know, Corvette and C8 is designed from day one to be accessible to a lot of different folks at different price points. And, you know, right now, 50% of the market is sports cars. So, and we're doing it very profitably. So we have the formula pretty well understood. And, you know, I want everybody to be able to enjoy these cars. And, you know, I don't think Corvette or Chevrolet stands for anything else. It's not farmed out. It's not somewhere else. It's not $500,000. It's a pretty thoughtful progression in price that matches the performance.
Joining me now is my co-host, Hannah Elliott herself, out of Los Angeles. Hannah, tell us a little bit more about this amazing car. You and I have driven other versions of the 8th generation of Corvette. This one is just off the charts in terms of power design.
Well, simply put, it's great news for Corvette because this is the most powerful Corvette we've seen to date. Of course, it's the T8, but it's the ZR1, which is the highest variant. It's got over 1,000 horsepower, 160,000 horsepower. And it's the first that we've seen with turbocharging on that V8 engine. So it's going to have a bit of a different power band, but like Mark told us, I think it'll drive incredibly. The other really interesting thing about it is it has a split rear window, which, if you remember, we haven't seen since the second generation of the Vet in the 60s. So that's kind of exciting. I actually really like how it looks.
Yeah, I'm pretty into it as well. I love just the base model of the Corvette, but this thing is, in my opinion, absolutely a supercar. You can do the quarter mile in less than 10 seconds out of the box. Top speed of over 215 miles an hour. What do you think we're going to see, for example, at the Nürburgring? I think they're testing later on, and when are they going to come out?
Well, that's a really good question, and of course, we've asked Chevrolet what can we expect from their lap time. They haven't finalized testing, but they have told us that they're benchmarking against, of course, Porsche 911s, a couple Ferraris, the 458 among them. So we know those are what they're tracking down, what they're shooting for. In terms of production, that's going to start in 2025. They haven't announced pricing yet, but I think you can expect that this will cost a pretty penny. Pricing will be announced closer to production as well.
All right, thanks very much for waking up early on the West Coast for us. Hannah Elliott there, my co-host on our podcast, Hot Pursuit. It's the weekly podcast for car lovers. You can check it out on the Bloomberg Terminal or wherever you get your podcasts. You can get it on Spotify. You can get it on Apple Podcasts. You can get it online. Coming up, as top bank regulators weigh the Biden administration's overhaul of capital requirements. That's a real turn there. We'll speak with Sheila Bair, former chair of the FDIC. This is Bloomberg.
In global leadership are on Bloomberg.
We are 40 millions. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish...
Brent and US crude futures falling more than $2 a barrel on China demand
You
slides.
should tell us today, because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood, we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone. Only our lives are at stake here, and nobody can just trade our lives.
Nobody covers the top global leaders like Bloomberg Television and Radio. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. The top names in global leadership are on Bloomberg.
I envisage not only some kind of a bridge towards membership or language linked to the irreversibility of Ukraine's membership in NATO, but also some kind of a broader package of military material, of financial
aid. The more we support Ukraine right now, the sooner the war will end.
Nobody covers the top global leaders like Bloomberg Television and Radio. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Good morning from our world headquarters in New York. I'm Menace Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
I think rate cuts are definitely coming. I just think that at this point, there's not a really strong case for waiting. If the Fed doesn't cut in July and waits till September, it's not going to have a huge effect on the economy's trajectory, except the fact that when the unemployment rate starts to deteriorate, it seems to be a reinforcing negative feedback loop. Jobs are lost. People pull back on spending. That leads to further cuts in employment.
That was Bill Dudley, Bloomberg opinion columnist and former New York Fed president, speaking yesterday. Remember, Dudley's comments come ahead of next week's FOMC meeting on Wednesday. And for more on what to expect, we are joined by Sheila Bair. She's the former chair of the FDIC, of course, especially during the financial crisis, of course, the senior fellow at the Center for Financial Stability. And you think a lot about Dudley's comments here was really rooted in the worry about a recession if you did not see a rate cut soon enough. Do you share those concerns?
No, I think the Fed's handling it right. It sounds like they're going to stand pat next week. They should. A lot of this is just reverting to pre-pandemic norms. So it's, I think we want to, keep our heads here and not unduly panic. And I do think, not certainly with Mr. Dudley, who I have a lot of respect for him, worked with him a lot during the great financial crisis, but I do think a lot of this Wall Street clamoring for rate reductions is really more, they're saying it's for Main Street, right? Get those credit card rates down, but it's really for them because that will boost their asset valuations, maybe generating some refinancing income, they've got distressed borrowers, help them. I mean, it will be a clear boon to Wall Street when rates start to go down again, but it's not clear it is for Main Street. What Main Street is hurting, those credit card balances are high because of inflation, because it's more expensive to live these days. And that hits everybody, not just borrowers. So I think the Fed is handling this right.
Well, Sheila, that's so interesting to hear you say that, because the point has been made again and again that the medicine is worse than the illness at this point. You're taking the opposite view here, that actually, no, inflation is the main thing that consumers are suffering from right now. It's not necessarily those higher interest rates.
No, I don't think it is. And, look, rates are not high by historical standards. These are kind of normal interest rates. And there are benefits from higher rates. You get more disciplined capital allocation. You reduce incentives to lever up. And that's painful because we had a lot of leverage build up during the long, protracted era of ZIRP. And so people are having to deal with that now. But higher rates are actually productive for the economy. Low rates hurt productivity. There are a number of academic studies that show that. So there are economic benefits to it. And but I also think any kind of incremental reductions in rates, and I think at some point the Fed can nudge them down a bit, but how much that's going to flow down to help Main Street is a question for me. And I think the real problem is we've had some real wage growth, thank goodness, but things are more expensive. We need to focus on real wage growth as a way to empower consumers, just not more debt, whether it's 25 basis points less or what have you. And housing, mortgage rates, which is the other area that Wall Street targets, that is a supply problem. You lower rates, fine. You're going to juice demand. It's still supply constrained. You're just going to get home prices going up more. So that doesn't help Main Street either. So I think we need to look at the root causes and stop, saying that monetary policy is the solution to all these problems.
I mean, higher rates should also encourage more savings, right? Theoretically, you've got a rainy day fund. You're getting 5.5% on your CD or whatnot. Sheila, I wonder though about your confidence in the Federal Reserve's independence. Some people running for office right now may want to weigh on the Fed more heavily than others. Are you concerned about Fed independence?
Well, I am. I mean, Mr. Trump clearly is not going to be respectful of Fed. He's already, pressuring them to. He doesn't want them to lower now. He wants them to lower when he becomes president, if he becomes president. So yeah, but I have a lot of confidence in the current Fed. I've not always agreed with them, but I have never questioned that they have political motivations behind the decisions they're making on monetary policy. So I do, it's going to be all about the leadership. But if Mr. Trump comes in, there are strong statutory protections against Fed independence. I think if he tries to assault that independence, there could be a significant legal barrier to doing that. And if it's Kamala Harris and if she wins, that's kind of an unknown. Mr. Biden has respected their independence. I hope she would continue to do the same.
I want to switch gears here and talk to you about an opinion article that was written in Politico this week, and it's entitled, "Why is the Government Encouraging a Taxpayer Bailout?" The idea here is that mortgage origination and servicing has really moved out of the banking system. This is the system here, of course, that the federal regulators really oversee, and out of the purview for the most part from these regulators. Just this week, one of the companies named, Mr. Cooper, became even more powerful by buying a set of assets from New York Community Bank, arguably embattled a little bit at this point in time. How do you feel about this move from the banks to the non-banks and the move by regulators to really try to backstop this system?
Yeah. Well, I think it's unfortunate. It bears repeating over and over again that the majority of these toxic subprime loans that cause so much heartache for families and so much disruption in our markets, the majority were originated by non-bank lenders. So the irony that they go from about, 34% to 2/3 of mortgage originations now is supremely ironic, and the servicing has moved too. It's about 4% during the crisis. Now it's well over half. So this is a problem with bank regulation. When you just clamp down on the banks, and capital requirements on mortgage servicing rights, I think, are part of the reasons why the servicing have also moved to the non-banks. But you just force this activity into less regulated sectors. And then to have an answer, okay, we're going to clamp down on the banks, we're going to push this, and not to say we didn't need more capital, we did, of course, but you can't do that in isolation without paying attention to kind of risks that are being created when it moves out of the banks. So this is a problem. They need more prudential supervision. They don't need bailouts. And there are plenty of tools now. I used to be the chair of the Fannie Mae board. Fannie, Freddie, Ginnie can set standards. They do set standards of financial integrity. Their businesses are at risk if these mortgage servicers get into problems. They could strengthen those requirements. FHFA could help them with that. And so I think there are current tools. It would be great if Congress provided more direct regulatory authority over them. But pending that, I think the tools are there now, and that's where the focus should be, not on creating bailout funds.
Right.
I mean, that's just, if the Fed thinks or FSOC thinks Mr. Cooper's is systemic, there's a process called Title I designations. They can designate Mr. Cooper's as a Title I systemic entity, put it under the Fed's supervisory regime, make them have a resolution plan, increase their capital requirements. Those tools are there if they really think these servicers are systemic.
I think this is an important conversation because, I did ask at one point, even J.D. Vance, if the private equity community and the private credit community and the non-banking community at large needs more regulation. And he agreed.
So in 10 minutes time now at the top of the hour, we get the Canadian budget balance. Prior was a deficit of 33.59 billion.
Been tangled in a web of bank debt. Bloomberg reported this morning that there are banks looking to restructure one of those debts. For example, Brightspeed, they might be stuck with losses on their books. Is there a deeper connection than meets the eye between the private community, non-banks, and the banking system that regulators are not privy to?
Yeah, I think there absolutely is. There's a real lack of transparency around what the exposures are on these private funds. My gut tells me they use leverage on leverage. The conventional wisdom is they rely much more on equity financing or less leverage than banks. I don't think that's the case. And here again, banks have tremendous lending exposure to them, as a lot of the lending and other financial services have moved out of banks driven by the capital regime and the lack of those capital requirements in the non-banks. this business has gone out, but the banks are still lending to the private funds that are now doing this. But the capital treatment is more lenient because they basically do it on a collateralized basis. The exposures are structured differently than just making loans and holding them on your balance sheet. So again, it's a phenomenon of only slapping regulation and tougher standards on the banking sector without looking at what you're doing on the non-banks. And at very minimum, we could impose tighter requirements, things that the banks should know about those private funds, having a holistic view of their financial position, not just looking narrowly at the collateral. And gosh only knows, they probably bought that collateral with the loan. Who else has a claim on that collateral? They don't have good. The banks don't have it. I don't think the regulators have it too. And I think FT had a very good piece on this, kind of breaking down all the different financial engineering that's used to pile leverage on leverage in these funds. And it doesn't, we talk about recession risk. I worry more about that. So much private credit has shifted into the non-bank sector. And if that sector implodes and that flows back into the banks, then we are going to have a real problem. Then we are going to have a deep recession along the lines of what we had in 2008.
Unfortunately, I have to leave it there, but something to rediscuss very soon. Sheila Bair, formerly of the FDIC. Stick with us. This is Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that.
Don't miss Bloomberg's interview with the
The top names in business are on Bloomberg.
Middle market line draws are basically still about 5 percentage points below where it was pre-pandemic, which means as cost of borrowing went up, people aren't being quite as aggressive, and that's why the economy is slowing down. They're not hiring quite as many people. They're not buying that piece of equipment. They're not doing it because they're a little worried about final demand, and therefore they're being careful, which is unpleasant for your bank, but is okay because the companies don't make them profitable and the credit quality is good.
Nobody covers business like Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Well, it's the third straight week of multi-billion-dollar inflows for BlackRock's Russell 2000 ETF. The ticker there is IWM. And for more on the flows, we're joined now by Bloomberg's Emily Grafeo for this ETF Friday. So even beyond IWM, even beyond the small
In 5 minutes' time now at the top of the hour, we expect the Canadian budget balance. Prior was a deficit of 33.59 billion Canadian dollars.
AI Mag 7 names and into small caps, but also a broadening out on the sector level. If you look at RSP, this is Invesco's equal weight S&P 500 ETF. It took in over $600 million this week. And like you said, the small caps taking in over $2 billion this week, the third straight week of a multi-billion-dollar flow. And the performance is there too. That fund is actually poised for its best month all year in flows, and it's beating SPY by over 10 percentage points last month. I'll also say, though, we're not seeing a complete rush to the exits. This week, at least, SPY, VU, and IVV, all of the S&P 500 ETFs, all took in positive inflows. We're actually still seeing some semiconductor ETFs, Soxal, and also SMH from VanEck taking in positive flows.
SMH. So there you have it. It's a broadening out, not exactly a rotation there. Bloomberg's Emily Rufeo, thank you so much. And tune into ETF IQ every Monday. That is at 12 p.m. Eastern. Now, coming up on Monday on Open Interest, pleased to say, over the next week, we'll be joined by Kate Moore of BlackRock, Henrietta Trees of Veta Partner, and of course, Mark Rayfield of Saint-Gobain North America. A lot to look forward there to. After a very volatile week in the markets, of course, we have the Fed next week as well, so we'll see what all of that holds. This is Bloomberg.
It is.
Liquidity is the lifeblood of an airline. We make very conservative decision making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well, because things
1 minute
change
remaining
by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This
10
is
seconds.
Bloomberg. From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde.
1.1 billion at a surplus of 1.1 billion.
Live from London and San Francisco, this is Bloomberg Technology. Coming up, we'll have full market coverage after a wild week for tech stocks.
Plus, Apple losing ground in China. We'll break down why.
And as the Paris Olympics kick off, they brace for an onslaught of cyber attacks. But first, let's check in on these markets. An extraordinary week. In fact, we have been down for 3 straight weeks on the NASDAQ 100. This week, we lose about 3%. It is the worst week, well, only since the previous week, since last week, Ed, but we are trading basically at the low since May, and we've wiped off a ton of market capitalization.
Yeah, and I think a big part of the story is the Magnificent Seven. I think you've already shown this Bloomberg terminal chart this week, Caro, but it's kind of the go-to. You know, in the past 2 sessions, Wednesday, Thursday, almost $1 trillion of market cap are raised, and that has a broader impact on markets at an index level, but I think largely Google, which we'll talk about later in the program specifically, and volatility in NVIDIA, it's still top of mind for so many investors. So let's talk about it. Joining us for more is Anthony Saglimbeni, Ameriprise, sorry, it's Friday, not enough coffee, financial chief market strategist. The market volatility, it gets you, it gets me. Anthony, welcome back to the program. I mean, I've framed it in a very specific way. We're still micro-focused on the Mag 7, whether it's a weighting consideration or whether it's just a news flow consideration. For someone like you looking at the markets, is that still truly the case?
Yeah, I mean, I think the next few weeks are all about earnings. We're going to have a big week. If you thought this week was volatile, wait for next week. We have Microsoft, Apple, Amazon, Meta. All of these companies are reporting. They're about 1/3 of the NASDAQ by market cap weight. And so there's going to be a lot of attention on the earnings from these Mag 7 names. And when we get later in August, we're going to see NVIDIA. And that's been the big story in the first half of what's been driving the market higher. So I think there's a little bit of trepidation around earnings season. I think the earnings are going to be fine for the Mag 7. But there's certainly some trepidation if they're going to meet kind of the whisper numbers and the expectations that have been set, which are very high. Valuations are very high in these Mag 7 names. And I think the market's starting to pay a little bit more attention to all the stocks that didn't keep pace with the Mag 7, financials, small caps, cyclicals outside of tech. These are the areas that are driving the market right now.
Anthony, have you been one of those who've thought that the valuations have become silly, absurd, or have you actually thought there was reason for NVIDIA getting to its $3 trillion market cap?
Yeah, I think it's fair to question some of the valuations of big tech right now, certainly based on, AI and some of the payoffs that may take a few more quarters or years to develop. And so I think it's right for investors to question some of the valuations, but I also think the secular drivers of artificial intelligence are real, and I think they will generate profit for these companies. They're already generating profits for companies like NVIDIA and Microsoft and Alphabet. It's just the question, are they meeting elevated expectations right now? And it's normal to see over the course of a cycle, investors kind of get ahead of where the profits really are. They take those expectations back. Provides an opportunity for investors to look at some of these stocks that have really moved higher, maybe at a little bit cheaper price. And so if you have a balanced view of both growth and some of the cyclical opportunities that have developed, I think you can use a pullback in big tech as a means to put more dollars to work.
Anthony, one reason that we watch Alphabet, the parent of Google, so closely is largely because it goes first, right? And it gives us an indication of how cloud will do, but also advertising will do. And then that sets us up for this week, next week, that you perfectly framed for us. But there is more to the market than just earnings. Are you able to apportion some weighting to how much the market is looking at the rate cycle against what the Mag 7 do in terms of EPS growth?
Yeah, I think it's a great question. Obviously, in the first half, there was a lot of questions about the economy, inflation, interest rates. And so a lot of investors piled into big tech because the profits of these companies were very visible. I think what we're seeing in the second half, or at least at the start, is that there's a little bit more clarity or certainty about a soft landing. Interest rates look like they might come down starting in September from a Fed rate cut. Inflation is moderating lower. We saw that in the PCE data this morning. And so I think there's a little bit more confidence in the other, 493 S&P 500 companies that their profits and their outlooks might actually improve in the second half. And so that macro backdrop that was a little bit more uncertain in the first half is starting to get clarity in the second half. And I think that's why you're seeing some money rotate out of big tech and those magnificent seven names and into some of the areas like small caps and financials and industrials and materials, which are performing better today. I think investors are starting to give those areas a second look.
Anthony, the reason we love your experience over the last couple of decades is because you don't just look at certain equities or asset classes, but you look globally as well. This rotation, it's kind of been happening in the Japanese names have sold off, European chip makers too, and I'm interested as to whether or not you're seeing some global narratives build as well.
Yeah, I think it's a great question. I mean, you're certainly seeing normalization in terms of economic growth patterns, inflation, and interest rates, not only here in the U.S., but in Europe, in Japan. Japan will have their their BOJ meeting next week. They're talking about actually normalizing policy by hiking rates. In Europe, you've seen the ECB cut rates in June. They're on pace to cut rates again in September. That's because there's this balance between growth and inflation. And think about the narrative over the last 2 years, not only in the U.S., but across the globe, of really high inflation, really high growth, and really high interest rates. And what we've seen over the last 6 to 12 months is more normalization in inflation, the opportunity to normalize interest rates, and a pretty solid economic environment in Europe and in Japan. These areas are performing well and could continue to perform well if investors look for that cyclical trade outside of big tech, which is really dominating U.S. indices.
Anthony, it's always great to catch up with you. Happy weekend. Anthony Seglenbeni of Ameriprise Financial. We appreciate it. Meanwhile, coming up, Apple losing ground in its key China market. We're going to be breaking down the iPhone's decline next. And what are you watching?
I'm looking at another Chinese name. In a week that's been, let's be honest, pretty rubbish for electric vehicle makers, CATL, which is the world's biggest maker of EV batteries, is bucking a trend. They actually reported a pretty impressive second quarter net income number. So while we're all down about EVs, the battery maker's doing well, and its peer LG Energy Solutions hadn't done as well. So it's really hard to understand this story, but it's one name that we watch over in China, given it's the world's leader in EV sales. Be right back. This is Bloomberg Technology.
In tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself, actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
Apple's losing ground in the China market, with the iPhone officially falling out of the top 5 in the nation, according to new data from IDC. Let's break it all down with Bloomberg intelligence analyst Anurag Rana. That's a very interesting table we're showing. And there's actually a chart within the Bloomberg News story that shows the sort of slide in position that Apple has had. Relatively short term, Anurag, right? I'm thinking towards the end of 2023, over a 6-month period. What does the data tell you?
Yeah, I mean, a couple of things. I would say this, when it comes to Apple and China, we know over the last few years the growth has not been there. But the comment I will take you back to what they said in their last earnings call is they grew in China, while all third-party data providers were saying that, China shipments are down. Now, there is always a timing issue in terms of, when the product is shipped out of the warehouse versus when it's activated, when it's recognized as revenue. So I think next week's earnings is going to be extremely important to see what's really going on in China for Apple. And I think because, to be fairly blunt, that is the most important thing for over the next 12 months for Apple, far more than, anything else at this point.
The way in which the IDC tracks the data, whether it's government, whether it's actually seeing what third parties are really up to, we can sort of try and dig into the nuance there, Anurag. But the overall narrative seems to be that Apple loses position and Huawei gains. Is that the right one to make?
Oh, yeah, but that's because over the last 12 months, we have seen a massive upgrade in Huawei phones. But there's a reason for it, because Huawei hadn't, launched a phone for several years. So the people who had the older phones were going out to go out and refresh that or buy the newer ones. Whereas, as we know, for Apple iPhones, we are seeing an elongation in the refresh cycle because the product's been, a far more reliable product as well as it's expensive. So people are keeping it longer. So that's really has been the biggest issue for Apple for over the last, I would say, 2.5 years or so.
The domestic Chinese handset makers are a factor here, right, Anurag? And Bloomberg's reported about government policy directing government employees or state-backed enterprises to leave the iPhone at home. How do you model that at Bloomberg Intelligence, that kind of policy perspective?
Yeah, and again, as I said, going into the last quarter earnings, all of these things were, at play at that time too. Meanwhile, Apple came out and said that they grew in the Greater China region, and that's why I am more inclined to wait for Apple's comments rather than any of the data sources. But having said that, I think Apple is going to have a bit of a tough time if you see the Republican, president coming in, because if the China rhetoric is going to go up over the next 2 to 3 years, Apple's going to be right in the middle of the US-China issue. So I think really Apple's not as clear-cut at this point compared to, let's say somebody like an Amazon or Microsoft in terms of the visibility over the next 2 to 3 years.
Of course, we had that reporting earlier in the week that Micron and Apple executives were visiting China of late and talking to government officials. Anurag Rana, great to have some time with you. Bloomberg Intelligence, we thank you. Meanwhile, let's just talk about how politics is affecting China-US relationships a bit more. China-based ByteDance is going all out in Washington to keep TikTok from being banned, with lawyers, lobbyists, and, of course, with money. Joining us now with the details, Mike Shepard, you understand more than many the intricacies of US and China relationships. And TikTok is just fighting this hard because they have to or they're going to be out.
This is really existential for TikTok and for ByteDance to be able to maintain this kind of access through TikTok and its 170 million users to what may be the most lucrative advertising market in the world. And TikTok is not going gently into that good night in the face of this law that was passed and signed in April. It requires the company, the app, to be sold by ByteDance by January 19th, or it will face a ban on its U.S. operations. And that would be devastating to the company and also to U.S. users who have really grown to depend on it, not only as a source of entertainment, but also as a source of income and business. There are many small businesses who are active on the app as well, and TikTok is deploying them, too, as part of this campaign.
Mike, there's an issue of language here that I find just crucial. That when this law was passed in April, it was a divest or ban law. And it just seems like the divest part is just not a talking point for TikTok or the US government at this stage.
I'm glad you brought that up, Ed, because when you see, for example, Vice President Harris joining TikTok as of yesterday to help boost her campaign against former President Donald Trump, what we are seeing is that there is great utility in this app. The app itself is not the issue. It really is the ownership. However, we are seeing zero movement when it comes to a sale. ByteDance says TikTok is not up for sale. The Chinese government has expressed objections to any idea that this crown jewel of ByteDance would be forced to be sold by the U.S. government.
Bloomberg's Mike Shepard, who leads our coverage of tech and politics. Thank you very much. A story that Mike just mentioned in the context of TikTok. Vice President Kamala Harris officially joined the app with her first personal account since she began her presidential campaign 4 days ago. TikTok and other social media platforms have seen a groundswell of viral memes, images and videos all featuring the vice president. Worth noting, President Joe Biden did sign that law into bill in April, forcing ByteDance to sell the app by January, as Michael outlined, or face the prospect of being barred from operating in the United States. This is an astonishing situation, Caroline.
What's also astonishing is how expensive some of those power brokers and lawyers are that they're using. $1,500 in that story an hour. Meanwhile, look, let's just talk China a little bit more, but in the context of esports, the company NIP kicks off trading on the NASDAQ. Co-founder and chairman Mario Ho is going to be joining us. This is Bloomberg Technology.
The more that you learn about this case, the more it reads like a Hollywood script. The nature of the killing, the execution, the just brutality of it.
It wasn't in the psyche of people that they could be looted because they are considered so sacred.
And we did it the way you do every single investigation. How do you eat an elephant? One bite at a time.
It jumped off the page at me that you could see that there was a Ponzi scheme taking place.
I started hearing mafia, mafia, mafia.
Il sistema è perfetto. Sono gli uomini che spesso non lo sono.
These are the holders of truth and justice. They cannot be possibly be doing this. But then they are. They are. And the evidence is there. It's overwhelming.
It's time for Talking Tech, and first up, the SEC is suing short seller Andrew Left and his Citron Capital. The regulators alleging that Left and Citron generated about $20 million in illegal profits and is accusing him of committing fraud through stock trades, social media posts, and research reports. The SEC says Left would allegedly make a recommendation and then capitalize on the resulting movements on prices far different than what he'd recommended. Left had no immediate comment. Plus, Apple agrees to AI safeguards. The tech giant is the latest company set to adopt a set of voluntary protections for AI crafted by the Biden administration. Apple will join the likes of OpenAI and Alphabet, as well as Microsoft, committing to testing its AI systems for discriminatory tendencies, security flaws, and national security risks. And shares of TSMC fell the most in 3 months in Taiwan. This as the country's stock market reopened after 2 days of closures due to a typhoon. The stock decline joining a global rout in tech stocks as investors rethink their AI positions. TSMC's Taiwan listing has now fallen more than 14% from its peak. Caro.
Ed, a company not fearful of that volatility is Chinese esports company NIP. It began trading today. It opened at $13.11 after pricing the IPO at $9 per share, which is pulling back to about that $9 level. We're pleased to welcome NIP co-founder and chairman Mario Ho. Mario, why go public in the US?
Well, this is the biggest capital markets platform in the world. For us, we've always thought that in order for us to truly go global and to seek partnerships all over the world, we need to be at the biggest exchange, and that for us is NASDAQ.
And so give us the thesis. You're going out to the investor base. Obviously, you're trying to woo them on the business model. The business model one is perhaps hard for a US consumer to understand, because for us, we think China, regulatory crackdown, gaming, but actually esports is something very different, well-loved, national pride.
Absolutely. Esports is well-loved, national pride everywhere in the world, every single government, exemplified by the recent news, the fact that there is going to be an esports Olympics at Saudi Arabia in 2025. I mean, for us, whether it is an investor from China, whether it's an investor from the US, the business model of running esports teams, the excitement that comes out of it can be understood by everyone.
Our gamers and esports fans in the audience will know that you're the parent company or holding company behind Ninjas in Pajamas in Sweden, ESV5 in China. And you guys talk a lot about the big market opportunity, right? You cite this report that esports globally is going to be a $100 billion a year market by 2027. Your teams do well, but you've booked about $19 million in prize money. So for all the investors watching, how do you make that number a lot bigger?
Well, prize money is only one part of our business revenue, which belongs to the part where we run esport teams. We also do a lot other than that. We also do talent management. We have sort of an IMG where we sign and manage a lot of esports talent. We also do offline events production, very much like the Esports Live Nation. And in the future, we're going into so many different new avenues like esports hotels, games publishing. We're definitely going to be raising the overall revenue pie of the company, not just prize money, but that is something we care about because our brands are very, very winning brands.
You mentioned the impact of having esports at the Saudi Arabia Olympics. That's a really interesting global view of this market. Could you sort of compare and contrast for us the health of esports in the USA against the health of esports in a market like China, for example?
Well, I think in terms of monetization and sponsorships, because the US has a very well-functioned traditional platform for traditional sports, I think the esport teams tend to do very, very well here. On the other side, in China, for example, you'll see a bigger size of following. More people, bigger population, more population that follows games and esports. So for esport teams in China to rack up a huge following and then to monetize that would also be easier. So it's a different demographic. But in terms of competitiveness, I think it is the same everywhere in the world. And like you said, Saudi Arabia, I would be very excited to see how the US teams pitch against the Chinese teams. And of course, teams from Europe and all over the world as well.
Mario, what sort of companies are wanting to really get in on the esport crescendo? I mean, many sort of think back to ultimately the collapse of FaZe over here in the US and a larger-than-life celebrities involved, but also worrying around the commitment of sponsors. What sort of companies are wanting to corral around you and wanting to support some of the players that you represent and the talent that you're going to be managing?
Well, first off, I think it is good to have a correction in the esports market globally, where we're now, as esports companies, are credited when you're able to prove a path to profitability. And that's great. That's, you know, for the overall health of the esports industry worldwide. For us, we have insane sponsorship from all over the world. You see companies like Red Bull, BYD, China Mobile, Fila, Puma, brands that are targeted targeting towards young people around the world will still find that very attractive to be represented by esports teams and have their logos on our shirts. And another reason for that is some companies want to really youngify or turn their brand younger in terms of audience. And for those types of companies, we're the sort of a very good partner for them.
Mario, Jackson Wang is a huge star. Mainland China in particular, huge following, and you've kind of tied League of Legends into his following. Will you replicate that strategy with any other celebrity in Europe or in the USA?
Absolutely. We're not saying no to that. The success of Jackson on his own, but also combining with the gaming audience has been something that's taken the market by storm. So if I'm able to form a friendship as strong as the one I have with Jackson here with somebody with a US celebrity, absolutely. But from business perspective, yes, those are all possibilities that we're looking to seek into the US markets.
Mario Ho, co-founder, chairman, and co-CEO of NIP Group. Thank you. Now, coming up on Bloomberg Technology, we'll hear from FTC Chair Lina Khan about her AI priorities and why she's looking at that industry closely. That's next. I mentioned it earlier. I want to look at Alphabet, parent of Google, real quick. On track for its biggest weekly drop since October. The latter part of the week, definitely earnings a factor, but yesterday, news from OpenAI on a beta search GPT, and even though I was off, I noticed that the stock was under pressure in that moment, right? OpenAI finally giving us something tangible about their ambitions for search, and certainly something everybody was talking about on social media. How they do, who knows? But clearly, it's having an impact on Alphabet's shares, down 6.5% for the week. We will be right back with you. A lot more to come. This is Bloomberg Technology.
Jason Kelly, and this season on Power Players, we're taking you behind the scenes to see how the business of sports has gone global.
I want sports to grow. I want sports to be bigger because we have talent.
And how mammoth value is coming from the smallest of players. 3,184 hits, 431 home runs, and of course the most famous stat that everybody knows, 2,632 consecutive games played. Unmatched career. Why are you doing this?
What we have achieved in the NWSL from an investor perspective over 2 years is the equivalent of what it took other leagues 25 to 30 years to achieve.
You've got to have a business that's sustainable. The only way it's sustainable is got to make money.
There's only one word, winning. You win on the court, you win off the court. And as you do that, you bring people along.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Welcome back to Bloomberg Technology. Ed Ludlow in San Francisco.
Caroline Hyde in London. Let's have a quick check on these markets because it has been a tumultuous time this week, to say the very least. But we are up this Friday on the NASDAQ 0.6%, even though we have been down for 3 straight weeks more broadly on the benchmarks and lost, remember, about $1 trillion worth of market cap over on the NASDAQ 100. Russell 2000 gains, outperforms once again small caps, outshining big tech as we see that rotation in place. Bitcoin, though, a little bit of love. Remember, we have, well, previous President Trump speaking at the Bitcoin event in Nashville this weekend. We'll see what he says for the crypto scene. We're up 3.5% as risk assets do better across the board. Move on to the individual movers because we have got some in play. And when you're looking at the leaderboard, Charter Communications beats on its earnings. We're up some 15%. Extraordinary movements for this particular company. DoorDash doing well. Of course, we finally get Prop 22 being signed off by the Supreme Court over in California. That does well. And some analysts upgrading on the stock. We're up more than 3%. Dexcom. What a wipeout, 41%. Unexpected cut to 2024 sales forecast. This is a blood sugar monitoring device maker for diabetics. Look, we are starting potentially to see the impact of Ozempic and some of those similar weight loss drugs. The CEO wouldn't say whether really they've been impacted by perhaps fewer common type 2 diabetes necessities coming from people as they use that weight loss drug. Ed, what are you looking at?
Glasses. In the news and making moves, EssilorLuxottica, the world's biggest eyewear maker, said Meta is planning to buy a stake in the company. Confirmation. The two companies have already been working together for years and presented their first Ray-Ban Meta smart glasses in 2021. This deal would see the US tech giant further stepping up its pushes into smart glasses. Right. Another Meta story. Meta's facing its first EU fine over allegations it abused its dominance in the classified ad market by tying Facebook Marketplace to its social network. Bringing in Bloomberg's Sam Stolten out of Brussels. Sam, good afternoon to you. Just walk me through the EU's perspective on this, the sort of the angst that the Commission has against what Meta did.
Yes, hello from Brussels, Ed and Caroline. And yes, we expect this fine to be issued against Meta in the coming months. And the European Commission has a number of concerns with how the company has tied Facebook Marketplace to the Facebook social media network. And what it is set to say, as I say, in the coming months, is that Facebook shouldn't make access to Marketplace obligatory on users having a social media account. And it also shouldn't use the data from its rivals, and I'm talking about non-public data belonging to classified ads rivals like eBay or Craigslist, etc., to compete against them. Because what the Commission has found is that over the years, Facebook has actually been a space for those types of companies to advertise and promote their services. But what Facebook has actually done with that data could be problematic in terms of an abuse of dominance. So the fine is set to come in the coming months. We don't exactly know how much it will be, but just a reminder, Brussels does have relatively high fining powers, up to 10% of global annual revenue. So it could be a fairly hefty bill for the Menlo Park firm to pay off.
Meta spokesperson saying the claims by the Commission are without foundation at the moment, Sam, and the organisation continues to work constructively with regulators over the issue. What's the chances that they can work constructively here? Because, you know, as a user of Facebook Marketplace, you can understand why you want it tied to the social media platform, because you want to understand about the buyer that's putting in the interest, and ultimately it's sometimes really hard to sell things through these sorts of platforms.
Yes, Caroline, well, indeed. I mean, it has been working with regulators since this case was first launched in the EU in mid-2021. Facebook did actually try to stop this investigation by offering some concessions. It made an agreement actually with the UK's competition authority to stop using this non-public data to compete against classified ad rivals. And that was enough for the UK regulator, but it wasn't enough for DG Comp here at the European Commission in Brussels. It wanted more. Meta wasn't prepared to offer more. And we're in a situation now where it's basically a standoff, but it looks like it's heading towards that fine and a couple of quite significant behavioural orders as well, which we expect to include an order from the European Commission for Facebook to create a separate portal that users who don't have a Facebook social media account can use to access the Facebook marketplace.
Really appreciate you breaking it all down because it's complex. Sam Stolten, go have a wonderful evening over in Brussels. We thank you. Meanwhile, let's talk about another key platform on Meta. It's WhatsApp, and it's hit 100 million monthly active users in the United States, growing its daily audience by double digits. Now, Meta CEO Mark Zuckerberg announced the new milestone on his WhatsApp channel yesterday. The app has amassed billions of users, of course, worldwide, but more US users would improve Meta's effort to build out WhatsApp's business, with the US market typically being the most lucrative, eventually, for advertising. Now, back to good old antitrust. FTC Chair Lina Khan was in San Francisco and, well, she's been meeting with members of the business and VC community. She discussed what's on her mind in an exclusive interview with Bloomberg's Emily Chang, starting with her thoughts around artificial intelligence. Just take a listen.
As a general matter, historically, we've seen that openness and open source can be a critical vector of innovation, right? I mean, what happens traditionally when you render some of these ecosystems more open is that it can lower barriers to entry, it can lower costs for entrepreneurs and startups and really enable them to innovate much more freely. And so we want to make sure that that tradition continues. We are watching very closely. I think there's still an open question around what openness really means in the AI context. Our team has been focusing on this idea of open weight models, which we think could similarly engender a lot of competition and innovation and make it easier for startups and entrepreneurs to compete on a level playing field. Of course, we need to really closely understand what are any restrictions, licensing restrictions that are being included here, and could those be foreclosing competition? More generally, we also need to be aware of how there are significant incumbents that may have an outsized role to be playing because they have key control over the raw material and key inputs. And so we need to be aware of the broader potential competition issues or bottlenecks or choke points that could emerge in ways that could inhibit innovation and inhibit competition. And so that's what we're going to be talking with founders and VCs and others about today.
I do have to take a moment to talk about the presidential election. A number of prominent tech folks have endorsed President Trump for a variety of reasons, but I've heard specifically multiple tech executives and investors complain about how they can't do deals on your watch. Do you have any concerns that your agenda has at all alienated the tech community or could impact the impact of your agenda going forward?
You know, it's been such an honor to serve in the Biden-Harris administration, and, you know, we're just focused on doing our work. What I oftentimes hear from the business community, including small businesses, including entrepreneurs, is that they want markets to be more open and more fair and more competitive rather than incumbents being able to squash out nascent competitive threats. I mean, our free enterprise system is one where the best ideas are supposed to win. And we've historically seen that it's the disruptors and entrepreneurs that have been a key vector of innovation. And so our job at the FTC when we enforce the antitrust laws is to make sure that our markets stay open and fair and competitive. And that's something that, you know, most businesses and most entrepreneurs should really be able to get behind.
That was FTC Chair Lina Khan and Bloomberg's Emily Chang. Coming up, we'll be joined by Hillel Zidel, Managing Director at Kennett Partners, on the firm's brand new fund focused on all things SaaS and all things Europe. This is Bloomberg Technology.
I decided to acquire Indeed 12 years ago when I was 36. I couldn't speak English, but I decided to move to the US with my family. Okay, let's study English. Let's, manage this big American company, but I could do it. Ages are just numbers. If you stay being very curious to run new things, you can keep doing that. So what we're trying to adjust is our company should be the praise to maximize people's ability, people's talent, and people's passion, right? Our employees' passion. So we believe that if we can have the work or the vision, people can be passionate, and which is aligned with all what employee wants to do, that's the best way to maximize the people's ability.
Follow your passion.
That's right.
So whether you're 14 or 40 years old.
I think so. Because, what's the difference? I don't know.
Russian Defense Ministry says that Russia scrambles fighter jets over the Black Sea to escort British warplanes.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Transatlantic growth equity investor Kennett Partners has just raised $290 million for its largest fund to date, called Kennett 6, which brings the firm's assets under management to over $1.4 billion. Bringing in Hillel Zadel, Managing Director at Kennett Partners, for more. It is great to have some time with you, Hillel. And look, we want to understand about the reputation, the returns you've already given some of your LPs and investors. What kind of companies have you backed? What sort of returns have you got?
Hey, Caroline, thanks so much for having me on the show. It's great to be here. So we're investing Kennett 6 right now. We have a long track record, north of 20 plus years investing in the sector. Our focus is on business-to-business software companies, and in particular, those that have been bootstrapped and getting to a great close on Kennett 6. In order to do that, you need to have a strong track record, and we're delighted to have that. Kennett 6 is a continuation of what we've been doing with our prior funds, and we're really excited about what we're seeing in the market right now.
Hillel, what's the backstory for wanting to focus on SaaS?
A few things. Firstly, scalability. These companies can scale very rapidly. They have high gross margins. They are predictable businesses. And within SaaS, we focus particularly on business-to-business companies and really those that are mission critical or essential to their underlying customers. What we really care about is this company solving a real problem of their customer? One of the unique aspects of our particular strategy is on bootstrapped SaaS companies. That's businesses that have been built by the founders without relying on external capital. These are companies that are very different to the traditional venture capital business of raising large sums of money, going out, spending, raising more. The companies we're investing in have been built to scale by their founders with very limited resources, and that's a strategy that we think provides our investors with really compelling risk-adjusted returns.
And also clean cap tables too. I'm interested in sort of trying to avoid hype cycles here, Hillel. I'm looking at some of the previous investors. Cross-border solutions, 6X at the moment, is an AI-driven tax and transfer pricing solutions. You've got financial automation software platform. I can imagine a lot of the founders you're now going to be looking to have had to in some way describe their business as artificial intelligence at its heart. How do you get out of some of the heady, hypey valuations when you start targeting that?
Yeah, I mean, that's a super relevant question. I think, we came out of a momentum cycle of 2020 to 2022 when prices were really high. Lots of investors were coming in and investing in technology. That's corrected. We're now in a more moderate environment, and then AI comes along and it's creating another level of hype. Our view is that we need to be investing in good businesses, good management teams, good strategies at the right pricing. We don't have a FOMO style investing. We're not trying to find the next unicorn. We're not trying to find the next big thing. We believe that just sticking to rational investing is the right way to be successful in this category. That being said, AI is real. AI is, in our view, the next platform shift, post mobile, post the internet. But I think we're at that particular point in the market where the reality, needs to catch up a little bit with the hype that's out there. And I think you're seeing that in the market in general, with huge investment going into infrastructure, into LLMs, and limited commercial value, commercial revenue at that point. And I think it's going to happen, but it's going to take time.
Hillel, it's a euro-denominated fund, and you're in London. We've got a new government in London. Just explain all of that, please.
Absolutely. So we invest in Europe, in the UK, and in the US. And we're really looking for the best businesses that we can support in their scaling. So, investing in businesses in the UK, we recently invested, as you showed earlier, in a company called Screen Dragon, which is a business between UK and Ireland. Our objective, with this and many other companies, is really around expansion. So, where we're investing in a UK company, we want to help build a world-class management team around the founders. We want to support these companies expanding internationally and ultimately develop strategies that maximize the value going forward. I think for us, the key point is the business we're investing in serving an international market? We're not really focused on companies that only serve domestic markets. It's much more about can this business scale and serve customers across multiple geographies.
Hillel Zadel, Managing Director at Kennett Partners. Thank you. All right, coming up on Bloomberg Technology, we break down the impacts of last week's CrowdStrike outage with Jennifer Tejeda, CEO of PagerDuty, and how the company plays a vital role in identifying and preventing incidents just like this one. This is Bloomberg Technology.
And global leadership are on Bloomberg.
We are 40 millions. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? If Trump knows how to end this war, he should tell us today. Because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood, we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone. Only our lives are at stake here, and nobody can just trade our lives.
Nobody covers the top global leaders like Bloomberg Television and Radio. Lots what's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Good morning from our world headquarters in New York. I'm Menace Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
They're spending over $1 billion when they're here in Paris. So we're seeing really good demand this summer. I think Q3 is going to be quite strong. And I think this event, the Olympics, is just the ultimate demonstration of the power of Airbnb.
Oh, we're talking Olympics, and just hours ahead of the Olympics opening ceremony, trains going to and from Paris were hit by an arson attack. Fires set 3 critical rail line nodes, causing delays for 800,000 passengers. The identity of the attackers is not yet known. Meanwhile, train delays are not the only concern. Look, the Olympics cyber team is bracing for attacks at this year's Games after France was already the target of hacks that shut down a film festival last month. In further Olympic news, get this, Canadian women's soccer head coach Bev Priestman was removed from the team after flying a drone over an opponent's training session. There had been prior instances of this by the head coach, according to the statement from Canada's soccer CEO, confirming Priestman's suspension. Ed, a lot of news.
A lot of news, and back to CrowdStrike. 97% of CrowdStrike's sensors are now back online after last week's outage, Bloomberg's reported. But there are growing concerns that incidents like this are part of a new normal. It's something I wrote about last week in Tech Daily. PagerDuty is a cloud computing company that plays an important role as an early warning system for incidents like this. PagerDuty CEO Jennifer Tejada joins us now for more. What was that like for you? That 24-hour, 4-day period when the outage happened. We just explained what PagerDuty does. So you must have been at your desk thinking, okay, we've got something to do here.
Look, I mean, these are the moments that were designed and built and prepared for. I'm especially proud of our technology and software and operations team because despite our platform coming under significant surges in traffic, incidents, we saw at the peak, we saw nearly 200% spike in the number of incidents that are normally processing on the platform, over 2.6 million events, which is, significantly higher than what we see in any typical hour, and a 1,425% increase in the number of incident workflows that our customers are running on the platform. So just seeing our technology stand up, in a very reliable and resilient way under that kind of pressure makes me very proud of our team, but also is just a good reminder that the effort that we undertake to build operational resilience, to prepare for these unexpected but really challenging moments, you have to anticipate them. You have to invest in the infrastructure, the redundancy, and the resilience to deliver when the time comes.
Jennifer, is this going to happen more?
It is happening more, absolutely. I mean, our customers saw nearly a 45% increase in customer-facing incidents just year on year. We are seeing the number of major incidents on the platform increase. These are incidents that have material or reasonable business impact. And that's because most of consumer engagement with brands, financial transactions today are taking place on digital apps that are supported by complex infrastructure, technology infrastructure, some of which is aging and some of which is increasing in its complexity because we're able to ship new products and services all the time, every day into this ecosystem. And that complexity is going to continue to grow with the advent of generative AI.
Jen, I just want to point out to our audience, we've made every effort to get George Kurtz, the CrowdStrike CEO, on this program on a daily basis, and he's yet to do so. And the reason I flagged that is so many IT managers, CISOs, CIOs, cybersecurity managers watch the program. They have very specific questions. The chief among them question is, is this a preventable event? or is this the sort of state of doing business now in the world that we live in?
Well, I think this is a good reminder that anybody who is responsible for technology in a business, and every business now is a technology business, is responsible for making sure they have good practices in place and good controls in place around technology change and around the ability to respond or roll back when a change does work ineffectively. But the reality is human error, technology fragility and tech debt in our aging technology infrastructure, cybersecurity threat, et cetera. All of these things create a more dynamic and volatile environment for the technology ecosystems we've grown to rely on. And that means that we have to make the investments in our infrastructure, in modernizing not only our technology, but the way we operate. So when these things do happen, and they will, that we can handle them more effectively. And one of the reasons that PagerDuty is architected the way it is because these events in particular are unstructured, they're unpredictable, and yet they're high impact and high value. So getting back to recovery of these systems is really important. But also, this is a tremendous opportunity for everybody in industry, not just folks who were affected by the outage last week, but folks that weren't, to double down on investing in infrastructure, on preparing, on improving their resilience, on practicing things like chaos engineering, tabletop exercises, and also communicating to customers the importance of
Comments from ECB Schnabel here. ECB Schnabel says services inflation is proving to be particularly sticky. Pace and extent of ECB rate cuts will depend on the data. Freight costs and protectionism could drive inflation, and a first cut doesn't automatically lead to a series, so some data wasn't quite in line with projections. In comments from ECB's Schnabel, who gave an interview to Faz News.
Generative AI right now, but the human needs to be in the loop.
Well said. The people behind this technology. Jennifer Tejada, we thank you so much, CEO of PagerDuty. Have a wonderful weekend. That does it for this edition of Bloomberg Technology, Ed.
Incredible week, incredible show. Check out the pod. This is Bloomberg.
In tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
What we try to do is combine some of our insights from the fundamental business with external and data set signals. And I think that's a lot of times where the opportunity is.
Always on the heartbeat heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. The top names in global leadership are on Bloomberg.
I envisage not only some kind of a bridge towards membership or language linked to the irreversibility of Ukraine's membership in NATO, but also some kind of a broader package of military material, of financial aid. The more we support Ukraine right now, the sooner the war will end.
Nobody covers the top global leaders like Bloomberg Television and Radio.
New York City for our viewers worldwide. I'm Shonali Bassick, and Bloomberg Real Yield starts right now. Coming up, the Fed's preferred inflation gauge rising at a mild pace in June, sending Treasury yields falling across the curve and boosting investor expectations for that September Fed rate cut. But we begin with the big issue, the great Fed rate debate.
I don't think the Fed is ready to cut in July.
July is off the table.
Taking July off and moving in September probably would be the best bet.
But September is still very much on the table.
September.
That's
very much predicated on the consumer slowing that has already started to materialize and probably will continue.
I certainly think the Fed has an argument to cut in July.
The Fed is late. They need to be cutting already. They should have started cutting some months ago.
We should probably start to see rate cuts sooner rather than later.
So there's very clearly a downshift in economic momentum.
I don't think the Fed would want to appear panicked.
Things are slower, but they're not slow.
We just hope they don't cut too soon, should they cut in September.
Likely going to see the Fed starting to cut rates in September, but we don't think they can go very far because of the underlying inflationary pressures.
Inflation, as we've always said, is insidious.
I don't think the inflation dragons were fully slayed yet.
Now, the U.S. yield curve has been steepening, and gravity had to catch up to the market at some point here, because you did see one of the favorite trades across Wall Street hit a lot of pain in the majority of the year, frankly. It only really steepened it back in January, and you saw it stay very, very inverted until recently, when you're seeing the 210s curves significantly steepen. In fact, the 230s curves you're seeing disinverted now. Now, if you flip up the board here, too, you see a lot of this really anchored in when people are expecting that rate cut. We could talk a lot more about that longer end of the curve and what it means for the yield curve to be steepening in this fashion, but the shorter end of the curve is really now pricing in that September rate cut with full certainty, nearly full certainty. There are other views out there about whether you can see one even sooner. Of course, the Fed meeting next week, and when it comes to Bloomberg opinion columnist and former New York Fed President Bill Dudley, his mind is made up. He's calling for a Fed cut next week.
I think rate cuts are definitely coming. I just think that at this point, there's not a really strong case for waiting. If the Fed doesn't cut in July and waits till September, it's not going to have a huge effect on the economy's trajectory, except the fact that when the unemployment rate starts to deteriorate, it seems to be a reinforcing negative feedback loop. Jobs are lost. People pull back on spending. That leads to further cuts in the employment.
Joining us now, Ed Al-Husseini of Columbia Threadneedle and Eric Nelson of Wells Fargo. And Ed, you heard those comments by Bill Dudley, and a lot of that was really anchored in this idea that if the Fed were to wait, then they risk a recession. Do you believe that to be the case?
Look, I think risks are definitely starting to shift in that direction. I think the Fed's been acknowledging it in the course of the past couple of months, is that we've been focused on inflation exclusively over the course of the past 2 years. It has been an appropriate focus, and now we're starting to see some downside risks to employment, and we should be acting on them at some point in the fall.
How do you feel about this dynamic, Eric? If you have rates stay higher at least until September, when the market is really expecting the Fed to cut, what else starts to weaken?
Well, I think, Chanel, if you look at market pricing, we're already there for a September cut, right? So very literally, if they sort of have to wait until September, technically the market won't necessarily move if they just cut 25 basis points in September. It's kind of a semantic point, but the market's already done some of the easing work for the Fed here. And I think in terms of sort of the U.S. economy and where we're currently sit, our labor market has certainly softened, but it's not at a point yet where I'm really worried about it, right? Like looking at the low level of layoffs. Yes, hiring is certainly weak. There's been some weakness in the underlying rising unemployment rate, but cyclical jobs are still okay. The GDP report showed that a lot of the cyclical parts of the economy are still growing, right? Equipment investment, durable goods spending. So I don't see this as an economy that's about to fall off a cliff if we don't get a cut next week.
Well, let me ask you another thing about the market's expectations, because if the economy, Eric, is still so strong, can you achieve 2 rate cuts in this market?
I think you can. I think the Fed thinks it's pretty far above neutral, right? So they would make the argument, I suspect, that if inflation stays around these levels and they only cut twice, they're still pretty far above neutral, and they're still in restrictive territory, and they're still putting some downward pressure on inflation, at least in their framework. So can you get two rate cuts? Absolutely. I think the bigger question for the market is can you get 6 or even more than that? And that's what really is sort of hanging the balance.
Ed, you look at the steepener that we're looking at here. What does it tell you? Is it a bull steepener or is it a bear steepener at this point?
Yeah, I mean, look, it's really been driven by the front end so far. And this tension between, let's say, inflation and employment that we're really focused on right now becomes a little bit more of a tension between fiscal and monetary policy next year. And I think markets right now are struggling. How do we prioritize the underlying case for cuts this year versus the possibility of bigger fiscal deficits and potentially higher rates next year? I think it's correct to focus on the immediate data and the downside risks to growth and employment and wait until after the election to get some clarity on the fiscal.
But another favorite trade has really been in duration this year. And how do you bet on duration when you don't know what the outlook looks like?
Yeah, look, I think the bottom line for me is if you're an investor coming into this environment, particularly if you've been in cash in the course of the past couple of years, there is an overwhelming case to extend into the curve and increase your duration in portfolios. I think there's also a compelling case on the credit risk side. Now, whether you take an active position in the curve, I think, is a secondary question to whether you take duration risk.
So, Eric, you take a look at the 10-year, for example, and it slipped for a moment on Friday to below that 420 level. It was actually 419 a little earlier. How much confidence do you have in the longer end of the curve?
Well, we think it's going to continue to be a bit of a grind, Shanali. You look at I mentioned the U.S. economy, and there's definitely some signs of weakness. But again, we're not sort of on the cusp of recession the way we see it, and that's, I think, going to continue to be an issue. And of course, there's questions around the U.S. election, right? If we get that red wave, that could certainly be another headwind for a duration. But we are at a different regime than we were pre-2016, right? Red wave is almost the base case, right? Fiscal deficits are the base case. So in that sense, if we get a divided Congress or expectations of a divided Congress, that could start to tilt the balance, at least on the fiscal side, toward maybe a better buying environment for duration.
That's pretty fascinating. Do you feel that way, Ed? Do you think that a Congress that is not swept to the red here is a benefit to the curve?
Yeah, I think, and by the way, it could be a blue wave as well. I don't know. I think the election's a coin toss. But yes, if it's a split government, we lower the odds of really front-loaded fiscal policy, front-loaded larger deficits in the course of the next couple of years. That will be positive for duration. What I'll point to is the starting point for real yields. Long-end real yields, right around that 2% level, is very attractive because intuitively, it's very unlikely that the economy can handle those rates for a protracted period of time.
Now, given the election uncertainty, both of you have kind of been pointing to this idea here of the fiscal versus the monetary. Ed, where does the 2-year end next year under a Harris administration and under a Trump administration?
Oh my God, the correct answer is I have no idea. There's a very decent, I think, easing cycle in the price. This is what I would point to. In my mind, we have about 100 basis points of easing in the price right now for next year. I think there will be a more compelling case for cutting more than that if the labor market continues to deteriorate. Right now, I think Eric's right, the deterioration in the labor market's been really marginal so far. odds are rising that it'll be more meaningful next year, and I think that will warrant deeper cuts.
Right. There's a camp out there, Eric, who believes that if Trump were to win the presidency, then the tariff policy would create an inflationary force. There are a group of economists and investors out there that also believe his potential labor immigration policy could do the same. Are you one of those investors?
That's certainly a risk that we want to be careful of, right? Because if we look at the disinflation in the last few months, a lot of it has, yes, there's been OER and core services have gotten better, but look at core goods inflation, right? We're back in negative territory the past few months. So, yeah, it's not just tariffs. We also have the Red Sea disruptions, and that's filtering through into some of the input cost environment. So there are some reasons to be cautious on that goods inflation backdrop in the second half, which is another one of those tail risks we have to be mindful of.
Question for you is, where does the 10-year end next year, regardless of who wins the election?
Well, I think it's. I will just make the quick point on the election. I think it's to me it's less about who's in the White House per se, and more about is there a unified government or not. But I think generally speaking, we think we can break through 4, but certainly by next year, and we're not necessarily in the full hard landing camp, but we think we can at least soften more than we've already seen. But yeah, I think the days of 300 basis point rallies in cutting cycles, I'm not sure that's what we're going to see this time around.
Do you think we can break under 4 on the 10-year?
I do. By the end of next year, yeah, absolutely. I mean, it's going to be, like I said, pretty choppy, especially into the end of this year. But I think if we're not going to get a really significant deep cutting cycle, then maybe you almost need to see rates. The hard landing risk get pushed out into next year, and then we worry about it.
Ed Al-Husseini and Eric Nelson, we thank you both so very much. Of course, a lot of uncertainty out there and a great perspective on how to make sense of it all. Now, up next, we're going to talk about the auction block. U.S. high-grade sales have exceeded expectations every month this year, leading the year-to-date total to the highest level since 2020. We're going to talk about that credit rush next. This is Real Yield on Bloomberg.
The more that you learn about this case, the more it reads like a Hollywood script. The nature of the killings, the execution, the just brutality of it.
It wasn't in the psyche of people that they could be looted because they are considered so sacred.
And we did it the way you do every single investigation. How do you eat an elephant? One bite at a time.
It jumped off the page at me that you could see that there was a Ponzi scheme taking place.
I started hearing mafia, mafia, mafia.
Il sistema è perfetto. Sono gli uomini che spesso non lo sono.
These are the holders of truth and justice. They cannot be possibly be doing this. But then they are. They are. And the evidence is there. It's overwhelming.
The top names in business are on Bloomberg.
Middle market line draws are basically still about 5 percentage points below where it was pre-pandemic, which means as cost of borrowing went up, people aren't being quite as aggressive, and that's why the economy is slowing down. They're not hiring quite as many people. They're not buying that piece of equipment. They're not doing it because they're a little worried about final demand, and therefore they're being careful, which is unpleasant for your bank, but is okay because the companies don't make them profitable and the credit quality is good.
Nobody covers business like Bloomberg.
I'm Shonali Bassick. This is Bloomberg Real Yield. It's time now for the auction block. U.S. high-grade sales remained hot this week, even with all that volatility in markets. United Health and Occidental were the big headliners, driving a nearly $30 billion week. United Health's $12 billion eight-part deal was the fourth largest this year. And with those sales, high-grade issuance for July is now nearing $100 billion, the fastest rate for any July since 2017. And it's well over the top end for the $85 billion forecasted to be sold this month. New sales next week could potentially challenge the monthly record. And in Treasury auctions this week, we had 2, 5, and 7-year offerings. The 2-year primary dealer award was the lowest on record. Meanwhile, the $44 billion 7-year note auction saw good demand. And earlier this week, we caught up with Winnie Caesar from CreditSights, who compared the credit market against the recent rally in small cap equities. Take a listen.
Within the world of corporate credit, there have been a handful of sectors and issuers that investors have basically said, nope, we're not willing to extend these capital structures. We think that they're over leveraged. We think that there's some sort of secular decline. We're seeing that, rotation into small cap equities. And so it is a little bit of a head scratcher, those two different dynamics. And, generally, I do think that credit markets tend to get things pretty right. They are kind of the driver of where liquidity goes within the system. So I'm really paying close attention to the reality that triple C spreads are still wider on the year.
And joining us now, Kelly Burton, High Yield Portfolio Manager at Barings, and Brian Whalen, Fixed Income CIO at TCW. Brian, the last time we spoke, you had some worries about the market, and it's interesting because even if we see this market softening a bit, the economic environment softening, you are still seeing investors flood into risk. Do you just follow the herd at this point, or you tell them to cool it?
We don't. We're going the other way. I think but that's what makes a market. That's what makes opportunities. We're seeing an environment where it seems like consensus is that, this economy is actually finally starting to slow down. You can kind of feel it. And, the next 6 months is probably going to be more about, how that transpires. So, it's kind of like buckle up and let's watch this thing. And, is this going to slow down in a way that the market anticipates, which is the market is pricing in a very high likelihood of a soft no landing. And, we're kind of leaning the other way. We don't think you're really compensated well for the potential outcome that this is anything but soft.
Kelly, how do you feel about it? I feel like that's the perfect setup to talk about high yield right now, because is this kind of ubiquitous? Do you invest across high yield knowing that people are expecting a rate cut, or do you avoid sectors knowing that the consumer's softening?
That's a really good question, Shonali, and I love that I'm on after Winnie Caesar. She's one of my best friends here in Charlotte. She's really smart. We talk a lot about the markets, and I agree that certain sectors have really already been kind of washed out. In recent trading sessions, they've actually picked up a bit, and triple Cs are actually outperforming over the last 30 days. So some of the thematics that you're seeing in the equity markets could be shown here as well in high yield. Overall, though, the triple C segment of the market remains quite small. It's only about 11% of global high yield. A lot of that is trading already very wide and part of these numerous LME transactions. So the part of the market in terms of new opportunities that we're trying to sift through would be those that are more performing and not at the widest yields and spreads that you see on the face of it. And then in terms of the higher quality bands, double Bs are still 55% of our market or so. So there's a lot of solid quality credits to invest in. Yes, spreads are tight, but it's not the whole story. We still like the price discounts and overall what we're getting in terms of spread per duration in our market overall. So I think all segments are worthy of investing. But again, the lower you get down the quality spectrum, you just have to be very cognizant of those sectors like cable, media, telecom that are really struggling.
Brian, how do you think about how to take on risk in this environment? On one hand, spreads, although we've seen periods of a little bit of widening, they have been significantly tighter than what you would expect at this point in the cycle. And, there's a lot of people who are out there trying to find that extra dollar. Where do you take on risk?
Yeah, no, I think I like the way Kelly articulated. I would say it kind of depends on what kind of investor you are. Like if you If you want to just set it and forget it, I think, we would tell you, high quality, high yield, kind of that single B, double B part of the market is probably just fine. Like, meaning that we don't see a lot of systemic risk in the market from excessive leverage or issues with accounting irregularities, nothing like that at all. Certainly leverage is bumped up and interest coverage ratios are coming down just given the rise in rates, but there's no kind of smoking gun down there that you need to worry about. However, it's all going to tie back to the macro, and it doesn't matter how good the balance sheet is or how strong a particular sector is, but if this economy slows further than the market is expecting, and it won't take much to do that, all spreads are going to widen out. And so, that's going to be fine, as long as you're buying companies that don't default. Eventually, you'll ride the volatility and get your money back. On the other hand, if you're a more active investor and you're looking for better entry points, we would say, look, the next 6 months are going to be more volatile than the last 6 months. You're going to have a better entry point. There'll be wider spreads. And you could potentially create a much better total rate of return for yourself if you wait. And so that's kind of that's the two different camps. You have to understand which one you're in. And if also, I'll add to this too, are you going to be the investor that during the volatility, you're going to kind of have the kind of stomach to step in when others are moving the other way? So you kind of also have to understand who you are.
I'm really curious about the stomach to step in. Kelly, if you think about the potential volatility ahead, do you expect it? Do you prepare for it? Do you keep some powder dry to step in when spreads widen out?
I think that's also a fair question. And I'd say at times we've had cash in this market a little more elevated than historical standards to allow for that. Certainly, we're heading into an election year here that can prove to add volatility to the market as well. Obviously, there's been a noise around that just in the last month or so. We do think rates on the margin are going to be helpful and supportive for risk assets, including high yield. We may not be there in terms of just how many rate cuts are built into the market at this point in time. Maybe one or two are fair. Again, that will be somewhat helpful as we go into the back end of the year. So I think rates are supportive, but overall, as he mentions in terms of the economy, that is certainly a focus. Right now, though, with what we're looking at in terms of recent data, whether it be the GDP print, inflation, et cetera, things seem to be in a good spot. The consumer continues to be resilient. That GDP print really lifted by above trend spending. And so then it goes down to just looking credit by credit and making sure that our companies are healthy, able to withstand their interest and generate free cash flow for us.
Brian, if you do wait to invest when you see a pullback, what are the areas that you're looking to deploy into?
No, that's a good question. Look, right now, what looks relatively attractive is in the securitized area. It's in areas of the market that have been beaten up due to the rise in interest rates and the interest rate volatility. And then, the sectors that look rich to us that should come under pressure are more in the corporate bond area. Obviously, the further down the capital structure you go, or the further down you go in credit quality, should be where you see the most opportunities. I'd add one more thought too about kind of the current economic environment. And certainly we would concede that the mix of the last 2 months of data would indicate a slowdown, but at least looking over the rearview mirror for the past couple of months, it doesn't indicate a recession. But I had heard a guest earlier before Kelly and I jumped on, said something about looking at the employment market right now and not being really worried. We would contend this, the U.S. economy makes the Titanic look like a dinghy, meaning that when you actually finally get to the point where you are really worried, it's going to be too late. At that point in the time, the Fed's going to have to be reacting, aggressively. And then that kind of the psychology, that negative feedback loop you're going to get at the consumer level and the corporate level, you'll start to see the layoffs. And at that point in time, it's going to be too late, because the Fed will be reacting, spreads will be much wider.
And sometimes this economy has been quite the jet ski. That is Kelly Burton and Brian Wellen. We thank you both so much for your time. Happy Friday. Happy weekend to both of you. Now, still ahead, the final spread, the week ahead, the latest U.S. payrolls print on deck. Stick with us. We'll talk all about those expectations next. This is Real Yield on Bloomberg.
Jason Kelly, and this season on Power Players, we're taking you behind the scenes to see how the business of sports has gone global.
I want sports to grow. I want sports to be bigger because we have talent.
And how mammoth value is coming from the smallest of players. 3,184 hits, 431 home runs, and of course, the most famous stat that everybody knows, 2,632 consecutive games played. Unmatched career. Why are you doing this?
What we have achieved in the NWSL from an investor perspective over 2 years is the equivalent of what it took other leagues 25 to 30 years to achieve.
You've got to have a business that's sustainable. The only way it's sustainable is got to make money.
There's only one word, winning. You win on the court, you win off the court. And as you do that, you bring people along.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
I'm Shonali Bassick, and this is Bloomberg Real Yield, and it's time now for the final spread. The week ahead, earnings is busy once again. McDonald's is kicking us off, and on Tuesday we'll get results from Microsoft. Plus, U.S. JOLTS and consumer confidence figures, and Wednesday, a Fed decision as well as the Bank of Japan. Thursday, Apple and Amazon, along with a decision from the Bank of England, and finally Friday, the latest U.S. payrolls report. And because those payrolls are coming after that big FOMC meeting, of course, a lot of volatility could be baked into next week. The unemployment rate is expected to stay flat at 4.1%. Non-farm payrolls expected to soften, though, to 175,000, and hourly earnings here are expected to cool to 3.7%. Remember, wages being a big part of that inflationary story. We'll see how it all comes in the next stage of this economy. From New York, that does it from us. Same time, same place next week. This was Bloomberg Real Yields, and this is Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, The moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
Welcome to Bloomberg Markets. I'm Scarlett Fu. Investors have been punishing big tech in favor of small caps this week as we await the Fed's decision and some critical earnings next week, while the SEC targets famed short seller Andrew Left. And Paris moves ahead with opening the Olympic Games even after an attack on the French rail system. More on the top stories of the day just ahead. But let's give you the setup for you in terms of where we stand with equity markets. The S&P 500 and NASDAQ 100 in recovery mode after 3 days of losses, while the Russell gains for a fourth time this week, up 1.3%. Everything's up about 1.3% right now. And Treasury is also gaining, with the 10-year yield moving lower today and on the week, right now at 4.20%. Let's get you some individual equity movers at midday. Bristol Myers rising the most in 10 years after announcing it'll join other big drug makers in raising its 2024 profit forecast. This after sales of all of Bristol's biggest products beat estimates, also helping Bristol's $20 billion purchases of 3 other drug makers last year. Meanwhile, 3M rallying the most since 1987. The company, which is under new management, also boosted its full-year profit forecast. The new CEO, Bill Brown, is prioritizing sales growth and increasing the pace of new product development. Let's also look at the NASDAQ 100 this week. The index swung wildly based on earnings, economic data, and election developments. So we want to talk about the big swings that we've seen in markets with Bloomberg's Isabel Lee. When we talk about the NASDAQ, Isabel, it's great to see you. Thank you so much for making time for us. Is it either a warning sign of things to come that we've seen a peak in big tech, or is this a buying opportunity? I feel like it really depends on your view on technology.
Exactly. There is no consensus. We saw such a wild, violent rotation this week. Wednesday, I'd like to hone in, was the worst day for the S&P and the NASDAQ going back to 2022. And that really started because of lukewarm earnings from Alphabet and Tesla. So the main question I've been asking people is this the end of the AI rally, and does this rotation have legs? And of course, depending on who you ask, you never really get a consensus. But then I think that's the interesting thing. Investors were now thinking, when are we going to get the ROI or the payout for these billions we've been pouring into artificial intelligence? I mean, yes, it's revolutionary. We have KKR, digital infrastructure head, saying that it's going to be bigger than the cloud, but it's not going to happen overnight. And I think that's what investors are seeing. Add to that is the Fed meeting next week.
Right, and of course we're going to get more earnings from the rest of the Mag 7 next week that might help to provide some answers. But I want to go to the Fed because I'm glad you bring that up. I feel like the catalyst for all this Fed talk really was June 11th, when the June CPI came in cooler than anticipated. It really cemented the idea that the Fed will move sooner rather than later, and it gave those small caps a big shot in the arm.
Yes, because as we know, lower interest rates would be beneficial for small caps because they're more economically sensitive, their balance sheets are a bit weaker, and so if the Fed cut rates, it will be a boost for them. I mean, for the longest time, we thought that big tech will see a bad year this year, but then AI rally happened, ChatGPT, so that's a different story altogether. But with the Fed, the consensus is they're going to cut in September, although we have the likes of former New York President Bill Dudley saying it might be in June because we're seeing the effects already of the Fed interest rate hikes. But it still remains to be seen. Honestly, some of the portfolio managers I talk to say it doesn't really matter. It's 25 basis points. June, September, it doesn't matter. What's important is the direction and that they're going to cut already. So now it's just really which month rather than will they cut.
Yeah, exactly. It's not if anymore, it's just when. So here's the other thing. I wonder how much political headlines are contributing to this rotation as well. We've had enormous amounts of headlines in the political world. The presidential debate at the end of June, the assassination attempt on former President Trump in mid-July, and now Biden stepping down, and Kamala Harris, the vice president, taking over as the presumptive nominee. How much is the Trump trade part of this greater rotation?
I wouldn't even say it's a big impact. And the thing is, when Trump trade depends on who you ask. It's different for everyone. And then throw in crypto. And Trump 2016 is different from Trump 2024. I mean, he wasn't even crypto friendly back then, but now he's slated to speak in the Bitcoin conference. I mean, I guess we can only write about it when he appears, but then there's that thing going on also. The main thing that investors are really watching is earnings. We have the continuation of 5 out of 7 next week, Microsoft, Apple, Amazon, and so that's a big thing. The politics, it's too early to tell. There are still 3 months down the line. Even the Fed, it's not really such a huge game changer in a sense that investors already have a consensus and have fully priced in September.
Yeah, all right, good stuff. Thank you so much. Isabel Lee, who covers markets for us here at Bloomberg. Let's stay with the markets overall because the SEC is suing short seller Andrew Left. The regulator accused him of committing fraud through stock trades, social media posts, and research reports, marking the agency's biggest move yet in a multi-year crackdown against traders who tout their bearish bets. Bloomberg's Bailey Lipschultz joins us now with more. So, Bailey, what is the SEC accusing Andrew Left of doing specifically?
There are a number of things, Scarlett. So the SEC and the Justice Department both have their own charges against Andrew Left. The thing that stands out from what we're seeing in the SEC complaint is that he would use social media to promote investments and lay out price targets, but then quickly profit from it. So if he came out with a short position or a short call on a certain company saying that the stock should drop 50%, he would actually, according to the allegations, load up on options or load up on a position and then quickly exit the position when the stock immediately reacted. So not sticking to those investments. So one of the examples it alleges is that Left would say he would stay long a stock until it hit $65 when, according to the SEC, they immediately began to sell the stock at $28. So profiting off of the immediate reaction as opposed to laying out a long-term thesis and sticking to it.
He just needed investors to jump on whatever he said, and then he would kind of quietly make his trades. There was also part of the complaint that said that he was teaming up with hedge funds.
And that's been a long part. So when you go back 3 years ago, when both the SEC and Justice Department were investigating kind of the network of short sellers, they were trying to figure out if these are actually research units and groups that operate individually or if they partner. And that's one of the things that was uncovered in the SEC complaint is that, in fact, they say the defendants had entered into compensation agreements with hedge funds. So whether they were letting them know trades before they actually came out with research or outright publishing other firms' research as their own to help move a stock.
And the SEC also uncovered some statements that really sound pretty damning, right, when it comes to Andrew Left, like making it clear that he knew exactly what he was doing, too.
And that's really, when you look through all the filings, in the SEC's complaint, it is not really becoming of Andrew Left, and it's going to be interesting to see if there is another shoe to drop and when that would happen, just because, again, this is going on 3 years of investigations. There is a large network of investors who are activist short sellers who promote their investments on social media, use their following to move stocks, and there is a potential fallout from that.
Right, there is a playbook to this. So have we reached out to Andrew Left? I mean, he's been dealing with this for a number of years now. What is he saying, if anything?
No immediate comment. So not hearing anything right now, which I don't believe should be a complete surprise, but he has talked to Bloomberg in the past and has kind of been a target after that GameStop snafu back in 2021, which he ended up falling under some pressure from that too.
All right, good stuff. Bailey, really appreciate you joining us, giving us the lowdown here on the SEC's lawsuit against Andrew Left, famed short seller. We do have some breaking news here, and it was expected that Warner Brothers is suing the NBA after TV rights were awarded to its rivals, in particular Amazon. Of course, we'll keep you posted on further developments. Amazon did have a bid that was approved by the NBA, and then Warner Brothers Discovery tried to match it, but the NBA made clear that it was going to move forward with Amazon's bid instead. So now we have legal action as a result. Meanwhile, in Paris, let's just go to the other side of the world here, the city is sticking to its Olympic Games opening ceremony in just under an hour, while authorities address a, quote, massive attack aimed at paralyzing the network of France's super fast trains. What happened was that fires were set off at 3 critical rail line nodes, impacting hundreds of thousands of passengers. Traffic on a small number of the impacted train lines have since resumed. There have been no official statements over who is responsible for these attacks. Bloomberg's Caroline Conan has more from Paris.
The Paris 2024 Olympics kick off on Friday night for the first time in real life after the pandemic kept spectators away from the Tokyo Games the last time. But just a few hours before the opening ceremony, the SNCF train network warned about some acts of sabotage on 3 parts of the TGV fast train lines, west of France, north of France, and east of France, that could actually disrupt as many as 800,000 passengers going in and out of Paris. Of course, that's a big impact possibly on the opening ceremony. I was talking to the Accor Deputy CEO Danone, CEO earlier, two of the big Olympic sponsors, who say it's very sad that some people are trying to take the Olympics hostage, but hopefully it is not going to ruin the party. As many as 15,000 athletes from more than 200 countries have arrived in France and in Paris, including from Iran, North Korea, Israel. Those athletes from Israel have been placed under very high security. The Russian athletes will be able to compete, but individually, not representing their country. President Macron has called for an Olympic truce after 1 month of political uncertainty since the snap elections, and no new prime minister in sight yet. On Friday night, for the first time, the opening ceremony will take place not in a stadium but in the city along the Seine River, with as many as 6,000 athletes sailing down on boats, with a big finale at the base of the Eiffel Tower.
Our thanks to Caroline Conan in Paris. Need to work on my French accent there. All right, coming up, a private equity giant leans into gambling with a deal to buy game companies IGT and Everi. This is Bloomberg.
In global leadership are on Bloomberg.
We are 40 million. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? If Trump knows how to end this war, he should tell us today. Because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood, we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US, or we'll be all alone. Only our lives are at stake here, and nobody can just trade our lives.
Nobody covers the top global leaders like Bloomberg Television and Radio.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
It's time now for the stock of the hour, which is actually a twofer because we've got International Game Technology and Evry. Their shares are jumping after Apollo agreed to buy a part of IGT and all of Evry, which is a gambling machines company. The price tag, $6.3 billion. Joining us now for more is Bloomberg's Chris Palmieri in Los Angeles. Chris, what is Apollo's strategy in buying these two companies?
Well, so IGT was really the pioneer in the slot machine business in the U.S. They own that ubiquitous Wheel of Fortune game in casinos everywhere. But it was really not doing great. It had been bought by this Italian lottery company a few years ago. And the new industry darling was this Australian company called Aristocrat. It was really making all the exciting machines. And so they had come up with this idea to separate IGT business, and they cut this deal with Evry, a much smaller slot machine manufacturer. And Apollo, we had reported last year, was interested in IGT, and now just came and decided, well, we're just going to scoop them up. And obviously, they think they can do a better job than the current situation.
Okay, and IGT may be selling its gaming division, but will still remain a publicly traded company, right?
Yeah, I think they're not going to use the IGT name anymore, but it'll be the lottery business that existed before.
Okay, got it. Thank you so much for clarifying all of that. I want to get your thoughts, too, on the breaking news that we just told you about moments ago, which is Warner Brothers Discovery suing the National Basketball Association after the TV rights were awarded to rivals. This is a multi-step thing, but let's just take you through it, right? Because there was this period where everyone could bid, and Amazon bid for one portion of the games, and the NBA accepted it, and Warner Brothers Discovery was able to match it, and it did, and the NBA decided to move forward with Amazon. So now Warner Brothers Discovery is suing over what? The NBA making a decision not to go with it?
Right. Well, Warner Brothers is arguing that in their current contract, which expires next year, they pay a premium for the right to match a competing offer. Not an uncommon situation in these types of deals. What we're hearing the NBA is arguing is, or will likely argue, is that this isn't the same package that Warner Brothers had before. We kind of know why the NBA picked Amazon. For one, it's got a larger footprint of subscribers globally. It's obviously got a lot more money. And they just want to sort of go with this streaming partner in the future. But whether the contract is enforceable, that's something the court's going to ultimately decide, it looks like.
All right, so we should mention Warner Brothers Discovery shares are higher at the moment by about 26 cents at $82.55. Chris Palmieri, thank you so much for clarifying all of that for us. Chris Palmieri on our stocks of the hour and the latest with WBD suing the NBA. Coming up, we're going to turn to real estate with venture capitalist Kalea Warburg-Peters, who helped coin the term prop tech. This is Bloomberg.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
This is the biggest single hosting event in the history of Airbnb. We have the number of people staying in an Airbnb here in Paris.
10 minutes time now.
Olympic Stadium
At the top of the hour, see the release of the weekly Baker Hughes rig count numbers. Oil rigs, the prior was 477. Total rigs, the prior was 586.
Olympics. Brian Chesky, of course, founder of Airbnb. So let's bring in now Clelia Warburg-Peters. She is managing partner at Era Ventures and our own Bloomberg's Abigail Doolittle. Clelia, you have called Airbnb the most successful property tech company, which is really an area that you know well, having helped coin the term prop tech. What did prop tech look like before Airbnb, if at all, and what does it look like now?
Yeah, so I think that prop tech was pretty nascent about a decade ago, which was around the time that Airbnb was being founded. There, of course, were companies like Zillow, Trulia, but the broader disruption of the real estate industry, which is, the industry driving the most GDP across every economy in the world, was really in its very, very early days at that time.
So in terms of prop tech, this spring we had Austin Allison, co-CEO of Picasso, who I know you know, and of course their other co-CEO, a founder of Zillow. He said that home sharing, co-sharing of homes is the American dream. Do you agree? And do you think that Picasso could be, I love how you're nodding your head there. It's hard to know if we agreed with that also. Do you think that Picasso could potentially be, say, the next Airbnb or Zillow?
I mean, I think that Picasso is offering a really interesting innovation, allowing people to share, in particular, second homes. And I do think that we have an affordability crisis across this country, and that different innovations that allow people to access home ownership are really valuable. Now, whether or not home sharing is actually a realization of the broader American dream, I think that's a legitimate question mark.
Yeah.
But I do think, Picasso started out to allow people to share vacation homes. And I think for many people, Picasso could allow them to access something that wouldn't otherwise be available to them, which would be a home in another place outside of their primary residence.
Well, sticking with homes, but more on the residential side, of course, there was that massive NAR lawsuit, the commission lawsuit settlement, $418 million. I know some of the measures go into effect this August. Even ahead of that, have we already seen the death of the 6% commission, the perception of that it just doesn't exist anymore?
Yeah, I think this is going to be a really interesting question that we are going to live the answer to over the course of the next 6 to 12 months. I personally think that the settlement was less of a big deal than it's been made out to be. Really, the settlement was very kind of nuts and bolts, like here's the regulation about what can and cannot be displayed on MLSs and the types of agreements that buyers agents and sellers agents can make between themselves. The settlement did not in any way require that commissions come down. It just required that the bits and pieces of the transaction be tied up better. But I believe that the way that the media has covered news around the settlement and the perception now on the part of consumers that their commissions are going to come down are going to kind of set up this standoff between the real estate industry and consumers that I do think is going to result ultimately in lower commissions. But I think they may be less low than the media is currently suggesting, because I think that there's really no requirement that real estate agents bring these commissions down, and that I think what you're going to see is that there will be a push on the part of many sellers to
US
say,
stocks
I don't
extend
want to pay
gains.
this.
That's the Dow Jones up 2%
I'm
now.
going to list my home with the understanding that we won't pay a buyer's agent, and then there are going to be fewer people who come and see their home, and then they're going to moderate over time.
So there's a lot of things that kind of have to happen, and there's obviously a lot of confusion, as you put it. What does this mean for the housing portals like Zillow, like Redfin, which you could consider prop tech companies. Isn't this good for them because people will be going on those sites and looking for more information?
So Zillow, Redfin, those I think are some of the leading prop tech companies, right? But you have to think about what the different business models of those businesses actually are. So I think Zillow and Redfin are actually in distinctly different positions. A business like Zillow is really an advertising agency for buyer's agents. As you know, we think of Zillow as being a portal just to look at listings, but Zillow's business model is they're selling that lead traffic to buyer's agents. So if buyer's agents are suddenly in a worse position in the market, if they have less money, if you make less money as
In
a
5 minutes'
agent,
time now, at the top of the hour, we expect the weekly US Baker Hughes rig count numbers. Oil rigs, the prior was 477, while total rigs, the prior was 586.
To try to create offerings that are more focused on sellers and sellers agents.
And I should have mentioned before, the reason that we skipped to residential is you are the former president of Warburg Realty. You know, in terms of the settlement and the changes that are going to come, and knowing that there's nothing official relative to commissions, what real changes will be affected? And if everything else remained equal, do you think that just that perception that commissions have already dropped, maybe not as much as the media is portraying or people think, do you think that it's going to have an actual effect on residential values?
You know, I think we're going to have to see, and I think it will vary somewhat by market. So I think that this will probably impact luxury markets less, because I think that people in luxury markets are more used to working with professionals in different parts of their financial life, and that people will continue to be committed to working with really strong buyers and sellers agents in luxury markets. I think that in the middle market, you know, the average American home worth generally around $300,000 right now. For a seller or buyer in that market, 6% is often equivalent to their entire life savings.
Yeah, wow.
So for them, that is a really meaningful difference. And I think you will see people really push more in that middle market segment to have commissions come down.
Our Ventures Managing Partner, Claylia Warburg Peters, and Abigail Doolittle, thank you so much. That does it for Bloomberg Markets. This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
What we try to do is combine some of our insights from the fundamental business with external and data set signals. And I think that's a lot of times where the opportunity is.
In global leadership are on Bloomberg.
I envisage not only some kind of a bridge towards membership or language linked to the irreversibility of Ukraine's membership in NATO, but also some kind of a broader package of military material, of financial aid. The more we support Ukraine right now,
shortly expecting results from the Baker Hughes rig count for the week.
The top global leaders like Bloomberg Television and Radio. From the politics to the world of business. This is Balance of Power. Live from Washington, D.C.
The Obama endorsement is in the bag. Now time for a running mate. Welcome to the fastest show in politics as Vice President Kamala Harris lands the Obama endorsement, checking the final box among Democrats. And we're going to bring you new polling from the swing states just ahead from Spencer Kimball at Emerson College Polling Center. Bloomberg's Michael McKee will join us this hour with a tame reading on inflation this morning, what it means for the economy and for politics. And of course, we'll have analysis from our signature panel. Bloomberg Politics contributors Rick Davis and Jeannie Shanzano are along for the ride. After we take a look at Wall Street right now, let's see how the numbers are playing in the markets with an update from Charlie Pellet in New York. Hey, Charlie.
Thank you very much, Joe Matthew. A substantial rally now underway. Every major group in the S&P 500 higher on bets at the start of the Fed easing cycle will keep fueling the outlook for corporate America. Here's where we stand. S&P at 54.83, another leg higher in the past few minutes, up 84 points, just about the best level of the day, up 1.6%. Dow Jones Industrial Average now surging by 807 points, up 2%. NASDAQ, the composite index, up 1.5%. The NASDAQ 100 index up 1.6%, while the Russell 2000 index of small cap shares also taking part in today's advance, up by 1.4%. We've got the 10-year yielding 4.20% with a 2-year 4.38% right now. Gold up $24 the ounce, higher by 1%, 23.89.
Oil rig count 482, 482, and the total rig count 589, 589.
3M shares are surging the most in more than 36 years after raising its full-year profit forecast as its new CEO vows to reinvigorate the iconic manufacturer's innovation engine. We've got shares of 3M up now by about 19.4%. So again, recapping, stocks are advancing. S&P, best level of the day, up 86 right now, up 1.6%. Balance of power continues now. Back we go to Washington, and once again, your host, here he is, Joe Matthew.
Charlie Pellet, thank you so much, and welcome to the Friday edition of Balance of Power here on Bloomberg TV and radio. It's great to see you with news on the economy and politics that we need to talk about, all colliding here in a fascinating way to end what has been an historic week in American politics. As we wake up this morning to news, the PCE, the Fed's favored price gauge, rising at a mild pace, spending holding up, fulfilling the hopes, at least, of the Biden administration to where we might be by the time voters are hitting the polls in the fall. It's even got some outliers calling for an interest rate cut next week. I know you don't think that's going to happen, but it's the kind of conversation that this White House wants to be having in Washington and wants to be having with Michael McKee. Bloomberg economics editor joins us right now live from New York with his take on this. Michael, I don't know if you're going to tell me there's trouble under the hood, but this seems like a pretty good stretch of data. And if we're looking for a trend, is this number 3? Have we found one?
Well, it is a good stretch of data, and the numbers aren't that bad, but you could argue it both ways. The administration will glom onto the fact that personal spending rose at a healthy pace the last 2 months, and that inflation was down. The PCE headline number now 2.5% for the year, the core 2.6%, both within shouting range of the 2% target the Fed is looking for, so rate cuts could be in the offing. However, personal income did not rise as much as anticipated, and wages were half what they were in the month of May. So if you were on the other side, you could say the economy is slowing, and then it's a question of how much is it slowing? Are we falling off a cliff? I'm sure one party would make that assumption. And are we doing okay? You'd get from the other side.
If you're Jay Powell, though, Michael, you're looking at this and saying, I love it when a plan comes together?
Yeah, because the GDP numbers for the second quarter, which came out yesterday, showed that growth was stronger than expected and led by personal and business spending. So that part of the economy is doing well. And we haven't yet seen a fall off in the labor markets as jobless claims, which are usually distorted in July anyway, have come back down. Now, the jobs number next week is going to be very important, but it does come after the Fed meeting.
meeting, everybody's going to be watching to see if we still get the same rough amount of jobs created, somewhere between 175 and 200,000, and then the unemployment rate, whether it goes up. That would be a harder thing for the Democrats to sell.
Harder to sell, but confirming, I assume, for the Federal Reserve. What do you say to the few analysts and economists out there predicting a cut for next week? Too early for a data-dependent Fed, or too early to communicate to the markets?
Too early for the markets. The Fed doesn't like to surprise the markets, and they haven't made a case for lowering rates at this meeting. So unless they decide that the data have pushed them, or they're worried that they're going to fall behind, they're not going to be raising rates this time. The real question is how strong a hint do we get in their statement and from Jay Powell in his press conference about September, and that being the time, that's when the markets think they're going to do it.
Spending, talking about the consumer spending number is interesting to me because the savings rate in this case fell to 3.4%, the lowest since December 22. Michael, what does that tell us about where we are with our savings from COVID? We're digging into it. We've already burned through it.
Well, mostly we've burned through it, but it depends on your income strata. The Fed and the BLS also slice and dice the income numbers. And when you look at it by quintile, the people in the top 20% saw a bump from their COVID payments, then their total assets went down a little bit, and now they're rising again. That's not true for people in the bottom quintile, the lowest 20%. Their bump went up and then came back down, and it's staying down, basically. It's gone up a little bit in the last few months, but not nearly as much. So it is the people who make less money, who are on the lower end of the income scale, who are suffering the most at this point. And then that has a spillover effect on the economy because they spend most of what they earn because they don't have any money to put into savings. So it's a sort of it could be cast as a tale of two economies.
Understood, as always. You're coming down for the Fed meeting next week, I presume. Will Jay Powell and policymakers telegraph the first rate cut in the statement, or when you gather in the same room with Jay Powell for the news conference?
Well, it's an interesting question. They probably will change the statement to acknowledge that inflation is coming down. They've basically been saying it's still elevated is the word they use. And if they do change the statement, markets will take that as a hint, and then we'll all press Jay Powell to try to go beyond that and give us a date, which he'll try to avoid doing, but I'm sure he'll find some euphemism for pretty soon.
Michael McKee, thank you, and we'll see you in D.C. Bloomberg TV economics editor Michael McKee getting us started here on Balance of Power, reminding you that the flow here on economic data goes directly into the political conversation here in Washington, D.C. And what world will we be in? What will that feel like if there is an interest rate cut in September, right around the same time Kamala Harris and Donald Trump are set reportedly to debate, and people start really making up their minds on how they're going to vote in November? It couldn't be more important to us here on Balance of Power. As we stick with the beat, of course, on politics and add the voice of an expert, Spencer Kimball, who runs the polling center at Emerson College, is with us. And it's great to have you back, Spencer. Welcome back to Balance of Power. I want to get into some new polling. This is really important because Emerson was one of the first to emerge, if not the first, with swing state data in the wake of Joe Biden stepping down and dropping out of this race. And we do have head-to-head numbers on Trump versus Harris. Important to note here, as I read from Emerson College, that Vice President Kamala Harris is trailing Donald Trump in 4 states and tied in another. That would be Wisconsin. But I want to start at a higher level with you, Spencer, before we dig into the granular here. The Trump campaign has been trying to telegraph this as essentially a blip on the radar. It's the same race, the same candidate, just with a different name. In fact, we keep hearing about the Biden-Harris administration when Donald Trump speaks and Republicans kick out messages this week. How about you as a pollster? Is this a game changer? Are we throwing up the pieces in the air, or is this just a slight aberration on the way to November?
Well, Joe, I think it was a game changer in the sense that after the first debate with President Biden, the Democrats were slowly drifting away from his or supporting his candidacy. And with Harris now, the presumption nominee, she kind of bounced back. She got that younger vote coming back to her. She's got some of that minority vote. So I'm not sure if it's enough to put her over the top, but it's definitely brought it back to a competitive race.
So let's take a look here. If you're with us on Bloomberg TV or on YouTube, you can see the data as we follow along with Emerson College here. Arizona, you've got 44 for Kamala Harris, 49 for Trump. He's leading as well in Georgia, 48-46. He's leading in Michigan, 46-45. Pennsylvania, 48-46. And we're tied in Wisconsin. You could argue that these are the 5 states that will determine the race. Our swing state poll, in fact, includes 7. But Spencer, that tie in Wisconsin should tell us a lot. And how do these compare to where we were with Joe Biden?
Well, it's interesting. Out in the Midwest, you're watching Harris competing much stronger than where Biden ended up last week after the debate. But where she struggles is out in Arizona. And Arizona is different than these other states. When we ask them their most important issue, for in Arizona, it's immigration, 30%. All of these other states that you mentioned, 40% was economy, was their top issue. And Arizona's different, and that's why potentially you're seeing a different result there at a 5-point lead, while all of the other polls are within 1 or 2 points.
Not a surprise then to see GOP ads, and there have been several already made targeting Kamala Harris, all focus on her record on immigration and border policy. Is that going to be the Achilles heel for the Kamala Harris campaign, knowing that she was assigned to the border by Joe Biden?
Well, certainly former President Trump will try to connect her to that issue. We'll see, obviously, out west how much that's going to play. We're going to take a look at New Mexico and Nevada, where that might be a big issue for those voters on the border. But then we got to look at the Midwest and see how they're playing with immigration. That's really a secondary issue. It's about 10% as the most important issue in those states. And as I mentioned, the economy, that's up at 40%. So while there might be some benefit on, some movement on the immigration, I think in those other states, it's going to be about the economy.
You talked to Democrats about who delegates should support here. And pretty remarkable considering where we were, Spencer, even a week ago, talking about various governors, whether it was Cooper or Beshear, Shapiro, Whitmer. The Democrat bench was full, we heard. And within, my goodness, 24 hours of Joe Biden announcing his decision when he kicked out that letter, Kamala Harris had the delegates to close the deal. What did you learn from talking with Democrats in this poll?
Well, generally speaking, they're rallying around Harris. As you notice, about 80% in each state would like Harris to be the nominee. And so that, I think, has a lot to do with some fallout from President Biden's debate performance, where Democrats were really concerned about not being able to beat Donald Trump. They see in Vice President Harris a potential candidate who will be more competitive. And that's what we're seeing in the numbers.
Let's play the Veep stakes here. You asked voters about her selection of a running mate, Spencer. What'd you learn?
Well, each state has their favorite son or daughter. We can go up to Michigan and they want their governor, Gretchen Whitmer. If we go out to Arizona, they want their senator, Mark Kelly. Georgia, Wisconsin, they're not quite sure. They kind of jump around between Pete Buttigieg and Bernie Sanders. But probably the strongest candidate out there is Josh Shapiro, the governor of Pennsylvania. Very popular in his home state. And Pennsylvania has the most electoral votes up for grabs.
Well, yeah, just among Democratic voters overall, Shapiro gets 57%. Next in line, Mark Kelly at 42%. Is it because Democrats believe Shapiro can carry Pennsylvania for Kamala Harris?
Well, I'm not sure if that's what's driving Shapiro's support, but I do notice is that he's got a lot of support amongst younger voters. And we don't really see that with any other Democratic candidate except for Bernie Sanders. So it would be interesting if he could kind of carry that baton of the youth vote that Bernie Sanders has been carrying for about 8 years.
Well, it's interesting, too, to see Arizona Senator Mark Kelly, 42% prefer their senator. Maybe that shouldn't be a surprise. But I wonder your thoughts on the Sun Belt versus the Rust Belt. Our Republican analyst, Rick Davis, was talking about this a bit earlier, that we spent so much time talking about the blue wall, that it was Pennsylvania, Michigan, and Wisconsin. And Kamala Harris may be opening a new path in the Sun Belt states. Do you agree?
Not right now. Look at Arizona. That's a big 5 points right there that she has to make up. And the top issue there is not something that is her strength. Maybe on the economy, as you were mentioning earlier, it seems to be rebounding. The markets are doing better. That might be, Bidenomics might be campaign theme more than the immigration. So it's going to be interesting in the Sun Belt. North Carolina was a state that we kind of moved off of the swing states. We'll see if she can bring it back in. About a fifth of the population there is African American, so that might give her a bounce in North Carolina. But I think giving up that blue wall, that's a big path for the Democratic success, and I would be very hesitant to do that.
So it sounds a lot like Shapiro to me based on this conversation, but I know the rules change based on the campaign. You asked an important question, Spencer, and I don't mean to be reading into this. You can tell me if I'm going in the wrong direction here, but a majority of Democratic voters in each state you talk to think Kamala Harris should be nominated at the Democratic National Convention this August. Does that imply that they do not want her to be nominated in this virtual call about a week from now?
I'm not sure about that. I think the virtual call is kind of going under the radar. That has to deal with the Ohio ballot access issue.
Yes.
It's going to have to obviously deal with potentially her running mate if that call has to go forward. It's a little gray about, the necessity of that call, but regarding the convention, I don't think that they would mix it up. I think they're looking for a new horse, and they were concerned that the president
70 counterparties take $381.257 billion at the Fed reverse repo operation.
We spent time with Spencer Kimball from Emerson College polling out with some of the first swing state data we're seeing since Joe Biden dropped out of the race. We're waiting for a debate. Spencer, I bet you are too. And it's interesting because we don't know if we're going to have one now. Kamala Harris tweeting last night, what happened to any time, any place? Because Donald Trump, I guess, doesn't like the venue or the network here that we were looking at for the next one. Trump spokesman Steve Chung says debate plans, quote, cannot be finalized until Democrats formally decide on their nominee. Based on your experience, do you think Trump's trying to get out of this? And will that have a bearing on polling and the final result in November? Voters want to see these two on stage together, right?
I would think so. I'm hoping that there'll be a debate. Obviously, the last debate had tremendous impact on this race, and so we'll see what the next debate might have. But with that said, voters are going to kind of come back in after Labor Day and focus in. And we've seen this previous years. If you remember, 16 years ago, John McCain was up 2 points after his convention and ends up losing to Obama by 7 or 8. So we see these swings in the polls when different things occur. This is a big shakeup, and I think it's going to take a few weeks for things to settle down.
Interesting to see no Trump convention bump. Is that fair to say?
Yeah, I would say that Trump kind of got his bump the previous week on the attempted assassination. Yeah, right. You saw it in the polls. He was up 6 points nationally. We haven't seen a Republican up that much since George Bush in 88. So that was that was a big bump. He seems, with Biden dropping out on Sunday, that seems to have taken away that momentum, if there was momentum with the J.D. Vance pick. And then now we're going to talk about the Democrats.
Well, I'm glad you could join, as always. Spencer Kimball with the breakdown on new numbers from Emerson College polling, where he is the director. We'll play it to the panel next. Rick Davis, by the way, says they lost by 6, but who's counting? This is Bloomberg.
names in business are on Bloomberg.
Middle market line draws are basically still about 5 percentage points below where it was pre-pandemic, which means as cost of borrowing went up, people aren't being quite as aggressive, and that's why the economy is slowing down. They're not hiring quite as many people. They're not buying that piece of equipment. They're not doing it because they're a little worried about final demand, and therefore they're being careful, which is unpleasant for your bank, but is okay because the companies are still making profitable and the credit quality is good.
Nobody covers business like Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Good morning from our world headquarters in New York. I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything. Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
It's 1:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks heading for their best day since February after key economic data this morning bolstered speculation that the Federal Reserve will be setting the stage next week for a rate cut in September. S&P up 83 to 54.83 in advance of 1.6%. The Dow's up 787 points now, a gain of 2%, while the NASDAQ Composite Index is up 254 points, up by 1.5%. 10-year at 4.20% with a 2-year 4.38%. Spot gold is climbing by $21 the ounce, up 0.9%. A retreat for crude, 77.46 a barrel right now on WTI, down by 1.1%. Big move for Bitcoin, up 3.3%, 67,444 on Bitcoin. Charter Communication shares are rallying after the cable and wireless company reported revenue that beat analyst estimates, boosted by a surge in residential mobile service. Charter up now by 16.8%. Again, recapping, stocks are rallying. S&P up 84, a gain of 1.6%. 10-year 4.20%. Balance of power continues now. Back we go to Washington. Once again, your host, and here he is, Joe Matthew.
All right, Charlie Pellet with the Friday trade. We thank you, sir. We'll be back with Charlie a little bit later on this hour as we keep tabs on the markets. Always here as we talk politics on Balance of Power. Thanks for joining us on the Friday edition. I'm Joe Matthew in Washington, where yesterday it was all about Benjamin Netanyahu here, meeting with the President of the United States. We talked about it at length. We brought you in the Oval Office for the pool spray, as they call it, as these two sat down, not agreeing on everything these days, certainly when it comes to a ceasefire. But there was another meeting that Benjamin Netanyahu held yesterday, and that was with the Vice President, Kamala Harris. Now, of course, suddenly at the top of the ticket, she gets her own sit-down, her own one-on-one with Benjamin Netanyahu. having an opportunity to delve into foreign policy. And unlike the president, this is really interesting, Kamala Harris spoke to the press after her meeting. We did not hear from Joe Biden following his. Here's a bit of what she said.
It is time for this war to end, and end in a way where Israel is secure, all the hostages are released, the suffering of Palestinians in Gaza ends, and the Palestinian people can exercise their right to freedom, dignity, and self-determination.
We assemble our panel for their take on this moment in the campaign. Jeannie Shanzano and Rick Davis are with us. Of course, Bloomberg Politics contributors, our signature panel. And a really interesting take earlier today in Politico, Jeannie, that in fact, Kamala Harris is saying all of the same things, essentially, almost word for word, as Joe Biden. But her words are being interpreted differently by Democrats here in Washington, many of whom have been critical of Joe Biden for the lack of a ceasefire deal, for the number of civilian casualties in Gaza. How does she leverage this moment for her campaign?
Yeah, I mean, I agree with that assessment. I think for many Democrats, we all know this has been such a divisive issue. And yesterday's speech, if you will, by Kamala Harris was so important because it's the first time we've heard her speak out in her own voice, not just as an emissary of Joe Biden on a foreign policy issue. And what struck me was how similar it was in substance to the Biden campaign, or the Biden administration, rather, but how her words were being interpreted differently, in part because her rhetoric is a bit different. She was, it was noticeable, for instance, that she took the time to carefully read out the names of each of those American hostages held by Hamas. She talked about the fact that Israel has a right to defend itself. And then she also walked this line of saying that she understands and is sensitive to the amount of civilian casualties and devastation in the Gaza Strip. So from that perspective, the rhetoric was a little bit sharper, if you will, than Joe Biden's has ever been, but the substance was the same. And I think this is something that is going to be left unresolved for Democrats. That's the first time. And in my mind, she's walking a very similar line to the Biden administration. Let's get a deal done. But there's not really a different path forward to doing that, if you will.
This is interesting to me, Rick. I wonder your thoughts as we hear from a former staffer to two members of the squad, Rashida Tlaib and Cori Bush. This is Abbas Alaway writing, Harris conveyed more sympathy for the plight of civilians in Gaza than President Biden did at any point. Abbas is the person who led the uncommitted movement in Michigan, Rick. Kamala Harris really isn't saying much different from Joe Biden in this case, is she?
No, this is just situational politics. They needed a scalp because they had been losing within their own caucus, the Democrats, on this issue. The far left, disagreed with the vast majority of Democrats. So they had to be mad at Biden. Biden was just as empathetic for the plight of civilians and Palestinians as anybody else in the party was going to be, but that wasn't going to be good enough for the left flank of his party. And so they took it out on him. And it created a weakness at a time when he was trying to consolidate the party. So they did some pretty good damage to Joe Biden at the time. Now, he's gone. Long live the king. Kamala Harris has done a much better job than anybody expected her to consolidate the Democratic Party in less than a week. And they are attributing the exact same statements she's making that Biden made to being a new look. And frankly, an amazing opportunity for her to seem like she's different than Joe Biden, which is a positive politically, right, without actually taking any risk to do it.
Well, I suspect she'll seem pretty different than Donald Trump on this issue if they get on a debate stage, Jeannie. And I'd like to hear your thoughts from both of you on this. I thought we had a debate. Everybody was a tough guy a minute ago. The Trump campaign now refusing to debate with Kamala Harris because she's not officially the nominee. Trump spokesman Stephen Chung issuing a statement here that plans cannot be finalized, quote, until Democrats formally decide on their nominee, knowing, of course, that, well, the debate was set for September. Nominating process happens in August. Harris posting on X in response, what happened to any time, any place? Jeannie, will there be one?
Let us hope. I am hoping there will be. You know, it's fascinating because Donald Trump was willing to debate Joe Biden when he wasn't nothing more than she is the presumptive nominee. And so you see Kamala Harris there showing a little, showing a little bit of bravado. You know, what happened to anywhere, anytime, any place. I suspect it depends in part on where we are poll-wise and everything else, whether this goes forward, and what the rules of something like this look like. You know, I've heard from people on the Democrat side who say that they don't know if this is something that Kamala Harris should do, but I am sure hoping that she does. And I think looking at the last debate, it can change a lot in these races. So we do have Americans really deserve to hear from both of them together.
What do you think about this one, Rick? Who has more to lose? Will there be a debate?
Well, I didn't think Joe Biden should debate Donald Trump, which turned out to be a disaster. And I got to tell you, I think they are high-fiving each other down in Mar-a-Lago. I mean, Susie Wiles has to be thrilled with that statement because the last thing they want to do is put Donald Trump on a stage with Kamala Harris. He is not a good debater. He's lost virtually every debate he's ever had. He would have lost the debate with Joe Biden had he not had a complete collapse by Joe Biden. It was a horrible debate for him. And once you see through the smoke, you realize this is not the way they want to conduct their campaign. They want to keep the attention on Kamala Harris, and they're going to do it through TV and radio and social media. And they don't need to risk getting on a stage with her. And so they'll find all kinds of different ways to avoid it. But my bet is they avoid it to the end.
Well, pretty remarkable when you consider the money that's already being spent in the ad wars here. MAGA PAC, the main PAC supporting Trump, adding $32 million in ads, attacking Kamala Harris through Labor Day. Jeannie, Future Forward, the big Dem PAC backing Harris, is going to spend $50 million on advertising in 6 states over the next 3 weeks. This gets back to what we were talking about yesterday. This is the race to identify Kamala Harris. Who's going to win it?
Yeah, the race to define Kamala Harris. And it is anybody's game right now. It is a jump ball, and Democrats really have to catch up on this. There is a great YouGov poll which shows the fact that voters see her policy-wise as similar to Joe Biden, and that is liberal, and that is going to be a problem for her in those key Rust Belt states that you were just talking about. So she really needs to define herself, and we're hearing that, but we need to hear more of that.
What do you think about this, Rick? The Republican ads from this week that were created in the wake of Joe Biden's announcement all refer to the Biden-Harris administration. Is that the right strategy, and is that what we're going to get the rest of the campaign?
I would. There's no question she's a part of it. She's been party to all those decisions. The economy especially has suffered under the Biden-Harris administration. And why not? It's fair game. I think that this is part of what they're going to try to do in this interim period. Go into her convention. Obviously, she has to do a better job than the president has done defining what they have accomplished on the economy and what their plan is going forward. It'll be interesting to see whether she rolls out a more aggressive inflation fighting program than what the administration is currently pursuing.
That would be fascinating. Are they spending enough in this case? Rick, Future Forward, the Democrat PAC, spending $50 million on ads, as I mentioned, in 6 states. Is that a number that you would have arrived at?
Look, I mean, I think combined with what the Harris campaign can spend on their now that we've been hearing anecdotally.
Rick there. Oh, yeah.
Yeah. Can you hear me? Hello?
I got you now, Rick. Finish your thought, yeah.
Hey, great. Democrats have been outspending Trump 6-1. I don't think that percentage is going to change much. They've got a load of cash there.
Rick Davis, Jeannie Shanzano, great conversation and a great analysis from both of you. Rick, we heard you and appreciate your finishing your thought here on Balance of Power. Much more to follow with Rick Davis and Jeannie Shanzano. They'll join us on the late edition of Balance of Power here on Bloomberg TV and radio. That's at 5 p.m. Eastern Time. Let's bring you up to date on world and national news. Right now, Amy Morris joins us from the Bloomberg 99.1 newsroom here in Washington. Hi, Amy.
Hi, Joe. Service on France's high-speed trains was disrupted by what officials are describing as coordinated sabotage ahead of the Olympic opening ceremonies. Jean-Pierre Farandot is the chief executive of France's state railways company, SNCF, and he says it's still too early to know who is responsible for this.
There's an inquiry running at the moment, so the police force are looking after, of course, the people who have committed this assault against the French network.
SNCF's Jean-Pierre Farandot. The railway company estimates 800,000 passengers have been affected by what it describes as a massive attack aimed at paralyzing the high-speed line network. Barack and Michelle Obama endorsing Kamala Harris in the Democratic race for president. The former president and first lady released a video this morning showing Vice President Harris speaking on the phone with both of them.
I am looking forward to doing this with the two of you, Doug and I both, and getting out there, being on the road. But most of all, I just want to tell you the words you have spoken and the friendship that you have given over all these years mean more than I can express. So thank you both.
In a joint statement, the Obamas said that there was no doubt in their mind that Kamala Harris can win. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself, actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that started in 1977, when by then I had a little research station, and 4 of my students were kidnapped, and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV, from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
What we try to do is combine some of our insights from the fundamental business with external and data set signals. And I think that's a lot of times where the opportunity is.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
top names in global leadership are on Bloomberg.
I envisage not only some kind of a bridge towards membership or language linked to the irreversibility of Ukraine's membership in NATO, but also some kind of a broader package of military material, of financial aid. The more we support Ukraine right now, the sooner the war will end.
Nobody covers the top global leaders like Bloomberg Television and Radio. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. Every major group in the S&P 500 rising on bets that the start of the Fed easing cycle will keep fueling the outlook for corporate America. Stocks on track for their best day since February after key economic data this morning bolstered speculation that the Fed will be setting the stage next week for a rate cut in September. Yes, we'll have Jay Powell's remarks live on Bloomberg Radio and Television. Make sure you catch it live here on Bloomberg. S&P right now up 63, a gain of 1.2%. The Dow up 657, up by 1.7%. NASDAQ higher by 167, up 1%. The Russell 2000 index of small cap shares up now by 1.2%. 10-year 4.20% with a 2-year 4.38%. Spot gold up $18 the ounce, up 0.8%, 23.82. And West Texas Intermediate crude now down 1.2%, 77.34 barrel. Bottom line, big rally underway. Shares of 3M are surging 18.5%, the most in more than 36 years after raising its full-year profit forecast. And U.S. authorities are accusing the famed short seller Andrew Left of committing fraud through stock trades, social media posts, and research reports, their biggest move in a years-long crackdown against traders who tout their bearish bets. Again, recapping, stocks higher, S&P up 63, up 1.2%. Balance of power continues now. Back we go to Washington, and once again, your host, here he is, Joe Matthew.
Thank you, Charlie Pellet, and welcome to the Friday edition of Balance of Power here on Bloomberg TV and Radio. We're live from Washington, D.C., with our eyes on the campaign trail and today's economic data, as we have been discussing both over the course of 2 hours here. A major moment, we can all agree, an historic moment in American politics here. It's also an historic moment for the media business, with hundreds of millions of dollars already spent on ads, more reserved on ads, and even more will be spent in the late fall as we make our way to November, with the news media struggling to cover this the right way, having gone through this before with a Donald Trump and a female Democratic presidential candidate. We've talked a lot about the rhetoric at play here and the challenges facing a news media tasked with live fact-checking and, of course, bearing out the truth here from both campaigns. We're joined by Jane Hall, back with us on Bloomberg, American University professor of journalism and media studies and author of the book Politics in the Media, Intersections and New Directions. Jane, welcome back. It looks like a new direction for us here, but it also feels back to the future in a way, as we're reminded of some of the rhetoric that Donald Trump has been using on the campaign trail, referring to Kamala Harris as dumb as a rock, as a radical, wants to be the president for savage criminals and illegal aliens. To what extent is this going to resonate with voters, having already heard some of this stuff before, and how should the news media be covering it?
It is in some ways back to the future, but I think that this is a very different moment in the media and in our politics than when Hillary Clinton had to figure out whether to call out Donald Trump for literally circling her on the stage. Kamala Harris is clearly moving to define herself and outrank and outrace Donald Trump and trying to tie her to the policies of the Biden-Harris administration. And what's very interesting to me is that if they do debate, and she's calling for that split screen, she will be far more effective, of course, than Joe Biden was able to be. But she also, I will be very interested to see how she says that she's going to prosecute the case. You know, if the news media call him out and ask him, how do you feel being called a 78-year-old criminal? They're clearly going to ask her, how do you feel being called a DEI hire? You know, that was one of the things that happened in the debates. And I think what's going to be interesting to see is, are the media going to ask her and him about the terrible things that are already racist, sexist, misogynist? You know, I think the other thing is that they don't seem to really know how to deal with a woman candidate. They seem to have been caught flat-footed. He said, I'm not going to be nice. He's deliberately mispronouncing her name. And that all reads as kind of a redo of Barack Obama in many ways, saying that he was not a legitimate citizen. The birther thing that happened. I mean, I think that the fact that they're being warned not to be racist and sexist, and they may not be able to keep Trump from doing that, is in Kamala Harris's favor ultimately.
Remarkable. It seems the Speaker of the House knows what you're talking about. We heard about this, Mike Johnson and Representative Richard Hudson, who chairs the NRCC, tasked with getting Republicans elected, asking members to cool the rhetoric. They can't do this with Donald Trump, but they did ask rank and file members of the House, Republican members, to stop with the DEI hire. To your point, I think it was Glenn Grothman, Representative Republican from Wisconsin, said that she was the likely nominee, quote, because of her ethnic background, unquote. This is part of the composite that you're talking about here. And it's one thing to cool it off in the House. It's a different thing for Donald Trump. You just said, he just said yesterday, I'm not going to stop being critical of Kamala Harris. So what are we in for?
Well, I think we're in for a campaign that is going to be fought very, very strongly, as you all mentioned in the ads. The right-wing media are clearly going to try to tie her to what is a big issue for them, immigration. I mean, that's one where I think she's vulnerable because she was tasked with that. And she's, you know, they're going to make the point that a bipartisan bill didn't pass because of Donald Trump, but she's going to be smeared in the right-wing media. Fox News is going to go after her. Trump is going to go after her. But what she has in her favor, I believe, is that the policies that have been enacted, the overturn of Roe v. Wade, the Supreme Court, policies that they can frame as anti-women of color. I think she's already benefiting also from all the memes and the social media. You can't buy that. That is organic. Young people saying, this is exciting. You know, she's going to have to win over people beyond young people, but she's clearly already moving ahead among voters on the Democratic side. And, you know, there are a lot of women over 50 who are a huge component. They aren't talked about as much, but there are a lot of women who don't like seeing another woman derided that way. Forget whether it's racist or misogynist or both. I mean, I think they've got a real problem if they try to link her that way. And I think, as I've said, it's going to be out there, whether it's stated explicitly or whether it's under the radar. And she has an opportunity to reframe that just by saying, this is what I've done. You know, this is who I've been.
Well, sure. It goes both ways, of course. You may not find an equivalency here, but what do you make of the whole weird talk of the Democrats describing Republicans It got to the point now where ABC News even wrote this up. Democrats' new line of attack on Republicans. You're being weird. This goes back to something that Kamala Harris said back in 2016 if Trump had followed her around the stage, something that you brought up earlier. But we're getting now Governor Tim Walz of Minnesota, supposedly on the short list for vice president, saying this on MSNBC on Tuesday. These are weird people on the other side. They want to take books away, be in your exam room. These are weird ideas. Is weird the new deplorable?
Oh, that's a very good point. I hope everybody knows you're referring to Hillary Clinton's remarks about a basket full of deplorables that she said.
Yeah.
I think that personally, I think going after anybody who's a voter who is on any side and calling them weird is not exactly the way to win. You can say they have weird ideas. You know, unfortunately for the Republicans, J.D. Vance has been called out and video has been shown where he talks about women, you know the phrase, childless cat ladies. I mean, I think that some of that is going to be talked about as being weird. But I do see an equivalency. I mean, I don't think you should be demonizing any voter if you want to get elected. I think what Democrats have been hoping for is somebody who could talk about what they've done and also take the fight to Donald Trump. I mean, that is what I think she is highly capable of doing.
Well, just like that, our crack team of producers has brought us a piece of tape to show what we're talking about and a couple of voices we're going to hear. Let's listen.
Donald seems to be drifting away from his own nominee because he's had so many weird views that he's expressed.
I see Donald Trump talking about the wonderful Hannibal Lecter or whatever weird thing he's on tonight. That needs to end.
What was weird was him joking about racism today and then talking about Diet Mountain Dew. Who drinks Diet Mountain Dew?
There you have Governors Pritzker and Walz talking there earlier. Look, I realize this is part of the game here, Jane. Obviously, you need a thick skin to be in politics. But the Democrats, does Kamala Harris need to call off the dogs the way Speaker Johnson did in the House?
Wow, that's such an interesting question. I personally, I come from a part of the state where there are a lot of Republican voters. I'm not sure. I think you can go after J.D. Vance just as J.D. Vance is going to go after Kamala Harris. I mean, people use their vice presidents as attack dogs. I hate to use that phrase, but I'm conservative on this. I think talk about what J.D. Vance said, talk about the policies, take the stance that Trump wants to take women back and people of color back. But I think it's early to say, but to call any voter weird, in my mind, you can say J.D. Vance is weird or J.D. Vance's ideas are weird. That's going to resonate because he's got a trail of video that is very odd in terms of women and children. It's just true.
Well, if you were watching, the Milwaukee convention on that Thursday night to see Hulk Hogan ripping his shirt off and the whole experience, you might have different ideas about who they were trying to reach and what exactly the message was in prime time there, Jane. I have to ask you, and weigh in on it if you want in our last couple of minutes, but if we had known about this, Kamala Harris, top of the ticket, before Donald Trump chose J.D. Vance, would he have gone with a different running mate?
Ooh, man, you're asking such good questions, in my opinion. I don't know. I think he went for somebody that he thought, would be a red meat person. I don't know if they would have made a different choice. They could have gotten Nikki Haley to run. They might have had a stronger ticket.
Nikki Haley, Tim Scott. I just wonder if they had gone in a direction other than another white man. Imagine the debate between Kamala Harris and Elise Stefanik or whomever Kamala Harris's running mate would be. Something to consider, isn't it?
Well, it is. We're into a whole gender thing. I mean, Hulk Hogan's, as the definition of men in this country, that's an argument that's very, very interesting in terms of gender and media. She's organizing white people, men for Kamala. I mean, they are very candidly going for a broader audience than might be perceived as being the narrow appeal that the Republicans are going to try to say she has.
We started this with a conversation about media coverage. How important is it for these two to debate, Jane? Because it looks like we're dancing around this idea now. Kamala Harris is saying, what happened to anytime, anywhere? Donald Trump says we need an official nominee. This isn't going to happen, is it?
Well, I don't know. You know, I'm not sure what I would advise. I mean, I think Kamala Harris is smart enough to know the traps for a woman. Women still have traps if they're too strident, if their voice is wrong. I mean, Hillary Clinton endured an awful lot of this. So, you know, I think it would be to her advantage to be able to talk about what her administration has done. I don't see any advantage to his doing it other than, I mean, I cannot imagine how anybody advising him would, he managed to hold it together in an hour and a half with Joe Biden. I mean, he has a record of going off the rails, particularly around women. I would not advise him to debate with her. Maybe she can debate an empty chair. You know, maybe they'll figure out some way that they can talk about how he isn't willing to debate her.
That's 2 this hour. Rick Davis said the same thing. Jane, it's great to have you back. We appreciate it, as always. Jane Hall at American University. The book is Politics in the Media, Intersections and New Directions. And boy, we are taking a new direction here, it seems. Watching Wall Street, by the way, does Kamala Harris need to start tweeting the markets? Maybe this is the new way to find some sunlight between herself and Joe Biden. Donald Trump would be tweeting all day today, Tim Stenovic. The Dow's up 670 points.
Yeah, I don't know. It had never been the Biden-Harris administration's thing, but then again, Joe, if she is trying to put some daylight between her and Joe Biden, maybe she does have to break from tradition over the last 3.5 years. Who knows?
And start pointing people to the good stuff. You got good data today. She's going to maybe, look, there could be a rate cut in September. Start tweeting about it now. Of course, Tim Stenovic and Emily Graffeo about to hold forth on Bloomberg Business Week. Right after Balance of Power. Tim, what do you have coming up today?
Hey, we're talking to Michael McKee, International Economics and Policy Correspondent, all about that data that you just mentioned. Plus, we're going to get an update about what exactly is going on in Paris, that massive attack on those trains. The opening ceremonies, they're underway now, Joe. But we'll get an update from Paris on what's going on there.
Can you explain the coconut tree to me next time we talk?
Yeah, I can do that. I can do it.
Just start Googling it now. Get your emojis ready. Tim, we'll be listening, of course, and Emily on Bloomberg Business Week. I'll meet you on the late edition of Balance of Power, 5 o'clock on Bloomberg TV and radio.
Liquidity is the lifeblood of an airline. We make very conservative decision making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
The top names in business are on Bloomberg.
Middle market line draws are basically still about 5 percentage points below where it was pre-pandemic, which means as cost of borrowing went up, people aren't being quite as aggressive, and that's why the economy is slowing down. They're not hiring quite as many people. They're not buying that piece of equipment. They're not doing it because they're a little worried about final demand, and therefore they're being careful, which is unpleasant for your bank, but is okay because the companies don't make them profitable and the credit quality is good.
Nobody covers business like Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
A very good afternoon, everyone. Live on Bloomberg TV, radio, streaming on YouTube, and on Bloomberg Originals. I'm Tim Stenevec. Carol Masser is off today. Joining me is Bloomberg News cross-asset reporter Emily Grafeo for this Friday edition of Bloomberg Business Week. How are you, Emily?
I'm good. I'm doing well.
Hey, thanks for joining me for the next hour on TV, the next 3 on TV, radio, and YouTube. And we got a great couple of hours coming up. This hour specifically, markets cheering a series of Fed-friendly data points, including core PCE figures that rose at a tame pace in June. Also, consumer spending remained healthy. Stocks up, yields down. More on that in just a minute with Bloomberg News international economics and policy correspondent Mike McKee, who is standing by.
And still ahead, a quote, massive attack on Paris's super-fast rail network has disrupted trains and cast a shadow over tonight's opening ceremony. We have the latest on the sabotage and why, separately, the Olympic cyber team is bracing for an onslaught from hackers.
Okay, well, from hackers to comedy, Joe Rogan, the world's most controversial podcaster, widely considered the most popular podcaster in the world as well. He's building a Texas comedy empire after fleeing California. We get the latest from Felix Gillette.
And we're joined by the managing partner of Illumin Capital, a fund working to achieve racial and gender equity across investing.
All that and more over the next hour. First up, though, a check of the day's trade and top business stories. Here's Charlie Powell.
Hi, thank you very much, Tim and Emily. We have got the Dow, the S&P, NASDAQ, Russell 2000, NASDAQ 100 index, all rallying today with gains of 1% or more. The U.S. stock market getting a big boost at the end of a wild week after key economic data bolstered speculation that the Fed will set up the stage for a rate cut in September. Every major group in the S&P 500 higher right now. S&P back at 54.66, up now by 66 points, a gain of 1.2%. We're off session highs. The Dow up 690 points, up 1.7%, while the NASDAQ Composite Index up 182, higher now by 1.1%. The Russell 2000 of small cap, the index of small cap shares up now by 1.3%. 10-year 4.19% with a 2-year yielding 4.38%. Spot gold up $19 the ounce, up 0.8%, and West Texas Intermediate crude at right around $77 a barrel, down today by just about 1.3%. Dexcom shares are plunging after the company cut its full-year sales forecast for the glucose monitoring devices that are relied upon by diabetics. Shares today of Dexcom, they are now down by 41%. So again, recapping here, 700-point gain for the Dow, up 1.8%, S&P up by 1.3%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
41%, that is what you call a haircut. Well, the Fed's preferred measure of underlying U.S. inflation, core PCE, rose at a modest pace in June. Consumer spending also remained healthy, encouraging signs for officials who are looking to cool inflation without breaking the economy. As far as the numbers look, core PCE, of course it strips out volatile food and energy, rose 0.2% from May. From a year ago, it rose 2.6%. That's according to Bureau of Economic Analysis data that came out this morning. Wall Street's certainly happy about the data. We see stocks higher, we see yields lower. For more, we turn to Bloomberg News International Economic and Policy correspondent Michael McKee, who joins us here in the studio. Mike, is this exactly what Jay Powell wants to see?
Yeah, basically. I was going to say not quite, but I think he'll settle for this.
He wanted to see it even lower.
They wanted to get back to 2%, but they did say that they were going to start cutting interest rates before they got to 2%. And he had said a little while ago that the range of 2 to 2.5%. As long as they got into that range, they'd be good.
So any change for next week based on this data?
No, because they didn't set the markets up for that. They don't like to surprise the markets. Now, I suppose there could always be a leak to the Wall Street Journal. That's only happened once in the last 15 years or so, but people do think of it as a realistic possibility occasionally. But in this case, I think they will be satisfied to wait, because what ends up happening is that bond yields go down if they signal that they're going to cut rates in September. And so they get the effect of a rate cut even without doing it.
So square the data that we got today with the GDP data that we had earlier this week. Are we in a Goldilocks scenario now, with inflation moving in the right direction and the economy still strong?
Well, I'll see your cliche and raise you one and say soft landing. I think either one is probably a good description, but only as to where we are right now, because we don't know what's coming around the corner, and there are certainly analysts who think that we could be closer to an economic contraction than anything else. But right now, it looks pretty good. The GDP numbers were strong and led mostly by consumption, business and consumer spending, which is what you want to see. You want to see the demand remain. It wasn't too bad. Personal spending rose just 0.3% in the month of June. May and April had been revised higher, which helped the GDP numbers. So overall, it's exactly kind of what the Fed wants to see. Sustainable growth. 2.8% is a little high, but they anticipate it coming down. But sustainable growth with continually falling inflation.
Okay, so separately, U.S. consumer sentiment eased in July to an 8-month low, showed that consumers see prices remaining high, and that cooling inflation rate has not yet helped improve their mood. Why do consumers remain so unhappy in this environment?
Well, there are a couple of reasons. One is, you've heard this before, that it's the price level, not the price change, that bothers people. And another is the overhang of bad news that we have had in so many areas in the last 6 months or so, the wars and the violence and that sort of thing, and the attempted assassination of Donald Trump occurred when they were surveying. Now, what probably did not get picked up was the change at the head of the Democratic ticket. When you look under the hood, and the University of Michigan's been surveying this for a long time, but they ask people, if you're a Democrat, Republican, or Independent, are you more confident or less confident? And Democrats were less confident, Republicans only slightly more confident, and Independents less confident. And given the reaction that we have seen anecdotally and in some polls already, you would expect Democrats to be feeling a little bit better right now. So maybe we get that next month.
Yeah, maybe. We'll have to wait and see. Mike, what about the idea that generationally inflation hasn't been around in many lifetimes of consumers, perhaps consumers who are completing these surveys? Does that have to do with this too?
It probably does, because you get used to a certain price level and you get used to inflation being so low. Alan Greenspan's goal always was that people could make decisions without factoring inflation into it, and that was the case for so long. And now people had to cut back on spending because prices were going up so much so rapidly. It's also true that it hits the lower income people much worse than upper income people, because they spend most of what they earn, and inflation's been tough on them. But I think the generational aspect is also true, because of course there are those of us who remember the 12, 13, 14% mortgage rates that we once had in the olden days.
Yeah, well,
you remember that?
I do not remember that. Thank you, Emily, for bringing that up. But it is something we hear a lot when people do complain about 7% mortgages. Yeah. But there are a lot of differences between that environment in the early 1980s and the environment today. Here's what the team at Bloomberg Economics said about some of the data that we got today, Mike. Though spending continued to grow at a healthy, albeit slower clip, income growth slowed more rapidly, and with the labor market cooling, we think consumption growth will ease further in the second half of the year. Is there concern that it will slow to the extent that we could start to see negative payrolls? We could start to see a recession?
That would be kind of far left tail risk. It's not what most people are anticipating. Slowing is what we should be getting with the Fed interest rates where they are. And even if they cut in September, 25 basis points isn't going to spur a lot of people. 6.75 mortgage is just as bad almost as a 7%. But it's going to be the process that starts sending it down that will make people feel better.
Okay, before we let you go, we talked a little bit about the Fed meeting coming next week, the payrolls report coming on Friday. 175,000 is what I saw at last look for jobs gained during the current month that we're in. What do we need to be on the lookout for a week from today?
Well, two things. We'll be looking to see if the last 2-3 months we have had forecasts in the range of 175, 180, and they've come in significantly above that. So we'll have to see if that trend continues and if the other trend of the previous months being revised down continues. But the biggest thing is going to be the unemployment rate this time. We're at 4.1% now. That's the forecast for another month. But if it goes to 4.2, we're going to trigger the Somme rule. And
Claudia's phone will be ringing.
Claudia's phone will be ringing. And it will, as I said, scare the markets, scare the horses, and we'll see what kind of reaction we get. There will be people in that case who are saying, got to cut right away, got to cut right away, because it already means we're going into recession. Fed doesn't think so because they think it's not that people are getting laid off, but just more people coming into the labor force that is pushing up unemployment. And that, in the long run, is a good thing.
Yeah, labor force participation. You want to see that go in the right direction. Our thanks to Bloomberg News international economics and policy correspondent Michael McKee, staying late for us on this Friday because he was in really, really early this morning, so we appreciate that. Well, the opening ceremony is continuing as normal in Paris for the Olympics after a, quote, massive attack on the country's super-fast rail network disrupted trains and cast a shadow over the event. It's not just the trains that the organizers are concerned about, though. The Olympic cyber team is bracing for an onslaught from hackers. So writes Jamie Terabay, Bloomberg News cybersecurity reporter. She joins us from our Washington, D.C. bureau. Jamie, good to see you on this afternoon. I want to start with the trains because lots of us in the U.S. here waking up to the news that French Transport Minister Patrice Vergret said were, quote, coordinated malicious acts that targeted several TGV lines and will seriously disrupt traffic until this weekend. What's the latest? Do we know who's behind the attacks? Do we know the motives behind the attacks? And do we know when these trains will be up and running again?
Look, right now, there has been no claim of responsibility, but it could frankly be any number of groups that are seeking to destabilize these games. They are in the heart of Paris. The entire world is watching, and whether it's homegrown, disenfranchised actors, we've seen France go through a very particularly tumultuous period recently. And of course, we have external forces as well. The physical security aspect of the games has been something that has been a really big concern amongst the French authorities. They've brought on tens of thousands of soldiers and police force and even private security guards to be part of that effort. They've had anti-drone exercises happening within the city. Because the games are happening in the heart of town, along landmarks, there is an even greater exposure to possible weaknesses in the system. And this wasn't a coordinated arson attack. And I understand that they're still in the process of getting everything back on track, but it's a big glaring target for a lot of different people with a lot of different motives to destabilize and ruin this for France and for the international sporting community.
Jamie, talk a little bit more about the extent of the damage that a cyber attack like this one has caused. We know that rail traffic was disrupted and that there were fires. Explain a little bit more what actually happens when there is a cyber attack at this scale.
So we know that this was an arson attack. So sounds like it was a deliberately set fire at each of these signal stations. A cyber attack would come in from the systems itself and cause a breakdown or a shutdown of an electric grid, of a network, of computers. It could reboot. It could cause all kinds of chaos. We could see hackers try to get malware into a system to lock it up and paralyze it. We've seen that happen in past Olympic Games, in the Pyeongchang Winter Olympics, on opening day, on the opening ceremony. In fact, there was a very disruptive cyber attack, which was later attributed to Russian actors. There are so many different points along the critical infrastructure that make up the games. The French cybersecurity agency, ANSSI, has named 500 different entities that they say are critical to the smooth operation of the games. They've been working with these groups for months, if not years, to shore them up, to audit their systems, and look at how they can be as strong and as muscular as possible when it comes to anticipating and expecting these attacks and being able to respond if and when they do see them.
Jamie, talk a little bit about the Russia element here, because as they have in Olympics past for other reasons, they are not necessarily present as they have been in the past at the Olympics this year, shut out in a sense. Give us an understanding of where Russia is when it comes to potential cyber attacks and what the French and its allies are prepared for.
This is, it's been explained to me in a lot of different ways as almost the perfect storm for Vladimir Putin. He and the Kremlin-affiliated hackers have been attacking France for a very long time through the cyber landscape. They have had people, particularly with President Macron and his attitude towards Ukraine and his support for Ukraine and his part in beefing up NATO has been a particular target for Russia. With the Olympics happening, it is a moment of international prestige. The opportunity for the Russians to disrupt this moment for the French and for the French leader in particular is essentially just an irresistible moment for him. In the past, as you've said, we've had Russian hackers erase data sets or really disrupt past, the roles of organizations like the anti-doping agency because Russian athletes' doping results were somehow erased from the national data set or from particular data sets. We've seen disruptions from the Olympic destroyer event during the Pyeongchang Winter Games. Right now, we're seeing a lot of disinformation campaigns that have been happening in the lead up to and are currently happening at present that began on Russian language social media platforms that are spilling over into the media, into mainstream social media platforms, really disseminating messaging like there's too much terrorism, risks in Paris, France is on the verge of civil war, Paris is not clean, Paris is not particularly friendly, it's a terrible place to go as a tourist, and all sorts of disinformation opportunities that are being attributed to Kremlin-associated hackers. We're also seeing brute force attacks on websites. So what that is when there's so much traffic directed at websites that it cripples their traffic and their ability to operate. We've seen that recently on targets, including the French Film Festival and also the Grand Palais, which is going to be one of the Olympic venues for Taekwondo and I believe fencing. So they're not going to stop. They're going to do everything they can from here going forward to amplify, to disrupt, to create as much chaos as they can, because the ultimate aim here is to not give the French their moment in the international spotlight without some kind of disruption.
Jamie, we only have about a minute left, but what do we know about the U.S.'s involvement in keeping the Olympics safe and the participants safe as well?
we have, we understand that representatives and employees from CISA, the U.S. government's cybersecurity agency, are on the ground in Paris, operating out of a joint operations center. We understand that there are also other American observers who are going to be there throughout the entire event. You've also got to remember that the next Summer Games will be in Los Angeles in 2028. So there is a real opportunity here for lessons learned for the Americans to be watching what's going on in Paris, how they anticipate and deal and encounter all of these challenges, and how they can apply them in 4 years' time. So there's definitely an international effort. The French are not alone in this. Everyone is supporting them on the allied Western side, and they're certainly seeing that in the private sector as well as in the public sector.
Jamie Tarabay, Bloomberg News cybersecurity reporter, joining us from our Washington, D.C. bureau. Up next, Joe Rogan, the world's most controversial podcaster, also perhaps the most popular in the world. He's building a Texas comedy empire. That's next on Business Week.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
What we try to do is combine some of our insights from the fundamental business with external and data set signals. And I think that's a lot of times where the opportunity is.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, NASDAQ 100 index, Russell 2000, all rallying gains of 1% or more on this Friday. Stock market did get a boost at the end of a wild week after key economic data this morning bolstered speculation that the Fed will set up the stage for a rate cut in September. Every major group in the S&P 500 higher right now. S&P up 62, a gain of 1.2%. The Dow up 684 points, up 1.7%. The NASDAQ Composite Index up 1%. The NASDAQ 100 Index also up 1%. And the Russell 2000 Index of small cap shares up now by 1.3%. 10-year at 4.20% with a 2-year that's yielding 4.38%. Gold up $21 the ounce, higher by 0.9%. And a retreat for crude oil down 1.3%, 77.26 a barrel. Bitcoin today rallying 3.4%, 67,489 on Bitcoin. 3M shares up the most in more than 36 years after raising its full-year profit forecast as its new CEO vows to reinvigorate the iconic manufacturer's innovation engine. 3M up now by 21%. 3M, by the way, the maker of Post-it notes. Again, recapping, S&P up 65, up 1.2%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Hey, thanks so much, Charlie. Do appreciate that. You guys are all familiar with Joe Rogan. He's widely believed to be the most popular podcaster on earth. He's got a huge Spotify contract. We're talking hundreds of millions of dollars. On message boards, people sometimes describe him as Oprah Winfrey for men. Well, about 4 years ago during the pandemic, he decamped from Los Angeles and relocated, he and his wife and 3 daughters, to Austin, Texas. And since then, he's cultivated a lifestyle tailor-made for the new age of the comedy profession. It's ruled by podcasts instead of Hollywood movies and sitcoms. He's got a new podcast studio, he's got a sauna, a bow hunting range, and most important, a new club, the Comedy Mothership, for doing stand-up, all of it engineered to share with his friends. And over the past 2 years, a growing group of comedians and podcasters have followed Joe Rogan to set up shop in Austin. Felix Gillette and Ashley Carmen write about Joe Rogan for Bloomberg Business Week. Check out their story. It's on the Bloomberg terminal and at bloomberg.com/businessweek. Felix is Bloomberg Business Week media, entertainment, and telecom editor. He's also the author of the book, It's Not TV, The Spectacular Rise, Revolution, and Future of HBO. He joins us here in the studio. Felix, how much Joe Rogan did you listen to when writing this story?
A lot of Joe Rogan. Yeah, like months and months of Joe Rogan.
Really? Months?
Yeah, because he wouldn't talk to us. He doesn't really do interviews, and he loves to talk about the comedy stuff, the comedy club on his show. So it's mixed in with, moon landing conspiracies and a lot of MMA, minutia that I don't really need to know. But it was interesting. You get his whole perspective on the comedy world.
So not just recent podcast episodes, but episodes going back a few years?
Yeah, for years he's been talking about this. I mean, he moved from LA to Austin about 4 years ago. And yeah, he got down there and he just, like everyone who moves to Austin, they just can't shut up about it. It's the greatest town ever. We got the best barbecue, like it's incredible.
It's
like the hill country. Summer. Yeah, it is hot in the summer. But the one thing he didn't have is he missed having a place to perform because he was a regular at the Comedy Store in LA. Austin had a stand-up comedy scene over the years, but it was always pretty minor, especially compared to the live music scene there. And so he was like, you know what? Like, I'm just going to build a comedy club for myself and my friends, and I'm going to spare no expense. He said on his show that, it's not to make money. He just doesn't want to lose money on it, but he basically just puts all the money back into the comedians, and it's a really nice club. And because Joe Rogan is Joe Rogan and he has, this huge platform that anybody who goes on Joe Rogan's show is going to get a bump for their comedy show, their podcast, their book, whatever it is. So his ability to recruit people is amazing. And every time he has someone on the show, he gives them the sales pitch. Come to Austin, come hang out with me. You can perform at the club. You can come on my show. You can have your show. You don't have to be, tethered to the studios of LA and New York anymore. Just move here. And, some people resist, but a lot of people have heard that pitch and been like, Yeah, okay. And, Shane Gillis, Brian Simpson, Tony Hinchcliffe, some pretty big name comics have moved down there. And, they all are headliners at the club and hang out with Rogan outside the club. There's like this whole scene around the bar at the Comedy Mothership. It's kind of fascinating when you're there because you have this feeling that anyone that's kind of in that world, Elon Musk, Johnny Manziel, anyone that's been on Rogan's podcast recently could pop in at any time. That's kind of like their clubhouse. And it's been this and then that's at the top end. And then there's been this whole trickle-down effect in Austin, where since Rogan opened the Comedy Mothership, there's now maybe a dozen other comedy clubs that have also opened up in the vicinity in downtown Austin. And now if you talk to like young aspiring stand-up comedians, which we did for the article, instead of moving to New York or LA to try and make it, a lot of them are now like, you know what, I'm going to Austin. So there's all these group houses popping up in Austin where you have, 10, up and coming stand-up comedians all packed into a house doing the open mic nights around town and desperately trying to get a spot in the Comedy Mothership.
So Joe Rogan embraced Austin, but in your reporting and Ashley's reporting, did Austin embrace Joe Rogan?
Yeah, I think they have to a certain degree. Austin has been such a boom town. It's been like the fastest growing city, every year for like 12 years. I think they lost the title this year, but there's been a ton of people moving there, including a lot of people from California. And, there's this expression in Austin politics now, which is, don't California my Texas, which initially people thought, oh, all these, California immigrants are going to make our, the state bluer. And actually, in the end, what's happened is it hasn't been like the liberals who've moved out of California. It's the more libertarians, tech folks that want low taxes have moved to Austin, Elon Musk, all these tech companies. So actually Austin has gotten a little bit less liberal over time. And I was talking to Evan Smith, who's the co-founder of the Texas Tribune. He's a longtime Austin journalist. And he was saying, there was a time where if Joe Rogan had moved to Austin, there would have been like an outcry. But those days are basically over. Like there was a little resistance at the beginning, but then they're like, well, he's putting all this money into downtown Austin. He's revamping this part of town that really suffered during COVID. And the town has embraced him.
Can you talk a little bit about how podcasting has disrupted the traditional comedy route? Because back in the day, the whole idea of becoming a successful comedian, you go and do some really good sets, you get on one of the late shows,
right?
You do really well on the late shows, and then you're given a sitcom, and that was like gold.
Yeah.
That was the way to get to the top.
Yeah.
It's not like that at all anymore.
No. The whole profession has really shifted, and it's fascinating to think, in the 1970s, the big upheaval in comedy was when Johnny Carson moved The Tonight Show from New York to LA. And that was the biggest thing, like getting to do your show, your act on The Tonight Show, and that could just catapult you. You get a sitcom, you get a movie, whatever. And all the producers on The Tonight Show would recruit, and they used to recruit at the comedy clubs in New York. When the show moved to LA, that all moved to the Comedy Store, and so the Comedy Store was like the place to be back in the day. And that was eventually decades later, that's where Rogan hung out. A lot of his friends are like Comedy Store comedians, and I think they also saw that connection that existed back in the day between The Tonight Show and the Comedy Store. Late night television, no longer what it once was. But it is fascinating that now, like, the big thing is Rogan's podcast. And similarly, the comedy club that he runs is now kind of like a gateway. And that's where talent is like, pulled to, with the hopes of like, well, maybe if I kill it, maybe if I just absolutely make a name for myself at Rogan's club, maybe then I get on his podcast, and that's seen as like, the big place to be. And even people that are out there, promoting whatever it is they want to promote, especially to the demographic that listens to Joe Rogan, which is like young men, primarily. Like, if you're selling something to that demographic, yeah, like you want to get on his podcast, you want to get on the podcast of all of his friends who were also in Austin, this whole little universe, the Roganverse, as we like to call it. And we talked to like Tucker Carlson, who's trying to launch
NYMEX
his own
WTI
streaming
crude
network,
September futures settle at $77.16 a barrel, which is up $1.12 or one spot 43% on the session.
Does another podcast in the club, and just goes hang out in the Mitzies. Like that's the new place to be. And it is a huge shift for the industry.
So what's the comedy like at the club? Is it all branded with the Joe Rogan, carnivore diet?
Yeah, I mean, you would think and when it first opened, people were like, oh, it's a anti-woke club, it's all going to be Rogan style humor. In truth, it's not really like that. It's much more just like a anything goes comedy club. I mean, it's like whatever people are doing that's funny, you can get up there. Some of the humor is, political, but most of it's not.
So how's the club different than other comedy clubs that people would go to?
I mean, first of all, it's very hard to get into these days. I mean, that's part of why, another dozen clubs have opened up in Austin, because it's just really hard to get a ticket just to get in there. Additionally, it's kind of like Rogan's guys who are the headliners. There's a smaller room, and there's a whole system, a hierarchy in the club. If you get a job as a door guy, then you work at the club, then you can do the staff shows in the smaller room. If you really are successful there, maybe you'll get up to the top room. But it's kind of like, there are definitely like plenty of big performers, comedians around the country that will never go to the Comedy Mothership. It really is kind of like a place for Rogan, the people that are already in his inner circle, and the people that are desperate to get into his inner circle.
Just very briefly, you're not allowed to bring a phone or cameras or anything in, but they have cameras set up for a very special reason.
Yeah, because you're gonna start seeing more and more live shows on Netflix. Netflix just did their first live show. Brian Simpson did a live from the mothership. You'll see more of that. The whole place is wired so that they can do specials.
Well, it's a great story by Felix Gillette and Ashley Carmen. They write about Joe Rogan for Bloomberg Business Week. Do check it out. You can read the story on the Bloomberg terminal and at bloomberg.com/businessweek. Felix, also the author of It's Not TV, The Spectacular Rise, Revolution, and Future of HBO, joining us here in New York. From New York to Washington, D.C. now for a check of the latest world and national news. We got Amy Morris in the Bloomberg 99.1 newsroom. Hey, Amy.
Hi, Tim. Barack and Michelle Obama have endorsed Kamala Harris in the Democratic race for the White House.
We called to say Michelle and I couldn't be prouder to endorse you and to do everything we can to get you through this election and into the Oval Office.
Former President and First Lady released that video this morning showing Vice President Harris speaking on the phone with both of them. The Summer Games are underway after service on France's high-speed trains was disrupted by what officials are describing as coordinated sabotage ahead of the opening ceremonies. Jean-Pierre Farandou is the chief executive of France's state railways company, SNCF, and he says it's still too early to know who is responsible.
There's an inquiry running at the moment, so the police force are looking after, of course, the people who have committed this assault against the French network.
SNCF's Jean-Pierre Farandou. The Manhattan DA, meanwhile, urging a judge not to overturn Donald Trump's hush money conviction. State prosecutors claim the Supreme Court's July 1st decision on presidential immunity for official acts made as president have no bearing on Trump's conviction on charges that he falsified business records in New York. Trump's lawyers argue that certain pieces of evidence should not have been introduced during that hush money trial under the Supreme Court's new ruling. Trump, meanwhile, denies any wrongdoing. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
you learn about this case, the more it reads like a Hollywood script. The nature of the killings, the execution, the just brutality of it.
It wasn't in the psyche of people that they could be looted because they are considered so sacred.
And we did it the way you do every single investigation. How do you eat an elephant? One bite at a time.
It jumped off the page at me that you could see that there was a Ponzi scheme taking place.
I started hearing mafia, mafia, mafia.
Il sistema è perfetto. Sono gli uomini che spesso non lo sono.
These are the holders of truth and justice. They cannot be possibly be doing this. But then they are. They are. And the evidence is there. It's overwhelming.
Season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. The top names in global leadership are on Bloomberg.
I envisage not only some kind of a bridge towards membership or language linked to the irreversibility of Ukraine's membership in NATO, but also some kind of a broader package of military material, of financial aid. The more we support Ukraine right now, the sooner the war will end.
Nobody covers the top global leaders like Bloomberg Television and Radio.
I decided to acquire Indeed 12 years ago when I was 36. I couldn't speak English, but I decided to move to the US with my family. Okay, let's study English. Let's, manage this big American company. But I could do it. Ages are just numbers. If you stay being very curious to run new things, you can keep doing that. So what we're trying to adjust is our company should be the place to maximize people's ability, people's talent, and people's passion, right? Our employees' passion. So we believe that if we can have the work or the vision, people can be passionate, and which is aligned with all what employee wants to do, that's the best way to maximize the people's ability.
Follow your passion.
That's right.
So whether you're 14 or 40 years old.
I think so. Because, what's the difference? I don't know. We might be totally wrong. That's how we have been running this company for 60 years.
The top names in business are on Bloomberg.
Middle market line draws are basically still about 5 percentage points below where it was pre-pandemic, which means as cost of borrowing went up, people aren't being quite as aggressive, and that's why the economy is slowing down. They're not hiring quite as many people. They're not buying that piece of equipment. They're not doing it because they're a little worried about final demand, and therefore they're being careful, which is unpleasant for your bank, but is okay because the companies are still making profitable and the credit quality is good.
Nobody covers business like Bloomberg.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We've got just over an hour to go ahead of the closing bell. Stocks ripping higher. Every major group in the S&P 500 higher on bets that the Fed easing cycle will keep fueling corporate America with the bull market broadening beyond a narrow group of companies. Right now, the S&P 500 index is up 65 points, advancing by 1.2%. The Dow closed to session highs up 698, up by about 1.7%. While NASDAQ is up 185 points now. For NASDAQ, a gain of 1.7%. The Russell 2000 up now by 1.4%. And Dow Transport's up by 1.8%. 10-year 4.19%. The two-year yield, 4.38%. Gold is advancing $20 the ounce, up 0.9%. West Texas Intermediate crude, 76.85 a barrel, down 1.8%. And Bitcoin is rallying 3.3%, 62,423 on Bitcoin. Bristol-Myers Squibb shares up 11%. It raised its 2024 profit forecast as demand for its new medicines suggested the company has gotten past a dip in performance. Again, Bristol-Myers Squibb up now by 11%. Again, recapping, stocks higher. S&P up 62, up 1.1%. 10-year yield 4.19%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thanks so much for that update, Charlie. Do appreciate it. Well, you may have heard over the last month or so quite a bit of DEI news, at least on the corporate side. So just last week, Deere and Company, it's the world's largest top farm machinery maker, said that it was pulling back from diversity measures in the face of conservative criticism. It was the second ag-related company in less than a month to bend to such pressure. At the end of June, Tractor Supply, you might recall, said it was eliminating DEI roles and retiring DEI goals, quote, while still ensuring a respectful environment. So some companies are pulling back when it comes to DEI, and others are leaning into it, like the investment firm Illumin Capital. Darren Dodson is managing partner at Illumin Capital. It's a fund of funds that's working to achieve racial and gender equity across investing. Darren joins us from Oakland once again. Darren, good to have you back on the program with us. Good to see you. Illumin just received its annual report, or released its annual report. We're going to get to that in just a minute. But first, I got to get you to weigh in on what's happening on the corporate side, because at least at some companies, when it comes to DEI, we've seen the environment shift quite a bit over the last couple of years. How are you watching this?
Well, of course, our strategy at Illumin Capital is to address biases as a methodology for unlocking economic value. So those that are pulling away from DEI have to be really careful that they're not pulling away from returns, because that's exactly what our research in partnership with Stanford Spark shows, that as we address biases, we are able to see underlying returns that sometimes we miss if we don't address them, particularly racial biases, which we found that systematically Black fund managers that are outperforming are overlooked by asset allocators when they're trying to achieve the highest return. They basically go against their own training in selecting high-performing managers when race is present. So I think there's a lot of work for those that are moving away from DEI, particularly at that intersection of DEI and bias.
Do you think it's a mistake for companies, and I'm not talking about investment firms or firms that are making investments, but companies like Deere and like Tractor Supply, is it a mistake for them to distance themselves from DEI after getting criticism from customers?
Well, what we've found is that our investors that represent a number of the largest institutions and foundation endowments, pensions, others in the country are really excited to do the work to address these biases, because they believe that there's tremendous economic value on the other side of that. And that's also what our research in partnership with Stanford Spark shows. So I think that leaders of corporations would do well to also look at their biases and resource allocations. Of course, Daniel Kahneman won the Nobel Prize in this area in looking at systematic bias and resource allocation in firms. And when we look at the intersection of bias and the way that it shows up with women and people of color as they outperform, yes, there's some important work for leaders of companies to do in that area as well.
So tell us more about why you founded Illumin Capital, and what are you looking for if you're running a fund of funds when you're selecting different portfolio managers and different
And
funds
seeing
to
Brent
invest
crude
in?
futures settle at $81.13 a barrel. That's down $1.24 or 1.51%.
So our research showed that as Black fund managers outperform, many miss that outperformance and basically fall back on their own biases. So when we tested leaders of university endowments that allocate large pools of capital, when we talked to sovereign wealth funds managers, and when we tested them for bias, we found systematically they went against their years and years of training and didn't select the highest performing managers, leaving money on the table. So in short, what we look for is high performing managers that others in the market overlook. And that's part of the reason why, with our recent impact report that was referenced at the top of the program, we found that our managers are about double the industry averages in terms of women partners, and also 4 times the industry average in terms of underrepresented people of color, where we believe that interrupting these biases and finding these overlooked and underestimated managers will result in continuing to create economic value for our investors.
Darren, do you think that because you're investing in what you call overlooked fund managers, you're able to invest at some sort of discount because the market's not actually taking into account what their performance is and what their performance could be?
I think that it's very similar to the way that Charlie Munger invests. When there's latent value in the market because others are overlooking it, and you partner with people to deliver on that latent value, that's a partnership. So we partner with our managers. We also have a unique program, the Illumin IQ proprietary training program, where we help them to identify companies and their underlying strategies that are also overlooked and underestimated. So we do a tremendous amount of work alongside of the funds that we select to ensure that they are also beating their biases and choosing the best companies in the marketplace as well.
What kind of evidence and research do you have that kind of shows a real connection between meaningful returns and portfolio outperformance and this DEI factor, we could call it?
I think the most substantial research, there's probably about 40 years showing the outperformance of managers of color and women-led firms done by the National Association of Investment Companies. And what was really unique about our research in collaboration with Stanford Spark and a number of the leading professors in the world in this particular area is that what we found is that not only was there years and years of outperformance, but there wasn't asset allocations to follow that outperformance of women and people of color managers. So we had to ask the question, why? And what we found in our research is that likely biases are interrupting people's ability to see high-performing Black-led funds, as we published in the Proceedings of the National Academy of Sciences in a peer-reviewed paper. And that is really important information for those that are looking to make money in financial markets, is that if they're looking at their investment strategies and they're finding that they don't have women and people of color within their portfolio construction, they have more work to do to address their biases to ensure that they're not interrupting their opportunities for more returns over time.
Hey, Darren, just 30 seconds left. What's the fundraising environment like right now?
Well, this is one of the really interesting things, and thank you for asking the question. The fundraising environment is impacted by the increasing polarization due to the upcoming election.
Interesting.
High inflation, as we know, and everyone's awaiting the Fed's new words. But what we find is that at periods where there's a lot of market volatility and uncertainty like there is right now, that people increase their biases substantially. And those very things that led them to overlook and underestimate fund managers and entrepreneurs get exacerbated during periods of stress, like the period that we're in right now. So I guess what I would say is that it's even more important now to do the work to interrupt biases for those that are looking to meet their fiduciary duty and achieve higher returns than ever before.
Darren, we love it when you join us. Darren Dodson, managing partner at Illumin Capital. It's a fund of funds that's working to achieve racial and gender equity across investing. Darren joins us from Oakland, California. Coming up next, Options Insight with Abigail Doolittle. This is Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
I'm Charlie Pellet with a look at company news. Authorities are accusing the famed short seller Andrew Left of committing fraud through stock sales, social media posts, and research reports, their biggest move yet in a years-long crackdown against traders who tout their bearish bets. The SEC alleged that Left used his firm Citron to generate about $20 million in profits from illegal trading involving almost 24 companies. The Justice Department also announced a criminal case against Left, accusing him of securities fraud. Left had no immediate comment. Charter Communications shares surging today. Charter up now by 15.2% after the cable and wireless company reported revenue that beat analyst estimates, boosted by a surge in residential mobile service. Sales increased to $13.7 billion, beating the $13.6 billion average of analyst predictions. Growth was driven by a 37% increase in residential mobile service. Again, shares of Charter, they're up 15.2%. JP Morgan Chase has launched a generative artificial intelligence tool and told employees to think of it as a research analyst that can offer information, solutions, and advice. That's according to an internal memo that was viewed by Bloomberg. JP Morgan Chase up now by 1.8%. Dexcom shares are plunging after the company cut its full-year sales forecast for the glucose monitoring devices relied upon by diabetics. A San Diego-based medical device manufacturer said it expects revenue of $4 to $4.05 billion for 2024. That compares to an earlier estimate of $4.2 billion to $4.435 billion. Shares are trading lower by 41%. Those are our top company stories. This is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio and Television.
It is Bloomberg Business Week. It's time now for Options Insight with Abigail Doolittle. She's joined by Brian Vending, president at MJP Wealth Advisors. Abigail, take it away.
Great. Thanks so much, Tim. And Brian, terrific to have you with us. This year, of course, similar to last year, big rally for stocks. I just noticed something very interesting, though, which is the S&P 500 on the year up 14.3%. The NASDAQ 100 up just about 13%. So big tech starting to underperform. And NVIDIA, which had been up as much as 190% of the year, right now up just a meager, and I say that jokingly, of course, up 128%. Do you think that stocks have more of a rally ahead? Is NVIDIA going to recover? The other big tech, the Magnificent Seven, going to recover from here? Or is this about as good as it gets? Or are we going to see a correction?
Thanks so much, Abigail. I think, second half of the year is all going to be about earnings. And, there's muscle memory, I think, with investors, especially as you start to see, today, for example, volatility down about 9%, investors coming back to some of those bigger tech names and really a little bit more of a broadening today across all sectors. And I think right now we're in that period of time where investors are still a little bit cautious about their earnings outlooks, knowing that mega cap tech has really run pretty far. And you're right, valuations are stretched, but this AI innovation trend that the market is infatuated with, I think still is a multi-year trend. And so I still think mega cap tech, makes sense, but you have to be cautious. And I think also on the other side, you have a lot of stocks that really haven't participated in this year's rally and still even playing catch up from last year. I mean, about 35% or so of stocks are about negative on a year-to-date basis, and you still have a handful leading the markets higher. So if earnings outlooks hold, and I know we have some big earnings coming up next week, some talk from the Fed, I really think that gives a chance for this rally to continue.
Well, you just mentioned the Fed, and we also have jobs. So how do you expect that to play? Do you think there's any chance the Fed cuts next week, or what are your expectations, and on jobs as well?
Well, I think the Fed is going to hold steady on rates. I think they're going to continue with a similar dialogue of wanting to see the next two prints of inflation before that September meeting. So don't expect any cuts next week, but hopefully we start to get a little bit more of a hint on the direction of monetary policy with rates, because we did have an inflation number, one of their favorites, come in this morning that was really at or slightly below expectations in some areas of the numbers. And that really is what helped to fuel this bounce back today. So if we still see inflation cooling while at the same point in time having stability in the labor market, Abigail, I think we still can expect 1 to 2 cuts from the Fed between September and December. And that will help the markets and also cool some of these concerns around volatility.
Yes, volatility for sure. We have this VIX close to a 17 handle and well off those complacent 12 levels. Brian Vendig, president of MPJ Wealth Advisors, thanks so much for joining us for Options Insight. Tim, back to you.
Abigail Doolittle with Options Insight. Thanks so much, Abigail. Taking a look at the markets right now, the Dow up by 1.6%, the S&P 500 higher by a full percentage point, while the NASDAQ Composite up by 0.8%. If you are sticking with us on Bloomberg Business Week on radio, on YouTube, on Bloomberg Originals, we got a great program coming up for the next 2 hours. We're going to be joined by Matt Miller because he's going to talk to us all about his interview with GM President Mark Royce. They're talking about that new Corvette. Also, we got the 10 AI startups to watch in 2024. Plus, we're joined by the CEO who's built a moving company that started with 1 truck and now brings in $100 million a year. And Emily, this is what I'm looking forward to. Finally, I'll learn what Brat Summer means for the 2024 election.
You're going to learn.
I'm going to learn. That's going to do it for us on Bloomberg TV. Don't go anywhere. The close starts right now.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day. This is the close.
Sorry, Charlie and the rest of the Bratosphere, but Wall Street's telling you that this is a small cap summer. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. This felt like a monumental week.
Yeah, absolutely.
To be sure.
Yeah, and you know what? Could get even more monumental next week.
So true. We get about 40% of the S&P reporting next week and 4 of the Mag 7. So I appreciate the S&P is up by 1% today, but for the overall for the week, we're down now 2 straight weeks for the S&P, and you have to wonder who's going to want to have a lot of risk on into this weekend and next week's earnings. Some of the big movers of the week, though, the 210 spread has moved 16 basis points just this week, as steeper as we go. That's a pretty solid move. Also, dollar yen here, that was causing a lot of consternation, very close to that 200-day moving average, and crude getting hit just really over the last hour or so. Now down over 2%, Romaine. I really wonder, is that rotation over yet?
Well, the weeks-long rotation into some of those economically sensitive shares, at least for today, does continue on here. And I have seen some significant staying power there as more and more data that would justify a Fed cut continues to mount. Traders pushing deeper into those lagging corners of the bull market this Friday. That includes healthcare, industrials, and utilities. A 13th day of outperformance for the Russell in the past 15 sessions, the longest stretch of small cap outperformance all year long. Now, the latest push today came on the heels of this morning's PCE report, which showed another month of core inflation prints roughly in line with the Fed's average target. That same report, though, did show that while personal spending is growing, it's doing so at a slower pace, and income growth is actually easing even more rapidly. And another developing story to keep an eye on today is the U.S. government's lawsuit against famed short seller Andrew Left and Citron Capital. This is part of a now 3-year-long probe into the relationships between hedge funds and short sellers, a probe that threatens to ensnare other money managers and activist investors as well. But we circle back to the top of the show and the big theme of the day and really the entire summer, Alex, and that is the continued outperformance of small caps.
Yeah, so here's a really fun one. So if you take a look at the IWM, which is basically the Russell 2000 ETF, and then the triple Qs, which is the tech ETF, this is really the rotation we're talking about. So the white line is small caps, and then the blue line is tech, and it's just a chart for the last 30 days. Not a big deal, but man, you see this right here, sort of right after we got that CPI read, and you have a big shift within the market. Tech moving lower, and the small caps moving higher. In fact, now you have small caps up, or the IWM, for about 3 straight weeks. We're now at the highest level since November of 2021. And if the consensus is being de-risked right now, do we have more of that consensus to kind of wring out of the tech market?
That will be the big question of the day here. Stocks sitting on some pretty decent gains on the day, though, when we talk about that rotation and the yin-yang between small and big caps continuing for a 4th straight week. Joanne Feeney joining us right now on this Friday afternoon to kick us off to the close, partner and portfolio manager at Advisors Capital Management. Let's talk about that rotation, Joanne, and more importantly, talk about what's giving investors the confidence to rotate into some of those economically sensitive sectors. When you look at the data, do you have that same confidence?
Well, hey, Romaine, Alex, good to see you guys both. Clearly investors are encouraged by the macro data that's remained so resilient all year long, including the consumer being strong, and now with greater belief that interest rates are going to be cut here in the latter part of the year. More than just tech is helped by lower interest rates. And that's what we're starting to see. We're seeing it in company reports. We're seeing it in their guidance. Look at biotech, look at pharma, look at industrials, right? We're starting to see that improved outlook start to play out. And really, it's been a story of earnings and guidance this year more than anything else.
Balance that out, though, with some of the concerns that have been raised about the health of the consumer, particularly when it comes to the more anecdotal stuff that we're getting out of these conference calls. I know it hasn't quite shown up in the data, but everybody seems to be on edge here that at least some sort of portion of the consumer right now is tapped out.
No, that's absolutely right. And that's where picking and choosing is so very important. The aggregate data continue to show strength in consumer spending. But the aggregate data hides a lot of weaknesses. And the weaknesses we're seeing are at the low end and even up to the middle, where those higher prices over the last few years are really squeezing the consumer budgets. So we're seeing them shift towards cheaper alternatives, which is why we have liked TJ Maxx for so long. But we're seeing also some pain at the high end, even among the very wealthy, because those luxury brands, it turns out they didn't quite set their prices appropriately for the wider market that they play in. And so we're starting to see some adjustments there. So yeah, while the aggregate data look pretty good, we're clearly seeing some cracks at the low end. We're seeing it in delinquency rates rising in the credit card data, and that is a warning sign. So you really have to pick and choose where to be in consumer, whether it's an off price like TJ Maxx, whether it's something else in consumer that people can't do without, like, for example, a new home for those in their 30s that are trying to move out of their parents' basements or they're having kids. And so that's another reason why we like Lennar. It's sort of inelastic demand. Folks need a place to live, and they specialize in first-time home buyers and one step up. So there are places to look in consumer that remain strong. But you have to be very, very choosy.
So, Joanne, if I want to de-risk, though, out of the Mag 7 and go into other areas of tech, for example, where do I go?
Well, one area we continue to like outside the Mag 7 is, again, a place where demand is inelastic, like cybersecurity. Look at Palo Alto Networks. They had a tough start to the year because they, clarified that they had to change their go-to-market strategy a little bit, and that was going to cause some near-term pain. So the stock really sold off back in February, and it's an opportunity still now to set up for the long term. We've owned it for many years, and we just see cybersecurity as something that's only going to grow more in demand. Another area to go is other places that have gotten beaten up that are due for a cyclical recovery, like, for example, a Qualcomm or an AMD, which is sort of part of the AI world a little bit, AMD, but it's also part of the PC and server world. And it's a company that's taking share from their old nemesis, Intel. Qualcomm, we're seeing a recovery in the smartphone segment after some, year after post-COVID surge in purchases. There was a lull. Now that's starting to come back. The inventories are clearing. So those are a couple places. And then our longtime favorite is Broadcom. Broadcom, we've owned it at the firm for clients since 2015. It's not only part of the AI revolution in software and hardware, but it's really part of the entire internet's infrastructure in fast data transfer. And it's also now working in cybersecurity and in software more broadly. So it's a well-diversified company that has just done an excellent job of capital management for its shareholders.
Do you feel like when we see the rotation continue, and you're talking about stocks that have been beaten up that you want to rotate into, does that also mean that you want to rotate into small caps? Is that really going to stay?
Yeah, when the economy holds up more than people expect, that generally benefits smaller cap companies, which are, more stressed in terms of how they can acquire funds to run their businesses. So they tend to be the first to do well when the economy picks up and the first to do badly under periods of strain. So because, again, the aggregate data is holding up pretty well, inflation's coming down, the Fed's very likely to cut rates, small caps is a place to go. At Advisors Capital, we have a separate small and mid-cap portfolio strategy that investors can put, say, part of their funds in, even as they perhaps try to be more balanced, with an income-oriented strategy elsewhere at the firm. So yes, we do believe that the SMID opportunity here is just beginning. Ultimately, though, that will depend on the broader aggregate economy and how that goes over the next year or so. But right now, it's an undervalued space that we think has a lot of interesting opportunities. Our approach, though, is to handpick those opportunities, to be really careful to find the ones that are best positioned for a more uncertain economic environment.
We only have about a minute left here, Joanne. I do want to get your thoughts here on the Fed meeting next week, your expectations, or more importantly, I guess, your hope of what you want to hear out of Jay Powell.
Well, Ramin, I think it's pretty clear, given what we've heard so far, that the Fed is going to be cautious about cutting, that it wants to cut at a time when it has enough data to be confident that inflation is heading back towards 2%. The recent data has been supportive of that move. We don't think they're going to be in a rush, though. So we think a September cut is far more likely than a July cut. And we're likely to hear more of the same kind of messaging as we've heard recently, that they're getting more information, that things are moving in the right direction, and that the labor market is loosening in a way that pushes them more towards that side of their dual mandate going forward.
All right, Joanne, great stuff. Joanne Feeney, partner and portfolio manager at Advisors Capital Management, helping us kick you off to the close here at the end of the week with a look ahead to next week. More than 170 companies reporting in the large cap space, including most of the big tech names, Meta, Apple, and a few others. Ross Gerber, CEO of Gerber Kawasaki, joining us in just a second.
Plus, 3M shares eyeing their biggest jump ever. This is after the new CEO boosted its profit forecast. It is today's stock of the hour.
And one of the big weak spots right now in the equity market is medical devices. Dexcom down more than 40% here on the day, erasing more than $17 billion of market cap. We're going to talk to an analyst about what's ailing that company as part of our top calls. All that and more coming up in a second, right here on The Close on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Good morning from our world headquarters in New York. I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything. Earnings season is here.
We're skating into another earnings season.
The expectation for earnings going forward are quite high.
Bloomberg is first to break the numbers.
Adobe earnings crossing
earnings out of Broadcom.
JP Morgan, we get Citigroup, we get Wells Fargo.
There is something for everybody.
With the smartest insights.
Now banks have earnings power.
There's a resilience in the bigger cap companies.
We're not talking about a collapse in earnings for technology.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Andrew left under scrutiny today. The famed short seller accused by U.S. authorities of committing fraud through stock trades, social media posts, and research reports. Bloomberg's Tom Schoenberg has more. Let's go through the allegations and left's response.
Yes, so today we had both the Justice Department and the Securities and Exchange Commission bringing cases against Andrew Left, essentially saying that he would, essentially used his reputation to sort of bring a following to stocks that he wanted to move based on reports or tweets, and that sort of his trading wasn't in line with what he was telling the public they should do. Whether it was a company saying that he should go long, he would then the government says they saw his trading that shows that he sold off a number of shares shortly thereafter, sometimes within minutes. They say that he also sort of made, misleading or false statements regarding that he had, investors for a fund when they said that a fund he had no investors. And this is all, his own trading. They also say that he, when, in interviews from the feds, that he made a false statement claiming that he never, received the money for research from a hedge fund.
Yeah. So have you had a chance to catch up at all with Andrew Left or his attorneys? Have they responded yet publicly?
Yes, I was able to catch up with his lawyer a short time ago, who, says obviously says that this case is bogus and that essentially that everything Andrew did was vetted by lawyers, any disclosures he made, and that furthermore, there is no rule or law requiring a publisher who discloses to disclose that he must also publish his private trading intentions.
Well, let's be clear about something here, Tom, because this is clearly part of a much broader investigation that the SEC has taken. I'm not clear exactly what they're looking for, but we do know they're looking at the much broader universe of these relationships between these hedge funds, the traditional money managers, and some of these short sellers and activist investors here. Do we have any sense as to how far along this investigation has gotten and whether anyone other than Andrew Left and Citron Research is in the crosshairs?
At the moment, it seems that this, seems to be sort of the biggest case they have. Obviously, it's the biggest one they brought. And it's, for a while here, we weren't even, based on information that sort of we had, it wasn't clear that, they were going to move forward with something. We were, a number of us for the better part of a year looking to see if, the government was actually going to bring any cases from this investigation that's been going on for more than 3 years now. The SEC did bring, a resolution a month ago with one of the hedge funds involved in this investigation, and in part, that resolution involved sort of payments to Andrew Left.
All right, Tom, I'm going to have to leave it there. Tom Schoenberg, there, a nice story today here on U.S. authorities accusing short seller Andrew Left and Citron Capital of committing fraud through stock trades, allegation that his lawyer vehemently denies. And Alex, I'm kind of interested in the story because we talk about the timeline of when this started. If you remember, we kind of had the whole GameStop saga, which kind of sent a lot of short sellers into the closet, so to speak, and the panic. And we heard from a lot of folks, including Jim Chanos, kind of saying that old playbook of how short sellers would kind of, make their stake and then come on to the media and plead their case, that was kind of over. You just couldn't do that anymore. Not necessarily because of the regulatory scrutiny, but more so because of the backlash from bulls.
Yeah, well, that is part of it.
Yeah.
Matt Levine had a great piece out that everyone should definitely read. He says, look, Andrew Left did have a track record. He attacked large companies. They weren't small companies with not a lot of liquidity. And he also had a track record, right? You can't accomplish what the SEC is accusing him of without those two things. So there's also that other side to look at.
Yeah, I mean, he had some pretty ones. I mean, obviously, most people know him from Valiant, and of course, that was a great short at the time. At least in hindsight, we know that. But it raises the question, too, is where is that research being shared? Is it truly just him and his people coming up with this, him coming into the media, or is there more involvement by other players? And that seems to be, from what I can gather, from what Tom was talking about, that's what the government is looking into.
And also what the PR around it is. I'm going to talk about it, but then is your tweet legit? Does your tweet kind of hype it up a little bit? Then it becomes a PR situation. So
absolutely. And of course, we have put out a formal request for Andrew to come back onto the program if he ever is so inclined. We would love to get his take on this as well as we continue our coverage here on this Friday afternoon. A look at some of the biggest movers of the day, and none bigger right now than Dexcom, a 42% drop as part of our top calls, and it's up next on The Close.
Jason Kelly, and this season on Power Players, we're taking you behind the scenes to see how the business of sports has gone global.
I want sports to grow. I want sports to be bigger because we have talent.
And how mammoth value is coming from the smallest of players. 3,184 hits, 431 home runs, and of course the most famous stat that everybody knows, 2,632 consecutive games played. Unmatched career. Why are you doing this?
What we have achieved in the NWSL from an investor perspective over 2 years is the equivalent of what it took other leagues 25 to 30 years to achieve.
You've got to have a business that's sustainable. The only way it's sustainable is got to make money.
There's only one word, winning. You win on the court, you win off the court. And as you do that, you bring people along.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
All right, let's get a view from the sell side. Our top calls up now. Some of the big movers on the back of analyst recommendations. We're going to start off today with Duolingo. Bank of America analyst Curtis Nagel actually lifting his rating to buy. This is mostly a valuation call for a stock that had slid 30% from its record high. Nagel, though, cites the potential for share buybacks as well as the stability from growing cash flow, no debt, and no obvious M&A distractions. Next up, let's take a look at WW International, losing another buy rating, this time with Morgan Stanley downgrading to equal weight and slashing the price target to a street low $1.25. The analyst finds subscriber trends for WW's core dieting app and clinical business unappetizing and says that the company might be unable to offset headwinds presented from the weight loss drug industry. Shares there having one of their worst days in a while, down 12.5%. And finally, let's go to Dexcom, down in the dumps after the maker of blood sugar monitoring devices shocked analysts with a lower sales forecast, multiple downgrades today, including a cut to neutral over at JP Morgan, with the analysts flagging multiple self-inflicted issues that leaves the company struggling to navigate near-term challenges and rebuild investor trust. Those shares having their worst day since the company went public back in 2005, and those are some of our top calls. We do want to stick with Dexcom, that last call, because our next guest says the downward spiral is almost too abrupt, telling clients the speed at which the business appears to have deteriorated is borderline stunning. Jared Holt's joining us right now, healthcare equity strategist over at Mizuho Securities. And Jared, yeah, I mean, look, a 40% drop in a stock like this probably shouldn't happen, but there must have been something there that really caught people off guard for this to sell off that hard. Do you think at all this sell-off is justified?
Thanks for having me, first off. I think it is, just given the magnitude of the guidance cut and what I think is going to be a new valuation range or valuation dynamic for the stock over the near term, which is to say, I think the PE multiple will contract, the price to sales multiple will probably contract as well, and you're looking at a new revenue base and a new earnings base for the company. So I think the move is justified. I think the question is, is the stock range bound? Can you buy it here?
Yeah.
It feels like the move today is probably more right than wrong.
Well, I am curious, though, because based on what you just said there, this gets to the idea that the problems that they have, or at least the problems that were revealed today, it sounds like you think this is much more of a long-term issue, much more structural, rather than maybe just a slight sort of, I guess, misexecution in the short term.
Well, I think some of it is, and probably some of it isn't. The sales force disruption that they spoke of in the quarter feels like it's reconcilable at some point, whether it's the balance of the year, whether it's 2025. I mean, the company's been incredibly successful since its inception. It's hard to think that this sales force doesn't get on track at some point. I think the thing that is the potentially more difficult issue to nail down as far as timing is the competitive dynamic, whereby it seems like Abbott is taking market share. There's pricing pressure across this category, and we haven't even really begun to discuss, and the company on the conference call last night really didn't discuss the rise of the GLP therapeutic class, which doesn't seem to have been an issue yet.
Right.
But I feel like when we look at this category, there's no way it doesn't have an impact at some point.
So, Jared, that's where I was going to go. So, technically, their update did not include GLP-1s, which is what you said, but I'm wondering if the price decline does.
Well, I think the price decline has more to do with the way that competitors are contracting with the supply chain and things of that nature. So I think that's kind of mutually exclusive from the GLPs. But we know that these medicines alleviate or delay the onset of diabetes for many patients. So given that, I think the medium to long-term effect of this medical device class within diabetes is probably, neutral to negative. And the fact that they haven't seen it yet, to me, is even more of an issue, because I feel like over the next couple of years, it's going to come into play at some point. Again, like getting the timing right for when the issue is going to be impactful is difficult.
I mean, is it a one-for-one, though? Like, if you use Ozempic and your blood sugar and your diabetes is better, do you not need their devices, or you just need all the stuff?
Well, that's the question. I think it's a combination of both. But the fact that you have the former camp in terms of patients that are on the medications and then no longer need this type of medical device therapy is what is going to be the lingering issue, I think, not only for Dexcom, but for a number of players in med tech that are in the diabetes space. We've obviously seen a lot of pressure in sleep apnea. Again, the companies have not really reported that they're seeing any detriment to their business on the back of the GLPs. But I think logically, just given are going to be on the injections and then the orals down the road, I would think it affects a lot of these medical device classes. We're just a little bit too early, to be seeing the impact here.
And of course, uncertain, and markets don't like uncertainty. Jared, thanks a lot. We appreciate you hopping on with us. Jared Holz over at Mizuho. I mean, anecdotally, I know people who do both, who are on Ozempic to manage diabetes, but still have the thing because they still have to test before they eat. So I think that's the question.
Yeah, it is. And it's also an issue, I think, when we talk about the share reaction, kind of a lack of transparency as to what's really the problem here. And I think at some point, Dexcom is going to have to kind of come out and put their cards on the table here. There's something clearly going on, or at least investors think there is.
I mean, the degree, though, to that stock is how it got hit, akin to 3M, of how it's on the upside, is truly staggering. All right, coming up, speaking of staggering, big bulk of big tech companies reporting next week. We're going to get insight about investor sentiment from Ross Gerber, co-founder, president, and CEO of Gerber Kawasaki. This is The Close on Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that started in 1977, when by then I had a little research station, and 4 of my students were kidnapped, and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
It's very easy to get caught up, and this is how we've handled investors last year and a half. As soon as tech sells off, that's it, alarm. But it is 9 p.m. in the AI party that we think goes to 4 a.m. So I get if you want to look at that from the outside. We like being in that party, and I think this plays out. It's part of our tech bull thesis.
and I speaking a little bit earlier on the program this week about all the hype in the AI and the tech space. And I think starting next week, we're going to have to see whether some of these companies can actually have anything to show for all that hype. A lot of big tech names scheduled to report.
And particularly coming after this week where you have that consensus trade, the consensus long, really unwinding. Whether you're looking at the equity market with tech or you're looking at FX, say with the yen, that really sets us up for a very interesting trade.
Absolutely. And we talk about Meta, Microsoft, Apple. I know a few others I'm forgetting in there. Going to get a few chip makers here. We know that they're benefiting to a certain extent, right? The question is by how much? And once you get beyond those big tier companies, are those second tier companies seeing anything at all?
Yep, you have July 30th, $6.1 trillion in market cap reporting, Microsoft being one of them, and then Thursday, August 1st, Apple, Amazon, about $7.9 trillion of market cap. Joining us for more, Ross Gerber, co-founder, president, and CEO of Gerber Kawasaki, joining us now. Hey, Ross, is this tech's baton to lose here next week?
Well, no, I mean, there's no baton to lose. And as my friend Dan said, he's using the 9 p.m. party. It's really like the second inning in AI. You know, we prefer the baseball analogy. But that said, you know, these companies are making investments that are going to pay off over the long term, and their core businesses are just killing it right now. So I think having an over exuberance on what you expect from AI results might be a little premature, but the actual investment that's being done is massive. And that's why investors need to be patient, and the valuations have gotten a little ahead of themselves.
Well, that's exactly what investors don't seem to want. Just look at Google. They do not want them to spend a lot and monetize later, or the question marks around monetization. So how does valuation reconcile for that?
Well, that's very short-sighted. Okay, these are companies with tons of cash flow and tons of cash that should be putting their cash to work. I mean, they earn 4 or 5% sitting in the bank, or they can be investing for their futures over the next 5 to 10 years, and that's exactly what I want my companies doing. So I think investors who just want to make like short-term gains are missing the forest for the trees, as they say, because really we're long-term investors in my fund GK and at my firm. So what we've really done is we've positioned clients so that they can take advantage of tech and AI, but they also have diversification into small caps and other types of industrials and other areas in the market that we like real estate right now with rates going lower.
Well, when it comes to sort of, I guess, making sure the clients sort of benefit, or at least have the potential to benefit from what is clearly a longer-term structural shift right now, at least in the tech space, Ross, is your strategy, or at least your general thinking, that you just kind of stick with the names that you know are benefiting, whether that's an NVIDIA or Microsoft or whoever, or do you kind of go down a step or two to maybe those second-tier companies that have the potential but maybe just haven't shown it yet?
Well, the way we're playing it right now with our clients is we're really looking at the hardware element first, because first we have to build the infrastructure. And then down the line, we'll look at names that will benefit greatly from the services that the hardware providers can provide. So we're really in stage one, as I said, of what's going on. And that's why we really there's a lot of investment being done from the big tech companies, but there's also a lot of beneficiaries of this investment, whether it be ASML or NVIDIA on the beneficiary side, and the investors being Microsoft, Google, Meta, and such. But we think that these companies will benefit greatly from these investments. So we are sticking with the names. If you look at my fund, there are a lot of names around AI that are the bigger names, and I think they'll benefit the most on the short term.
So for those hyperscalers and those other companies that effectively are the ones spending the money, meaning the ones having to make that investment, Ross, are you sort of comfortable with the amount of money that they're having to spend, with the knowledge that it might be several quarters or even several years before we start to see a material impact on the bottom line?
Exactly. And I think that people have to separate like CapEx spending from actual operating results. And so, as I said, these are very profitable companies with tons of cash and capital, and we want them to deploy that where they see growth. And I've never really seen tech executives so bullish about the future of something since the .com area that I grew up in. So this is my third decade of investing. And the way we do it at my firm is you have to have investments that are future focused, along with conservative investments that produce income and stability in the portfolio. And that's the way we build our account. So we'll get all the upside on AI success, but we try to lower the volatility of owning these kind of names by owning other types of names like Lennar, for example, which are a great opportunity as interest rates go low.
You are the second person who recommended Lennar on the program today. So clearly,
we're long-term owners of it. Yeah.
That's in the zeitgeist. Do you feel, though, that the consensus longs in tech, are they out enough? Like, are the consensus longs and other assets out? Like, is that trade played out, or do you think we're going to see more of that next week?
Well, once again, I've started investing 30 years ago in the same names that I'm buying today, whether it be Dell or Microsoft or Apple. It's like I'm kind of like going through this like flashback almost of what really made me wealthy the first time, which was the dot-com era. So it's actually an easy playbook for me, because I think if you think long term, these are names you want to own in your portfolio over the long term. And I think investors need to think about over the next 5 years or 10 years, what are the names that are really going to do well for me? And a lot of those names are the same names that have done well for us in the past. And that's what the market statistics have shown, is a very small portion of the market has made a large portion of the gains over the last several decades. And I don't see that changing,
Then based on that too, where do you think the money stops flowing first? So eventually when we get to the point where these hyperscalers are like, all right, I get the message, I'm going to spend less. Who does that first, and how does that ripple through the market?
I think it all ripples around return on capital and investment, where if you look at like the streamers where they invested like tens of billions of dollars and then it was much harder for them to get a return, and then they've pulled back. What we see is more, there's this first burst of spending, and then there'll be incremental spending as they see values. So we expect a much more cost discipline on investment from the big cap companies as we move forward. But just the same, we're building a whole new infrastructure, data center, AI, infrastructure to support lots of different businesses. So I see this as a pretty, long-term trend that will continue, and it could be an amazingly profitable time for investors who are willing to deal with volatility and be patient. But valuations, once again, have gotten ahead of themselves, and that's why we're seeing a pullback, and that's very healthy for the market and investors. We do not want a dot-com situation where the market just like doubles and then we go into this collapse. That's not ideal. So I'm fine with this right now. It's great. It's a great opportunity for investors.
Good, Ross. I'm glad you're happy now, and I still can't believe that you've been doing this 30 years. You don't look really a day over 25. Final question.
Thank you so much.
Sure, absolutely. We're here for the compliments. I am curious, Ross, though, when you look at the big tech cohorts out there, the individual names, are there any out there that you're just kind of avoiding right now, that you kind of look at and just say either it's not right, the right time, or the right company, or just not necessarily being in the zeitgeist?
Yeah, I mean, you're kind of leading me into the Tesla question here. Tesla's the worst of the Mag 7 performance and has the highest, PE ratio based off forward earnings and earnings estimates, which I think are vulnerable to more downgrades. So Tesla is going through a very difficult time because the CEO, Elon Musk, has chosen a very divisive route, and many of their customers have chosen other EVs or other vehicles to own other than Tesla. And we're seeing this with average sale prices continuing to drop, margins continuing to drop, while they invest in AI and robotics and hopefully have some return at some point into the future. So I think Tesla, mostly because it's the highest PE of the Mag 7, but yet is declining earnings, is the most vulnerable, and investors should be very cautious about their position. And we still own Tesla, but we've lowered our position, substantially over the last 6 months, and we'll continue to own Tesla for the time being. But we'd love to see a change from the anti-marketing campaign that's been going on with Elon, instead of like marketing the wonderful vehicles that they do have.
All right, Ross, always appreciate you taking time for us. Always a great conversation. Ross Gerber, co-founder, president, and CEO over at Gerber Kawasaki. A push ahead to that plethora, if you will, of tech earnings that we're going to get next week, including Meta, Apple, Qualcomm, Amazon, and a few others I'm sure I'm forgetting.
And it just raised the question, like, how much risk do you take into that? I mean, Google delivered really good numbers, but the investors just did not like that CapEx spend. But then what do investors want? Like, if you want them to be like first, front and center when it comes to AI, that's what you got to do.
I'm going to be. I know this probably puts me completely out of the realm of what most investors are thinking today. But I kind of feel like they just need to articulate when they're going to be profitable with some of this stuff, right? Because they're spending so much money, but they're not really getting a direct return from it just yet. And I know Ross is talking about the long game, and I understand a lot of investors, they're in it for the long game. But you know how public markets are. It's still a short-term market, and they need to see short-term gains.
What if they don't know? What if they don't know when they can deliver that super steady profit in a meaningful way? Then, therefore, I think maybe that's part of the problem.
Yeah, absolutely. All right, coming up here, we're going to take a look at another big company moving today. We talked about Dexcom, one of the biggest decliners on the day. And, well, one of the biggest gainers, on the day is 3M. Take a look at that. That's just over the last 2 days, a 22% gain here. Investors really celebrating the first results under the new CEO. It's our stock of the hour, and it's up next. This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
What we try to do is combine some of our insights from the fundamental business with external and data set signals. And I think that's a lot of times where the opportunity is.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
All right, let's go from the worst mover in the S&P to the best mover in the S&P today. It's time for our stock of the hour, and it is 3M. The share is higher by more than 20% here on the day, soaring the most in its entire 40 decades as a public company. This after raising its full-year profit forecast as its new CEO vows to reinvigorate the manufacturer's innovation engine. Abigail Doolittle joining us right now for more. I mean, he's got to be feeling pretty good here to get this kind of a share price reaction here on one measly earnings report. It's a lot.
It sounds like he's earned it because I've talked to a couple of analysts, including our BI analyst, Karen Ubelhart, and going into the call, this was his first call with investors. So yes, they did beat, yes, they did boost, but apparently on the call, he was very measured. He was very honest in terms of assessing the situation, saying these are the problems in the past. Our product pipeline more recently has been weak, but we can't fix that. But what we are looking at, is the future and what we can do there. So she came off the call saying basically a sigh of relief. Everything's going to be okay. And the way that the stock is reacting, it just seems as though they're excited about the idea that this story that's in so much pain is finally turning around. On the year, with the stock is up in a big way, but over the last 5 years, it's still down 13%. If you compare that to the S&P 500 or the industrial space, big underperformance. So there's still a long ways to go, but at least there's some degree of confidence that this guy can right the ship. The last CEO, he basically got them through the litigation valuation, but they started missing. It got a little sloppy. The CEO before that, it was clean as a whistle, always be, good management, and he was very personable. So I think the hope is now it goes back to that prior CEO.
All right, Abigail, thanks for that. We really appreciate that. Abigail Doolittle joining us on that. Also, just by raising its full-year profit forecast at the lower end, you can make an argument that maybe that's conservative, which gives some analysts and investors a little bit of hope that maybe they can upgrade and beat. So there's that sort of trickling through, I would think.
Yeah, I mean, it's remarkable, right? We always talk about how sometimes the reactions and the share and the prices are kind of divorced from the fundamentals, but this seems one where it's kind of in sync.
Yeah. All right, well, coming up, we're going to continue to count you down to the closing bells with Kim Forrest, founder and CIO over at Boca Capital Partners, on this truly tremendous, historic week in the market. This is The Close on Bloomberg.
In global leadership are on Bloomberg.
I envisage not only some kind of a bridge towards membership or language linked to the irreversibility of Ukraine's membership in NATO, but also some kind of a broader package of military material, of financial aid. The more we support Ukraine right now, the sooner the war will end.
Nobody covers the top global leaders like Bloomberg Television and Radio.
Liquidity is the lifeblood of an airline. We make very conservative decision making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well, because things change by the day.
So 1 minute now until we get the market on close imbalance.
Right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
The top names in business are on Bloomberg.
Middle market line draws are basically still about 5 percentage points below where it was pre-pandemic, which means as cost of borrowing went up, people aren't being quite as aggressive, and that's why the economy is slowing down. They're not hiring quite as many people. They're not buying that piece of equipment. They're not doing it because they're a little worried about final demand, and therefore they're being careful, which is unpleasant for your bank, but is okay because the companies are still making profitable and the credit quality is good.
Nobody covers business like Bloomberg.
So we're looking now to the market on close imbalance. The S&P 500, 1.5 billion to the buy side. NASDAQ 100, 200 million to the buy side. Also seeing the Dow 30 stocks, 430 million to the buy side. And Mag 7 stocks, 180 million to buy.
This is the countdown to the close. Romaine Bostic here.
And I'm Alex Steele. All right, we're about to close up the week. Quite a week it has been. The S&P is up, though, by about 1.1%. We're not at the highs of the session, but we're doing a solid move.
Not at the highs of the session. I mean, this is still the outperformance we've been talking about all week with the small and mid caps. So this is probably the one day of the week where we've seen the large caps at least try to keep pace with the small cap brethren. But it seems like investors have spoken. Like when you look at the economic data, the PCE data this morning and the GDP data a couple days ago here, everything seems to be aligning with this thought that the Fed has to do something and has to do something soon.
And Bloomberg Intelligence was pointing out earlier today in a note that, okay, the Fed cuts are now priced into small caps. So now small caps are earnings show me story.
And that's going to be interesting. But think about what we saw. I mean, we were just talking about 3M, right? We talk about what are the stocks getting bought, the biggest laggards out there, 3M. Newell Brands, I mean, up something like 38% or something this today alone. But then when you look at its year-to-date performance prior to today, it was, down like, 30%.
Right.
Well, so
how do you position? That's the question.
Absolutely. And that's the question that we're posing to most of our guests here today and really all week long as small cap summer continues. Kim Forrest joining us to help count us down to the closing bells on this Friday afternoon, founder and chief investment officer over at Boca Capital Partners. And Kim, I know we've talked before about this rotation. I think the last time we talked, it was still we were kind of questioning whether there was some staying power to this, but at least on a weekly basis, this is 4 straight weeks of outperformance by the small caps relative to big tech here. You see this lasting?
I think I do, and we're just getting into the heat of earnings season now, and we'll get some of the big caps next week, but there's a lot of small caps that report later in earnings cycle. So if you own them, or if you want to own them, now's the time to start paying attention. Because what you really want are companies that are well positioned, not only because they're small caps, you can't do anything about that, but you must make sure that they are well positioned against their peers. If you think a company has what it takes to outperform, this might be what they call a stock picker's market. So get prepared.
It's kind of interesting, too. So, Kim, I mean, as you think about this being a stock picker's market, give us a sense here as to how you sort of walk through the potential investment in something, particularly a stock that we know has been beaten down, and there's still a lot of questions as to whether those fundamentals are there, whether the macro is going to support it as well. What's the process you go through to do that?
Sure. So some of the just really brief things, you have to make sure that they have a balance sheet that can support growth for the company. Secondly, you have to have, and this is a low bar, adequate management. You don't have to have superstars. You have to have people that do what they're going to say, what they're going to do, and then do it. And then finally, and this is tricky, finding companies with a methodical way to create and expand their product base is key. And I think that product marketing cycle is really important, especially to small companies, because they can't just be a one-product company.
So, Kim, what do you like?
What do I like? Well, we've talked about this before. They're not really a product company, and they're trading kind of high right now. Urban Outfitters makes a lot of their own product that's close to whatever's hot. So they're very good at understanding what companies need or what their clients need. Some of the technology names, a little company called NetScout, that's NTCT is the ticker, they did very well this quarter, and they not only serve businesses with a running, also serve telecoms, and they've been a victim of a down cycle in telecom spending for equipment. So that's one area, but they're great at creating new products for their clients.
Kim, how do you play that hyperscaler trend then? Like, if say we don't own like a Google or a Microsoft, and obviously Google gets hit at like too much CapEx spending, et cetera, which beneficiary, who gets that money from the hyperscalers, and how do you own those guys?
Sure. Well, being the ex-nerd, or maybe still I'm a nerd.
No, you're still a nerd, Kim. It's fine. Me too.
Yes, yay. Okay. Anyhow, I was a software developer in AI, and if there's one thing I know, AI uses tons and tons of data, and then you replicate that tons of data for the process, training, testing, that kind of thing. And so data is big. So buy companies that allow people to store data. So that would be NetApp is one, and Micron, which makes the pretty much the guts of what NetApp sells. So that is a way to play AI. And it has a long timeline because AI is going to take a long time to build out. I hate to be the one to break it to you.
Okay, well, I mean, but it's going to take a long time. But Kim, if you do believe, I'm not saying you do, but if you do believe that there is sort of a structural shift, that AI is either aiding or more importantly at the center of, and that we are at some inflection point that will change technology forever here, do you just wait until we actually see kind of the whites of its eyes, meaning the actual end results of it, or do you try to get on in advance?
Well, I think people really have correctly got on in advance with NVIDIA. I'm going to give everybody, big kudos that spotted that hopped on. But, and they have kind of a good window ahead of them where they're the leader. They're the clear leader. Now, semis we don't know what products are going to be in demand, but we know they're delivered and developed on semiconductors, so that's a good bet. Again, data is a good bet, but I would keep an eye out in the software world because somebody's going to come up with that killer app. And if I knew, I wouldn't tell you. I just invest. No, I'm just kidding. I don't see anything right now that's the killer app.
All right, Meredith, you can tell us, Kim, after we get off air here, and just kind of whisper it into our ears. Kim Forrest, founder and chief investment officer over at Boca Capital Partners. As we count you down to the closing bells, we still got about 3 minutes until we get there, Alex. And it raises a question, too. I mean, we've been talking about the moves in stocks, but we still have that drop in yields. Not a massive drop in yields, but that's the anticipation here is that when we hear from the Fed next Wednesday, that not necessarily saying they will cut on Wednesday, but maybe they'll give us some clarity as to whether they're actually going to buy into what the market is pricing in, which is right now a little bit more than 2 cuts this year.
I would argue that the move in yields was significant, and it was, chunky this week. I was talking to Steve Major over at HSBC on radio earlier, and he thinks that steepener trade though is kind of toast right now. That if you were playing the steepener based on President, the Bears? Both.
Okay,
so the President Trump one, which would be the long end selling off, we got to recalibrate. If you're doing it because the Fed's going to cut, that's already priced in. So now that front end and the rally in the front end has to recalibrate. I thought that was interesting. We'll see if that actually plays out next week.
As a perpetual pessimist, I'm worried because this just feels like it's almost too perfect, right? I mean, we're back to the soft landing, the Goldilocks sticking the landing scenario again, and it all just seems like no one's taking into account or hedging for any potential of deviation from where we are right now.
But maybe that's what we saw this week with tech. Like the value at risk has been decreased in these systemic funds, and that's what we've seen. And maybe there's more to go there as well.
All right, 1% gains right now on the S&P and NASDAQ, about 1.5 on the Russell as we break down your market coverage right now on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Alex Steele, taking you through the Closing Bell, a global simulcast. It starts right now. Scarlet Fu joining us in the TV studio. Tim Stenovic in the radio booth. Carol Massar off today. Emily Grafeo filling in today for Carol on what is just a monumental day and a monumental week, Tim, when we talk about this rotation and more importantly, the idea that investors really do have some newfound confidence that they're finally going to get those rate cuts.
Yeah, I mean, I think the data certainly helped this morning. No rate cut next week necessarily at the July Fed meeting. But still, like you said, that rotation continuing. We're seeing the Dow outperforming the Russell 2000, but the Russell outperforming the S&P 500 and the NASDAQ, not just on the week significantly, but on the day today too, Emily.
That's right. That rotation trade is fully underway, but we are still seeing strength in the mega caps in the S&P 500. But year to date, that NASDAQ 100 now lower than the S&P 500's year to date gains.
So it feels like next week will be a really big test, right? Because you've got a big chunk of the rest of the Mag 7 reporting. For those who think that the NASDAQ's underperformance is an early warning sign of things to come, hopefully they're relying on these earnings reports to help answer that question, whether it is or whether this is just a buying opportunity.
I don't know. I keep hearing on the street, I was just telling Romaine this, that value at risk model for a lot of these systemic funds like CTAs, for example, are still getting hit. So it is surprising that we're not seeing more selling today after yesterday.
Yeah, absolutely here. But a pretty broad-based rally that we have on our hands here today with all the major indices holding in the green with the majority of the stocks in each one of those indices posting significant gains on the day. A Dow Jones Industrial Average higher by roughly around 660 points or about 1.7% on the day. The S&P 500 is going to close higher by about 60 points or 1.1%, while the NASDAQ Composite up 1% on the day. Similar moves for the NASDAQ 100. But your outperformer, modest outperformance, remains the small and mid caps. S&P 400 mid caps up 1.6%. The Russell 2000, Tim and Emily, up 1.7.
Yeah, majority, I think it's fair to say, the vast majority of stocks, at least in the S&P 500, moving to the upside today. You got more than 4 stocks higher for every 1 stock that's lower. 438 in the green, 62 in the red in the S&P 500, Scarlett.
And the IMAP is going to show you a green pizza pie. There's no tomato sauce here because all 11 groups, are in the green. Okay, I mean this is a salad pizza, really. That's what it is.
I see a little bit of red.
Higher. Okay, you want to know what that is?
What is it?
Autos and components down 1/4%, and telecom services down 1/5 of 1%.
Oh, I feel bad for whoever has to do decliners today. No, there are some big ones. There are some big ones. Okay.
That was a drum roll to him.
It was.
It wasn't me. I don't have to do decliners.
Okay. You're doing gainers. Go for it. You have a lot to choose from.
I really do feel bad. Okay. You want me to do the gainers?
Do the gainers.
Okay, I'll do the gainers. I do want to start with shares of 3M, ticker MMM. Look at that, up 23%, having their best day ever. Second quarter net sales beat estimates. The company lifted the lower end of its full-year earnings forecast. The results are the first under Bill Brown, the CEO, who succeeded Mike Roman. That was just back on May 1st. Brown inherited a much smaller 3M following the spinoff of the huge healthcare products division unit. That was amid massive legal liabilities. 23%, the biggest advance going all the way back to 1980. Bristol Myers Squibb, another one that was higher by double digits today. The company up 11.44% after it raised its 2024 profit forecast. Demand for new medicine suggested the company has gotten past that dip in performance. Adjusted earnings for the full year are going to be between 60 to 90 cents a share, an increase of 20 cents at the midpoint of its prior projection. And finally, Newell Brands, it's the parent company of Coleman, Yankee Candle, Sharpie, Rubbermaid, Crock-Pot, Baby Jogger, and many, many more, climbed the most ever to its highest intraday since September of last year, up more than 40% today. This after the company posted a second quarter profit beat, also raised its yearly outlook. The second quarter gross margin increased to 34.4% compared with 28.5% in the prior year period, Emily.
Well, you gave me the hard assignment, Tim. When I come in, I fill in for Carol.
I'm sorry.
And I have to get the difficult job of finding the red on the salad pizza of the green IMAP. But I did find some decliners. Let's start with T. Rowe Price. Assets under management of $1.57 trillion, just matching estimates. We saw that stock lower about 3% on the day. Second quarter net revenue for the company and EPS also missed, down over 5% on an intraday basis, the biggest drop since February. But the big decliner today, the one that we've been talking about for the last several hours, is Dexcom, down 40%, the worst drop ever for the maker of blood sugar monitoring devices for diabetics, after the company unexpectedly slashed its 2024 sales guidance, citing a drop in customers and lower revenue per patient. This massive stock decline triggered several price target cuts. Cowen saying it was a rare, disappointing quarter for the company. And finishing up, we have another health-focused company, Biogen. That stock down as much as 7.7% on the day, biggest drop since February, after a committee of the European Medicines Agency recommended against the approval of Biogen's Alzheimer's drug. I will note that the company's drug is already approved in other countries, including the U.S., China, and Japan, but for Europe right now, it was a no. BMO said that the opinion adds a significant headwind to the drug's chance of approval in the EU and is likely to pressure shares.
Yeah, talk about not being on the same page with that one. All right, guys, let's get to the bond market here because we saw some nice rallying all across the board. Yields lower, whether you're looking at the twos or the belly or the back end of the curve. And I should point out that for the week, that 210 spread at one point moved about 16 basis points steeper. Now we're only about 8. But nonetheless, that's quite interesting. Like, that's a chunky move in 1 week for that yield curve. And it kind of brings into focus next week and what's actually priced in when it comes to the Fed. Can that front end continue to rally, guys?
Yeah, that's certainly the question. Hey, another question that I have ahead of everything that's going on when it comes to AI. We hear from another, few of the Mag 7 next week. We'll get an update on how these companies are investing in AI. Is what happens to the companies that are not necessarily focused on AI, but starting to adopt the tools using the AI, which brings us to one of the stories on the Bloomberg terminal this afternoon about how JP Morgan is giving their analyst staff their own version of ChatGPT. It's called LLM Suite, And what it does is it helps with research, it helps with writing, though they're quick to note that it doesn't contain specific asset and wealth management division knowledge. This is all according to an internal memo viewed by Bloomberg.
We have some breaking news crossing the wire. This on Bill Ackman and his ambitions to take at least part of Pershing Square public. We're now learning, based on the NYSE's website, that Pershing Square has now postponed the IPO of that closed-end fund that Bill Ackman had been trying to raise money for. We had learned, based on Bloomberg reporting, that he'd been trying to raise roughly about $25 billion on that. He had raised about $4 billion and had planned to push ahead with that IPO. But at least based on what we see on the NYSE website, that our Bloomberg reporters have been tracking, that IPO, at least for right now, has been postponed.
Yeah, the idea is that they were going to file with regulators to raise about $2.5 to $4 billion. So getting that scratched is very interesting. We'll keep tracking those headlines as they come out.
And part of the interesting aspect of this story is that Bill Ackman was counting on his social media presence to really drum up interest in this IPO and perhaps pricing for this IPO as well. I don't know what this says about his social media presence, though, this delay.
And I wonder how long it'll be postponed. Like, you know, here's what we know is they were expected to price the IPO on Monday, trade on Tuesday. We didn't hear back. Representative Pershing Square declined to comment, and representatives from the New York Stock Exchange did not immediately respond to requests for comment.
Yeah, I mean, we have to get some more details on it, but if you look at the Bloomberg reporting that we had a couple days ago, it really seemed to be that at least the initial shopping of this just did not get the type of demand that I guess maybe they had set out to do. Maybe that's part of it. Maybe a postponement really is a postponement, but we'll see.
Yeah, that'll be quite interesting to see. And also maybe it was just a bad market conditions from what we are looking at as well. Okay, before we go, you guys, did anyone watch the opening ceremonies?
We were working.
Are you kidding me? I've been watching nothing else. I haven't even been watching this program.
Was anyone else really terrified by the weird opening ceremony? What?
Terrified when they cut off Marie Antoinette's head.
And she's singing?
And she held it and sang. And then whatever the band was, it was like shredding heavy metal on the... Come on, this is classic.
I found it very upsetting. And I didn't understand it at all.
I agree. I have no idea what any of this has to do with the Olympics, but it was entertaining.
Well, you know, it's a brief history of what happened in France,
Of
basically.
nothing, because heavy metal came from Britain, and you had Les Mis. That was not written by a French person.
And Marie Antoinette. That's
Did
French.
you see the big teaser, though?
How did you guys watch all this today?
Multitask.
This started at 1:30.
Tim.
Our show started at 2. I know you were tuned into our show from 2 to 3 while you were prepping for your show. How did you watch this?
Multitask.
We have lots of
Usually
monitors
at
open.
night.
Yeah.
Well, time change, you know.
Emily, what'd you say? It goes at night? It's night in Paris.
I feel like they're... Oh, okay. Yeah, that's true.
Time
See,
change.
we're just stuck here in this radio booth.
They lie. They have like 19 different screens there.
We do, but none of them are tuned to the Olympics. I guess that's for a reason.
We saw no torches today.
Maybe we can spend a little time this weekend watching the Olympics. Hopefully not too delayed. And, you know, those spoilers, you got to stay off of Twitter so
If
you
you
don't
paid
see
for
those spoilers.
Peacock, yes, you can.
All right. Well, perfect. I'll be doing that. You guys have a great weekend. That is going to do it for our cross-platform coverage of the market close on Bloomberg TV, radio, YouTube, and Bloomberg Originals. Alex Steele, you're heading out soon, but we were going to all be back same time, same place on Monday. Have a great weekend, everyone.
Our coverage continues here on Bloomberg Television. A momentous week. Who better to wrap it up with than Chris Kane? Factor Friday, a breakdown of the factors that moved the markets this week. That's coming up next, right here on The Close on Bloomberg.
And global leadership are on Bloomberg.
We are 40 million. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? If Trump knows how to end this war, he should tell us today. Because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood We want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone. Only our lives are at stake here, and nobody can just trade our lives.
Nobody covers the top global leaders like Bloomberg Television and Radio.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. The best day for stocks, at least going back to February. That's actually not enough to recover from that Wednesday, which I think was like the worst day that we had going back to 2022. On a weekly basis, you actually saw the S&P decline once again here, down about 0.8% on the week, though it did post in the green. But it's really about that outperformance, the difference that we saw between the Russell 2000, 3.4%, 5%, I should say, on a weekly basis, versus the Mag 7, which is basically the exact opposite, down almost 4%. Similar story with the SOX, similar story with the S&P and the NASDAQ.
What's remarkable is that we tend to think the Russell 2000 kind of turned around after the June CPI report in early, July? And that's actually not been the case since I would say mid-June. The Russell 2000 has posted 5 weekly gains out of 6.
Yeah.
So it's been a slow recovery.
Yeah, it's kind of interesting moves here. We did see the VIX actually end the week lower than where it started, despite some of the volatility that we saw there.
Intra-week is a different story.
And I wanted to point out, too, we had Newell Brands on there, which had like a 30+% gain on the week and on the day here. But it really was indicative, I think, of that rotation. What people were buying was basically they were looking at the biggest laggards out there, which are basically those stocks that were down 50, 60, 70% on the week, or on the year, and then trying to find any semblance of optimism, whether it's from a drop in rates or whether it's better fundamentals. You saw that with Newell Brands, you saw that with 3M, you saw that with names like Coursera, Carvana, and a few others here, and that really seemed to be the playbook with regards to this rotation.
And of course, the real test is next week when you get a whole bunch of Mag 7 names reporting earnings, whether the CapEx will actually result in meaningful ROI is the big question.
Yeah, a huge slew of earnings. In fact, the busiest week for earnings coming up next week. When we talk about the factors that did move the market, at least on this week, was it value? Was it momentum? Was it profitability? Well, maybe Chris Kane can answer that question. He helps lead our markets coverage over at Bloomberg Intelligence. We haven't spoken to you on quite a few Fridays. Always great to have Factor Friday back. And Chris, let's just start off here with large cap equity, because that really was the discussion here. Small caps stealing thunder from U.S. large caps. How have they performed, the large caps?
Well, factors and large caps are still up on the year, but most of those gains for all the traditional factors really happened in the first quarter. I would say the second quarter, the last 3 to 4 months, we really seen a pullback in some of these factors. Like, let's take momentum, for example. Like, momentum really started out of the gate hot. We had high momentum stocks beating low momentum stocks by over 10% in the first quarter, but that's really given back some of its gains. Like you mentioned, the Mag 7 rolling over a little bit. That has a big to do with that. And value's up as well. We have our long short value factor up 4%. I think that surprises a lot of people. I think there's a perception that value isn't working, but I would posit that that's really a size effect. Like when you look at the value and growth indices, they're market cap weighted, and the expensive large caps, so like Nvidia, for example, have done so well. When you strip away that size effect, and if you just equally weight the stocks, you'll see that value has worked. And I will shout out our multi-factor, which we call BMVP. That is a combination of momentum, value, low volatility, and profitability. That's actually done the best on a long short basis, up over 12%, which shows you there's some synergies with like combining these factors.
Of course, one of the catalysts that we've had for the market in recent weeks is political headlines, right? And it's kind of hard to believe how many different headlines people are reacting to, but I wonder how much the Trump trade is part of what you're seeing. What happened in factors last time Trump was elected?
Sure. The quant in me has to start with this is a sample size of 1, so it's not exactly a statistically significant thing. So take it with a grain of salt. But we did look at a long-short factor.
So following the close of the US cash equities markets for the last time this week, just going to give you guys a quick market wrap of the session today. So stock market rallied at the end of a wild week after key economic data fueled speculation that the Federal Reserve will set the stage for a rate cut in September. Every major group in the S&P 500 rose today on bets that a Fed easing cycle will continue to fuel the corporate America, with the bull market expanding beyond a small group of companies. While big tech has made massive gains this year, concerns about the so-called concentration risk have emerged following a disappointing start to the mega-cap earnings season. The rotation into economically sensitive shares began in July, following a Fed-friendly data point. Investors who had previously seen fewer alternatives to a smaller group of stock market winners were suddenly presented with more options. Financial, industrial, and staple stocks have largely outperformed technology. Small caps have risen 10% on the month on bets that they will perform better with lower borrowing costs given their higher debt loads. So today's economic data only strengthened those bets. The Fed's preferred measure of underlying US inflation, the core PCE, rose at a slow pace in June, while consumer spending remained strong. In July, US consumer sentiment fell to an 8-month low as well.
That's way higher than the index, the Russell 1000, which is only about 13%. Low momentum stocks is only about 8.5%. When you look at the ratio and profitability between high momentum stocks and the index, you're talking about a 95th percentile ranking going back to 2000, meaning one of the most profitable on a relative basis that we've seen. So while momentum has had a pullback here, I do think fundamentally it's in good standing.
Chris Kane of Bloomberg Intelligence, thank you so much. Always good to speak with you for our Factor Friday. Of course, when you talk about momentum, it's a chameleon because it's whatever had been moving. At some point, momentum is going to be made up of small caps if the small caps hold on to this outperformance.
Yeah, well, you wonder if it's going to happen as a group. The thing is, we spoke with Joanne Feeney a little bit earlier, and Kim Forrest over at Boca Capital said the same thing, just about how idiosyncratic this rally is, meaning that this really is about individual stocks, and that might actually skew some of the factors because you're not necessarily going to get what is a kind of rising tide lifts all boats.
Right.
It really is people going after those individual names.
Well, we'll continue to look through all of this for you. In the meantime, we have the top 3 coming up, where we focus on the top 3 movers and shakers at the center of the day's big stories. This is The Close on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
What's happening on Wall Street?
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Season is here.
We're skating into another earnings season.
The expectation for earnings going forward are quite high.
Bloomberg is first to break the numbers.
Adobe earnings crossing
earnings out of Broadcom.
JP Morgan, we get Citigroup, we get Wells Fargo.
There is something for everybody.
With the smartest insights.
Now banks have earnings power.
There's a resilience in the bigger cap companies.
We're not talking about a collapse in earnings for technology.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
A fund manager I know calls Harvard University a hedge fund with a school attached to it. Today's Big Take story finds Harvard enjoys almost $500 million in tax benefits. So maybe Harvard is more like a hedge fund that pays no taxes. But should it? In this week's Muni Moment, we discuss all of this with Nick Corello, who co-wrote this story. Nick, thanks for joining us.
Sure.
So Harvard is super wealthy. It's got this $53 billion endowment, and as a nonprofit, it is exempt from paying most taxes and can sell tax-exempt bonds. But the school does make some voluntary payments to its municipalities. How does that work?
Sure. So Harvard is not unique. This is pretty common among private nonprofit colleges. But a lot of the Ivy League schools make what's called a pilot, a payment in lieu of taxes, which is kind of a goodwill payment that these schools make to their hometown. Usually it's like a sliver of what they would ordinarily pay in real estate taxes, and this is supposed to help cover some of the municipal costs like policing and upkeeping their grounds, that kind of thing. Right now there's a big push among local officials in Cambridge and Boston to try to get Harvard to pay more, but it's pretty delicate because these payments are totally voluntary.
Give us a sense here, though. I mean, this is pretty common, as you pointed out. Even the school I went to, they had similar fights way back in the 40s when I went to college. Is there a sense, though, that the economic